Well, good morning, everyone. It's good to see everybody bright and early on day two. I know there's going to be a lot of in and out, but I'm looking forward to the discussions today. Yesterday was a phenomenal set of conversations, covered a lot of ground. Of course, the emphasis for this year's summit is supply chain resilience, and I think we touched on a lot of the really key points, and we're going to continue to dive deeper today. But to get us kicked off, I'm really honored to be able to introduce Michael Cohen. He's, of course, the chief economist in the U.S. for BP. He leads their oil and gas analysis and the economic and energy insights team, advises the executive team on short, medium, and long-term outlooks. Prior to his role at BP, he was the head of global commodities research at Barclays. And spent some time at IEA, at DOE, so we've kind of run the gamut, really, when you think about touch points and thinking about energy markets and analysis. And he's going to talk about the BP Energy Outlook, which the 2025 edition just released, and they're sort of on a world tour kind of talking about all this stuff, but it's a little bit broader in terms of a number of scenarios to think about potential pathways that the energy future might actually take, which is an interesting scene setter for the conversations we're going to have today, which will drill into different commodities, particularly around oil, around gas, around electric power, around minerals and metals and materials. So I think this discussion will set the stage really well. Before I hand the podium over, though, I want to remind everybody that we're doing Q&A at the end of every session using Slido, so there'll be a QR code that actually pops up on the screen. You can actually scan that and use it all day long to ask questions as we sort of roll through the program. With that, I'm going to hand it over to Michael. Michael?
Thank you, Ken. Thank you to the Baker Institute for inviting me here. Good morning to all of you. Thank you for showing up bright and early on what I understand was a difficult travel day. It's really a pleasure to be here. I think we've come to Rice University. The Energy Outlook Roadshow has come to Rice University the last couple years, so I'm really honored to be here to present it to you today. I want to start off with a bit of a scene setter. I'm going to show you a bunch of charts that are part of our Energy Outlook that go through how we see the energy system evolving. This year, we've added a couple new scenarios, so I'm excited to talk to you a little bit about those scenarios. And then I'm just going to conclude with a couple high-level remarks around the industry and some of the challenges that we're facing. And then I hope and I look forward to your questions during the Q&A session afterwards. And Ken, is there a clicker I should use to... Should I just click with this thing?
Right there.
Ah, there we go. All right, let's test this. Okay. Interesting colors. Doesn't. Okay, we'll just go on. So the point here is that each year we continue to emit about 40 gigatons of carbon dioxide into the atmosphere. There's been a narrative around the energy transition slowing. I think it's important to understand that the energy transition is taking different character and different trajectory depending on which region you're looking at. And so before we get to any projections, I would just want to show historical data. And you can see that the US and Europe are on a downward trajectory while China and India are increasing and the rest of the world is sort of plateauing. So all forms of energy use and emissions are at record highs, but we have this divergent pathway depending on the region that we are looking at. And so when we look forward into the future, we take a scenario approach to try to look at the way the energy system is evolving. And so for those of you that are familiar with the BP scenarios, we have two main ones that we like to use to try to capture the broad uncertainty associated with the energy system over the course of the next 2.5 decades. So the current trajectory scenario captures the broad pathway along which the energy system is currently traveling. It places weight more on the climate and energy policies that are already in place, but it also acknowledges that there is going to be a significant amount of difficulty in actually meeting some of those aims and pledges. So that current trajectory scenario is a slow and shallow decarbonization pathway. Emissions are only down about 25% by 2050 in that current trajectory. And if you think about the trajectory for a below 2-degree type of scenario, which is shown in the blue line here, there you see emissions falling by about 90% by 2050. And in that scenario, you see much more weight being placed on the tightening of climate policies, changing of behavior and preferences, which support further gains in energy efficiency and the adoption of low carbon energy. So for those of you that may be new to these types of scenarios, the lines will be wrong. What we're trying to do is try to understand what the uncertainty space is between those lines and try to build, in certain cases, whether it's a society, a company, a municipality, try to build scenarios and build a strategy that is robust to the range of uncertainty between those two outcomes. So they sort of serve as bookends. And then we try to say, okay, well, how does the energy system look in between those two bookends? I'm going to talk a little bit about the current trajectory. If you look at the chart that's shown here, you can see the 2023, sort of the history of primary energy supply by energy type. That's shown in the chart on the left. And you can see the red is fossil fuels, and specifically natural gas. Green is oil, and gray is coal. And you can see that on an absolute basis, those fossil fuels continue to dominate the energy mix in that current trajectory scenario, at least out to 2035 in both scenarios. And then as we move out into the 2050 timeframe, you can see that it is only the case in that current trajectory scenario. The natural gas share remains static, with the exception of that beyond 2-degree type of scenario. And if you look in the chart on the right, what you can see is that even in a current trajectory scenario, renewables exhibit the fastest growth on an absolute basis, and on a share basis, it overtakes coal, natural gas, and oil by 2050. So that's even in a current trajectory type of scenario. The other thing for those of you that may remember last year's outlook is we talked about two main phases of the energy transition: the transition phase and the substitution phase. So when we are in an energy addition phase, so this first phase, when low carbon energy is not growing fast enough to meet demand, this is effectively the state of affairs that we are in at a global scale right now. So what's happening over the course of the last couple of years is that we've had energy demand rising in excess of the ability for low carbon energy to meet that increase in demand. On the contrary, an energy substitution phase is one in which low carbon energy is growing fast enough to more than meet the increases in energy demand. And as such, unabated fossil fuels are declining. And I think it's important to understand that some countries have already made that switch. So today, and that's what's shown in this chart here, about 1/3 of the world's energy is consumed in places where that region has moved into energy substitution phase. And so when we think about what's happening here in the United States, we moved from energy substitution during the 2000s. You can see that low carbon fuels were increasing. Addition, during the 2010s and 2020s, we're back into an energy addition phase. And then as we move into the 2030s and 2040s, even in that current trajectory scenario, we start to see energy from low carbon fuels increasing by sufficient amounts to see unabated fossil fuels decline. So this is the problem that is facing the energy system, right? We need to be able to decarbonize more regions that can begin to start making that switch to move from energy addition to energy substitution. It's not sufficient to just have a couple of the regions, as shown in the chart on the left. We need to start seeing the China and other emerging economies begin to move into that energy substitution phase. And we see that in that current trajectory, even given the assumptions that we make about what is the direction of travel for current policies. So the next couple slides are going to talk specifically about the nature of the energy system. What does the picture look like for oil? What's the picture look like for natural gas and for the power system? And I want to start, before showing you any forward-looking trajectories or forecasts or scenarios, I want to try to understand what is happening just now based on historical data that is already published and put out into the public domain. And so what you can see here is that oil demand by region in the chart on the left, and then oil demand by product in the chart on the right. So I want to make two key points about oil that I think it's important to take away from this chart. And apologies because the colors look a little bit off here. But in China, when you look at the time frame from 2000 all the way up through the beginning of the pandemic time period, over half of the growth in oil demand came from China. In 2024, what this chart is showing is that China was actually a net decline or a negative contribution to overall oil demand. So the pattern of oil demand on a geographic basis is switching. We may see some growth in certain products in China over the course of the next couple years, but the idea that it will continue to provide half of overall global oil demand growth, like it has for the last decade, is something that is of the past. The second point is that road fuels, if you look in the chart on the right, in 2022 and 2023, road fuels were the particular contributor overall to oil demand continuing to grow. But in 2024, petrochemical feedstock demand was the single largest component of growth. And so again, historical data, and it's important to reflect on what this means for the future. So then, as we look towards the future, this is the profile for global oil demand. There is a plateau that we expect in the scenario of the current trajectory over the next decade. And when we think about what the key drivers are, why oil demand begins a plateau and then to decline, it is because of road transport. Now, the way that we think about this within our company and others outside is that we need to try to understand what is it that you have to believe for something to be true. So what is it that you have to believe for oil demand to decline or for it to plateau? In this case, if you want to believe in the idea that oil demand will have a longer plateau or that the decline will be less steep, then you need to think about it on either a sectoral basis or a geographic basis. On a sectoral basis, so that means that we need to see growth in other forms of oil demand from other products or from petrochemical feedstocks that is sufficient enough to offset the decline that we see from road transport. And it's very clear that even in that current trajectory scenario, those increases in petchem feedstocks and other sources of oil demand are not sufficient, and so that is why we end up in a decline in oil demand over the long term. Or you can look at it from a geographic lens, right? So if I think about where the key markets are for OEMs, for auto manufacturers, they're the US, China, Europe, key developed markets. That's the majority of incremental sales into the global car fleet. So if we think about this, then we need to understand that if China right now is selling half of every new vehicle is an electric vehicle, and even if we see a slowdown that I'll talk about in a little bit in the United States in terms of electric vehicle sales and fuel efficiency, the problem is that we have to see growth from those other geographies sufficient enough to offset the decline that we see in the US, China, and other developed markets. And it's very clear that it does not. And so that's why we continue to see a plateau and then a decline in oil demand over the long term. Specifically, I want to show you what this looks like for the United States. Compared to the energy outlook last year, we've seen an upward revision of a bit more than 1 million barrels a day due to the change in policy that we've seen over the course of the last year. So that policy remains a key uncertainty with how we develop and design scenarios. And it means that, the degree to which EPA is going to regulate and enforce, the degree to which policy continues to evolve here in the United States, could mean that vehicle standards look quite different in the coming years than what they have meant over the course of the last 10. So the incentives for OEMs, for auto manufacturers to sell EVs may be significantly lower, and the questions associated with California's regulation and its ability to set its own pathway are also all in question, which makes scenario design quite difficult. So again, what we're trying to do here is understand what that outlook might look like, try to take that into account every year when we get new information. And so it's clear here that it's still, however, a very slow, not as fast as we expected in past years, but still OECD oil demand, writ broadly, has been in decline since 2005. And here in the United States, same kind of trajectory is in place. It just may lead to a longer plateau and then decline than what we had expected in the past. And I'm going to show you a little bit about the implications of that slower electrification pace, that slower energy efficiency trajectory in an alternative scenario later on in the slides. So the other key thing when we think about the overall outlook for road transport is that this is not just about electrification, it is also about the natural turnover in the vehicle fleet. So when we look here at what this chart is saying, it's saying that there are two main things that are affecting the decline in global oil demand. The first is obviously the electrification. Between now and 2035, we expect roughly 7 million barrels a day of oil demand to be displaced by electric vehicles. And in addition, about 5 to 6 million barrels a day being displaced through fuel economy gain. And so it's important to keep that in mind, is that it's not just an electrification story, it's also the fleet turnover story. And you can see the share of car and truck miles traveled here on the chart on the right. And you can see that by region, and you can see the very slow trajectory that we expect for the United States in contrast to the much quicker trajectory that we see in China as a result of the increase in vehicle sales that are electric. Now, the other thing that we focused on as it relates to oil in this last energy outlook is the increase in use of oil as a feedstock. This has almost doubled since the year 2000, and it's increased from about less than 8 million barrels a day to over 14 million barrels a day by 2023 on a global scale. And so when we think about what has accounted for oil demand growth over that period in time, the petchem feedstock story has accounted for about a quarter of total oil demand during that time. And so in the current trajectory scenario, and as well in the below 2 degree scenario, demand for this purpose reaches about 20 million barrels a day by 2035. And that has been mainly driven by China and the Middle East, reflecting the increase in petrochemical feedstock processing capacity in those two regions. So we thought we ought to do some alternative scenario analysis in this outlook. And what the chart on the right is showing is the variation in oil demand for feedstock use over the course of the long term. And so if we take that a different assumption, so there are a number of different assumptions that one has to make in terms of trying to project this. And one of the key ones is what is the average relationship between economic growth and plastic demand. And so if we take the average relationship between economic growth and plastic demand that we've seen over the course of the last 30 years and hold it without changing it all the way into the future, which you can see in the line that is on the top there, it can lead to a difference in feedstock demand of as much as 10 million barrels a day of oil equivalent by 2050. And so the key point that I want to make is that depending on how one characterizes that relationship between economic growth and plastic demand, any kind of plausible and different assumption about that could mean you could have very different feedstock demand assumptions and feedstock projections of anywhere between 5 to 10 million barrels a day of oil equivalent by 2050. The large majority of that would be for oil. So the point here is that depending on those assumptions, you could get very different outcomes in terms of that trajectory for oil demand over the long term. Now, when we think about the supply side, our projections expect in a current trajectory scenario and in the below 2 degree scenario, a plateau in U.S. tight oil supply. Now, light tight oil is still the most elastic form of wellhead supply after OPEC, but I think it's important to understand and try to reflect on the fact that it is less elastic than it may have used to have been, right? And that is because of the consolidation that we're seeing, because of the returns focus that many of the producers have begun over the course of the last 5 to 7 years. And so the implication of this is that price is going to have to do more of the work to bring about a change in supply going forward. And the other point that is shown from these two charts is that here I'm circling the non-OPEC plus supply component. It is effectively at the whim of OPEC decision-making, which is shown in yellow. So OPEC plus in the chart on the left is keeping supply roughly stable as oil demand is plateauing and declining, increasing its market share. And in the below 2 degree scenario, it's cutting supply quite significantly in order to keep prices elevated. But the point is that whether you're in a current trajectory scenario or a below 2 degree scenario, non-OPEC plus supply is declining, and it's declining at a very high pace. Now, the point is there are going to be some components of non-OPEC plus supply that are better suited for the future and for this uncertainty that we face in the going forward. And there are certain ones with low carbon attributes, certain sources of supply that are close to refining centers, certain sources of supply that are close to resilient parts of overall oil demand. And so that is going to be the key characteristic for what that non-OPEC supply mix looks like going forward into the future. So one last point on supply. I'm reminding you this is the global oil demand picture that I showed you in one of the slides before. Now, the IEA recently released a report on decline rates. You can see that the global annual average decline rate assumed here is in the range of about 4 to 6%. By their estimates, that global annual average observed decline rate is about 6% for conventional oil supply and about 7% for conventional natural gas. The other point that the IEA made is that nearly 90% of annual upstream oil and gas investment since 2019 has been dedicated to offsetting production declines. 90%. That's a pretty dramatic and very large number just to offset production declines. And so natural decline rates, for example, if all capital investment were to stop, are becoming steeper, and that reflects the fact that we've seen a change in the composition of oil and gas production. And in addition, in order to develop new fields to offset those declines, we expect that, based on the work that the IEA has put out, and as well some of the work that others in the industry and other consultancies have done, that to develop new fields on average costs around 50 to 150% more than the cost to maintain or just develop existing assets. So none of this may be news to you all as an industry crowd here in Houston, but I think it does add some really striking implications for where and how much we need to be investing in the coming decade, depending on what range of demand scenarios you believe. The real question is, at what cost? And so even in that below 2 degree scenario, you can see in the blue line, the decline rate, a stylized decline rate assumption that is shown in that dotted line is still steeper than even that deep decarbonization scenario. And so that means that irrespective of which scenario we're in, we need to see additional investment to maintain existing supply, or else we're going to get a disconnect between supply and demand and the price implications from that none of us want to experience again. So I want to spend just a minute on the outlook for natural gas as well in our scenarios. Here you can see the pathway, depending on the scenario that you're in, differs quite markedly than the pathway for oil demand. So in addition, when we think about what this looks like compared to the outlook for oil demand, it is very much dependent on the outlook for emerging economies and their appetite for natural gas. It also depends on whether there's substitutability over the course of the long term with renewables and natural gas. And either way, we end up with a very wide divergence depending on which scenario we are in. So in contrast to oil, which is showing a decline across both scenarios, here the outlook for natural gas demand continues to grow in current trajectory, driven by rising natural gas use in emerging economies as they grow and industrialize. In both scenarios, there's a doubling in LNG exports and LNG trade in both of those scenarios. And the prospects for LNG trade post-2030 are critically dependent then on the pace of the energy transition. So if we look at the outlook for emerging Asia, which is what's shown in the chart on the right, that accounts for roughly half of the increase in global gas demand in the current trajectory. And production in that region is broadly flat. You see some increase in pipeline imports, but the entire growth in gas demand in emerging Asian economies is effectively met by increasing LNG imports. And the increase in these economies' imports of LNG more than accounts for the entire growth in global LNG demand. So I just want to repeat that because this is important. It is an emerging markets and emerging markets in Asia story. They are accounting for the most increase in natural gas demand on a global basis, and they're meeting it effectively with imports of LNG. And so it's important to understand that the course of action that those countries take in terms of their dependency on LNG and their dependency on natural gas will shape how global gas markets evolve over the course of the coming decades. Switching quickly to power, I want to make 4 key points. So as we've said in the past, one of the core beliefs from the outlook is that we see a rising share of your total final consumption being satisfied by electricity. And so over the last 10 years, the world's demand for electricity has grown twice as fast as overall energy consumption. And that trend continues to carry on irrespective of the scenario that we're in, with the world's demand for electricity doubling or even more than that by 2050, and that's what the chart on the left is showing. Wind and solar are the biggest share of growth over the outlook, and we, of course, will need to see changes in how our power systems operate to ensure their reliability, their resilience, and that is going to take significant continued investments in the grid. The other point to make is that data centers today make up around a tenth of the world's increase in electricity demand out to 2035. So it's just a tenth. It's important, but it's far from everything on a global scale. And in some regions, however, like here in the US, data centers are accounting, in our view, for around 40% of the growth in electricity consumption over the next decade. So if we are going to think about artificial intelligence and energy, it's important that we think not just about the impact of data centers. The impact of AI on energy is going to have an effect on our productivity. It's going to have an effect on long-term economic growth profiles. It's going to have an effect on how energy is supplied and, of course, on the efficiency of our energy system. So this is not just a AI in energy and how much is going to be used within data centers story. It could fundamentally shift many other aspects of how we think about energy over the long term. And I think some of that gets lost in the focus on just data centers. Now, for the US, what this chart is showing is a continued growth in electricity generation. So as you all know, load growth was roughly flat. Now we see it increasing by about 2% per year. Wind and solar continues to show growth over the course of the outlook in the current trajectory and the below 2 degree scenario. And the gas share, which is shown in red or darker red, does remain constant. What the chart on the right is showing is to try to put all of these different components of incremental demand in perspective. So when we think about the rise in production that is going to be needed in order to satisfy that rising demand for natural gas, some of it is for the power sector. So you would see an increase of about 100 BCM or 10 BCF per day by 2035 for power use. Half of that is for data centers, which is shown in the pink bar on the bottom there. And another 100 BCM is needed just for feed gas in order to supply the global LNG appetite. So how producers choose to manage that, the fact that you have equal shares of increase in feedstock need and the increase in need for the power sector is going to be a significant challenge that producers will have to navigate in the years ahead. Now, it would not be a surprise to you that any kind of talk that I do anywhere in the United States, and arguably anywhere, I always get a question on nuclear. And so I'm trying to get ahead of that this year. And so here we have the nuclear generation outlook. And in the current trajectory scenario, on a global basis, nuclear generation grows by about 65% and even higher in the below 2 degree scenario. And both scenarios are showing significant growth, but that nuclear share stays at about 8 to 9% through to 2050. That growth is driven primarily by emerging regions, with China leading the expansion, and in contrast, the developed markets see flat output in the current trajectory scenario and only modest growth in the below 2 degree scenario. So we do not expect significant growth in U.S. nuclear capacity or geothermal capacity through to 2035. We do anticipate a gradual scale up. Much of it is supported by financing from technology companies, and of course, we're seeing this start for data centers as well. Now, there's a lot of uncertainty about the commercial viability and the deployment timeline of many of these technologies, particularly in meeting that rapid need for the increase in data center demand. And so obviously a lot of uncertainty with this outlook for nuclear, but the point is that it maintains a constant share over the outlook, with much of the rise coming from emerging economies, and then in developed economies, it's having to offset the slow decline from older reactors that need to see retirement, even at the 65 and beyond year of their life. Finally, I want to just reflect a little bit on the growth prospects for low carbon hydrogen and CCUS. So we expect that the prospects for both of those low carbon vectors to be pretty limited. Low carbon hydrogen reaches about 75 million tons a year by 2050 in current trajectory. Now that's less than the current high level of hydrogen demand, and we get almost all of that today from unabated fossil fuels. So we expect considerable headwinds to slow the deployment of these technologies in the U.S. We saw with the passage of the OBBBA revising down the availability of the 45V hydrogen tax credits by about 5 years. Now, we still expect a gradual progress to be made in the long term out to 2050 as production costs for hydrogen come down and demand increases. But much of the domestic demand is going to be led by feedstocks development, so for the use of specifically for ammonia, methanol, and refining, with new uses emerging post-2035. For CCUS, the U.S. does remain one of the most competitive regions with the 45Q tax credit, but incremental costs are still going to limit development and deployment in the nearer term. There is an additional incentive in the OBBBA from increased value of tax credits for EOR that makes it a particularly favorable pathway for oil production. But the point here is that if we think about the outlook just up to 2035, CCUS is enabling the use and production of blue hydrogen, and long-term, that CCUS and those technologies associated with CCUS is able to come in and decarbonize the power sector, mostly natural gas, and also hard-to-abate industrial processes. So there's a favorable policy environment, but that favorable policy environment is not what we have in the current state of affairs, is something that we see evolving eventually over the course of time out to 2050, but is not the case at this point in time. So I want to pivot now to thinking about alternative scenarios. Number one, thinking about the likely increase in geographical and geopolitical fragmentation, the prospect that we could see a weaker energy efficiency outlook, and try to think about what that might mean for the energy system. So over the course of the last year, for anyone who's obviously paying attention, we've seen this significant escalation in geopolitical conflict. This significant increase in tension in recent years. We saw the conflict in Ukraine and the Middle East, and the greater use of trade sanctions and tariffs. And so one of the things that we wanted to do in this year's outlook was to try to think about what this might mean through the various channels and how this might affect the global energy system. And so when we think about the increase in geopolitical fragmentation, obviously that results in less global trade and lower GDP growth. And the reason that that's happening is that the scope for increased specialization and the scope for increased competition is limited. So your gains from trade are removed, right? It's just basic Econ 101. And so as a result, that feeds through into lower energy demand. But the other point that is important to reflect on is that increasing geopolitical fragmentation also heightens the importance that energy security, the importance of energy security as countries seek to reduce their dependency on imported energy and energy technologies. And that greater priority on energy security is likely to trigger three important types of reactions. So first, as this schematic is showing, you have more domestically produced energy relative to imported energy. You have a desire to reduce the dependency on imports of energy technologies, including low carbon technologies, and then the development of increasing domestic supply chains, even if that is coming at greater overall expense. So any increased weight on improving energy efficiency you could conceivably see that happening as well. But this also reduces the needs for all types of energy, and so it further bolsters energy security. So when we have this happen, we are assigning, in addition, less weight on sustainability and climate goals, which goes back to this concept of the energy trilemma, and effectively affordability and energy security are prioritized ahead of those climate goals. So we tried to do some modeling at a global scale with what this increased geographical fragmentation might look like, tried to take all of these different vectors into account. And what we get is, on balance, what this first bar is showing is the impact of the lower level of GDP that is stemming from weaker international trade. And that primary energy fall is due to that lower level of GDP. The second bar is meant to represent the increasing concerns about energy security on a global scale. And the important point here is that concerns about energy security generate a mix of offsetting impacts. So we have this increased preference for domestic rather than imported energy. That's leading to a shift away from oil and natural gas in some countries. Those countries are, those fuels, so oil and natural gas, are the most heavily traded fuels. And so in a sense, if the country has renewables and coal tend to be produced and consumed more domestically, then we're going to see an offsetting effect of that. At the same time, you have a higher cost of renewable energy as countries move away from those low-cost international supply chains, together with the lower weight assigned and attached to climate goals, and that also weighs on low-carbon energy and favors fossil fuels in some countries. So the third bar in this chart is meant to represent the net impact of the two channels. Number one, the lower level of GDP, and number two, the increasing concerns about energy security. So what this chart is showing you, and that third bar is showing, is that overall energy demand is lower, the carbon intensity of the fuel mix is slightly higher, and that reflects the increasing share of coal at the expense of oil and renewables. So at the end of the day, we saw not that much of a change versus a current trajectory scenario. But then when we started pulling back the layers and looking at how different countries were coming up in this mix, we saw some interesting results. So in the United States, we obviously are a net exporter of fossil fuels, so any heightening in energy security concerns doesn't really lead the U.S. to reduce its demand for either oil or natural gas. But it does cause it to reduce its dependency on imports of low-cost and low-carbon technologies. And so because the U.S. economy is relatively less trade-intensive and therefore less exposed to the impact of weaker net trade, we end up with this type of effect. China is roughly a mirror image of this. So their heightened energy security concerns cause it to reduce its dependency on imported oil and natural gas. But since it's the dominant producer of low-carbon technologies, its access to low-carbon and low-cost energy is largely unaffected. So at the end of the day, the point that is important to make is that increases in fragmentation, or the increasing prospect of fragmentation in our energy system, is likely to lead to increasing amounts of differentiation in our energy system. So that's the first scenario. The second scenario is important as well. So here we've seen a period of very weak energy efficiency gains over the course of the last couple years. From 2010 to 2019, energy efficiency increased at an annual average rate of just less than 2%, which is shown here on the dotted orange line across the page. Each year, what that means, in effect, is that the world needed 2% less energy to produce the same level of output. But over the last 5 years, annual energy efficiency gains have averaged just 1.5%, with a particular weakness in 2020 and over the course of the last 2 years. So there's a lot of theories. There's no certainty about what is causing this reduction in energy efficiency gains. It could be a post-pandemic rebound effect. It could be because of extreme weather events, or it could be because there's just been a slowdown in investment in some of these energy efficiency projects. But it's fair to say that we just don't know. This recent period of weak energy efficiency gains has caused that rise in energy demand that low carbon energy has been insufficient to be able to meet. And so we just don't know what the future energy efficiency gains will look like. And so we wanted to try to do some alternative scenarios with it. And so in a current trajectory scenario, this is the baseline, right? We expect that sort of return to the average, right? But suppose the recent weakness is a bit more persistent. And suppose, for example, we see the weakness in energy efficiency gains persisting until about 2030, before gradually converging then to a current trajectory profile by 2035. And so that's what's shown in that red line. So if we hold constant all the other elements of a current trajectory scenario, just the weaker profile for energy efficiency, it leads to a materially stronger outlook for energy demand, with total final energy consumption growing by about 20% by 2035, compared with about 15% in current trajectory. And the important thing to keep in mind here is that almost all of the increase in energy in order to meet that weakness or disappointment in energy efficiency gains has come from rising fossil fuel supply. So there's this very, very high level of correlation between the recent disappointments in energy efficiency gains and fossil fuel supply. And so to illustrate the effect on oil and natural gas, we're taking this assumption that all of that additional energy demand in the trajectory that is implied by slower energy efficiency gains is met with fossil fuel supply. So it may be different in reality, but we're just trying to look at what this stylized scenario might mean. And so the growth in non-fossil fuels is effectively just kept unchanged from the current trajectory, but it does capture the essence of those past correlations that we've seen in history. And so what happens is that oil demand in that scenario increases by about 6 million barrels a day over the next 10 years, compared with a broadly flat demand in the current trajectory scenario. Likewise, natural gas demand increases by about 1,000 BCM, compared with less than 700 BCM in current trajectory. So you can see that in these two charts. And the key takeaway here is that if you assume a weaker energy efficiency profile, even for just 5 years relative to the counterfactual, that could lead to a significantly stronger outlook for oil and for natural gas, and indeed for coal as well. But the opposite is true as well. So if we had seen an average gain in energy efficiency, as we saw between 2000 and 2019, the increase in oil demand or natural gas demand that we saw over the last 2 years would have been significantly less. So just to conclude, and then I look forward to the questions, I think it's important to reflect on what are the common trends across the scenarios, and then what are the trends that are dependent on the transition. So the common trends, just a reminder, electrification increasing share of renewables in overall power and overall energy demand, and a decrease in oil demand across both of the scenarios. The trends that are dependent on the transition, so very much so in terms of gas demand outlook, and then in terms of the outlook for new markets and new low carbon vectors, so low carbon hydrogen, SAF, CCUS, and DAC. The second point I want to just make before concluding is just the idea that the transition is slowing, I think, needs to have some nuance with it. We don't agree with that notion. We're seeing low carbon sources continuing to increase. When we look at the overall investment that is going into fossil fuels versus low carbon, we're seeing it increase in low carbon vectors by 2x to 3x versus the fossil fuel investment. It's just the reality is that the growth in low carbon sources is not keeping pace with the overall increase in energy demand, and a big part of that story is the slowdown in energy efficiency gains. So if that is sustained, it will affect the level of energy demand and that mix of clean versus fossil fuels. Irrespective of the energy transition scenario or the scenario that we're talking about, the world is going to need more energy, and oil and gas, irrespective of the scenario, continues to play a very important role in the energy mix in both of those scenarios across that uncertainty space. And then finally, when we look at different scenarios for what's happening today in terms of fragmentation and overall weaker global growth, that is going to affect the overall focus on energy security and affordability, and leads to much more different energy pathways depending on the resource endowment and how that plays out over the long term. So with that, I'll stop, and I'm happy to take your questions.
So we've had a few questions come through, and given time, I'm going to actually just ask one because I think it's really relevant for several of the ones that came through. But in particular, there are a couple of questions about less developed economies. And as they begin to grow and sort of climb that industrialization ladder and sort of expand energy use, how does that impact or get factored into the outlook? Because you've shown, even in the current trajectory, a sort of plateauing. Would that change if those countries were to, say, accelerate or?
Yeah, so I think, thanks for the question, Ken. I think this chart helps to show that dynamic appropriately. And so what this chart is showing here is the Human Development Index on the y-axis, and then your overall energy consumption on a per capita basis on the x-axis. And when we look at the share of countries represented by each of these, not up.
Yes, there we go.
There we go. Represented by each of these dots, you can understand that roughly half of the world's population is consuming very little energy today. So this shouldn't be a very unfamiliar chart to many of you, because it's been used in the past. I think what people tend to do is they try to equate the rise in energy use to make it 100% about the rise in fossil fuel use. And I think there's a difference, which is being a divergence and a distinction that's being made in the scenarios that we talk about, because we have an important increase in both energy efficiency use over the long term, and as well an increase in renewable energy supply and electrification. That means that we can't, over the long term, equate every little bit of need for more energy with a need for more fossil fuels. So the way in which we do our modeling, we take 14 or so different regions. Those regions are assumed to move at different paces in terms of their trajectory and their decarbonization trajectory. If I showed you the chart for India and India's oil demand, it would rise across the board for both scenarios for at least 2 decades, right? And I think the important thing is that we need to understand each of those countries and regions are going to take a very different trajectory based on their initial conditions right now. And we try to take that into account when we are looking at the aggregate, at an aggregate level. So I'm not sure if that, if they're just asking for more granularity, then there's plenty of insights and data on our Outlook website that you can look at and test for the developing economies versus or developed economies versus emerging economies, and look at how those trajectories diverge depending on the scenario.
Yeah, and to that point, I was going to recommend a lot of you ask questions that are directly addressable just by diving into the Outlook. So I'm going to encourage you to actually check that out because it's a great resource. Join me in thanking Michael. Thank you.
Thank you.
Thanks, man. That's great. All right. So as I mentioned yesterday, we do archive all these questions, and ones that are really burning and are not necessarily answered in the course of the Q&A, we will try to get to in responses to you all. So we're going to move on to the next part. I think Michael set the stage, particularly with the geopolitical fragmentation scenario discussion, for understanding how supply chain complexity can sometimes, in many cases, almost feel overwhelming. So I'm really pleased to invite Rick Talent up to the stage. He's a Global Executive Vice President at Shell. There he leads Shell's supply chain and contracting and procurement organization worldwide. He's been involved in Shell's efforts in Qatar around gas to liquids, Pearl in particular, and also been involved in Gulf of Mexico operations. So I am going to have a seat over here. I'm going to invite Rick up to the podium, make a few opening remarks, and then we're going to dive into a conversation. Again, feel free to give me some questions if you have them. Rick?
Thank you, Ken, and great for the opportunity here to speak. And I think the topic of resilience in energy supply chains is fitting given where the global economy is today. As Ken said, I'm our Executive Vice President for Supply Chain and Contracting and Procurement for Shell. And I think in my opening remarks, I'll give you a little context of what we do. I think a lot of people know the pectin by gas stations, but understanding what goes behind that, I think, is important. It's also important that I'm not a supply chain person by background. So I was our managing director of our Shell companies in Qatar, which is gas to liquids and LNG. And I ran our Gulf of America business before that. So when it comes to supply chains, I've seen both sides of the coin as well. So a little bit about Shell. So for 100 years, Shell has been in the heart of the global energy system, connecting energy and people and earning the trust and the promise that you can be sure of Shell. Today, we provide energy directly or indirectly to over 1 billion people, fueling their cars, the planes they travel on, the ships that deliver their goods, and providing heat to their homes. Every single day, over 1 million customers go to a Shell fuel station around the world. So 46,000 fuel stations across the world. That's more than Starbucks or more than McDonald's if you look at the number of locations. Shell has operated in the US for nearly 120 years. So we're active in all 50 states and have over 11,000 employees in the US. US is the #1 country for Shell. It's our leading destination for Shell Capital. We spend about $10 billion per year for OPEX, CAPEX 50-50 in the US. And we're proud to be the largest oil and gas producer on federal lands and water, which means we're also the top royalty payer to the US government. We're the largest buyer of US LNG at 16 million tons per annum. And we're the operator of more than 3,400 miles of pipeline that go through the US Gulf Coast. So 70% of every molecule that goes from the US Gulf Coast goes through a Shell pipeline. and we have 12,000 Shell-branded fuel stations in the US. As a global energy company, as demand is expected to rise 25% over the next 25 years, so very similar to what Michael said, our responsibility is clear. We must meet the demand while lowering carbon intensity and expanding access to the opportunities energy brings. Shell's vision is to be the world's leading integrated energy company. That means delivering more value with less emissions. We're growing our integrated gas and LNG business. We're sustaining lower carbon liquid production. And we're transforming our downstream renewable and energy solutions portfolios to meet the evolving needs of society. But to achieve this, resilient supply chains are essential. That means investing in infrastructure, supporting consistent policy frameworks, and fostering international collaboration. These supply chains must be designed not only for efficiency, but also for adaptability, able to withstand disruptions and deliver energy security at scale. Energy supply chains and energy security go hand in hand. Energy supply chains have been built, refined over decades, engineered to move resources efficiently, reliably, and at scale. And Shell has been at the forefront of this evolution, navigating complexity and deep expertise and global reach. External disruptions can challenge the most established systems. And I think currently today, we've seen those disruptions over the last 5 years. Obviously, starting with COVID, going into inflation, tariffs, we've even had ships in the Suez Canal going sideways, blocking transport. Every single day seems to be a disruption to global supply chains. But we do know now that we are more resilient than ever. But disruptions can still prevent us realizing the full potential of our assets, of our operations, and of the overall energy system. But not all parts of the energy system and supply chain offer optionality. Some are highly specialized, capital intensive, and deeply integrated, making them especially vulnerable to disruption or public policy decisions that have unintended consequences to deliver more energy projects in the United States. Give an example, so offshore production in the Gulf of America, it's highly specialized, very capital intensive, requires long-term outlooks of 25 to 30 years for investment, and requires stable, predictable policy to support long-term investment and operational efficiency. That's why bipartisan permitting reform, for example, is so important. Legislation like the SPEED Act, which is sitting in Congress, can help overcome delays and uncertainty, sending a clear signal that the US is serious about developing reliable, affordable, and secure energy across all forms. So in closing, the energy future we envision will not be built by chance. It will be built by choice. The decisions we make today will shape the energy landscape of tomorrow, and we must make them with purpose, urgency, and clarity. Thank you.
So first, thank you for joining me.
Thank you.
I just want to comment, Shell has been very gracious with executives' times over the years. I think you've joined me on stage, the company's joined me on stage in some capacity for the last 7 of the 9 summits, so it's pretty nice. You made a couple of points, one of which I'll just highlight that Jason Bennett, who helped me sort of pull all this together yesterday, summarized in his closing comments that reducing political risk is critical for maintaining supply chain resilience. And I mean, you're already dealing with market risk, you're dealing with geopolitical risk. To actually layer on political risk can be a problem. I wonder if you could reflect a little bit on the last several years, because you mentioned the amount of disruptions over the last 5 years, but if you could reflect a little bit on specifically what those have looked like and how you've dealt with them.
Yeah, I think it's pretty fascinating. Of course, I've been in this role for less than 2 years, but if you talk about supply chain resiliency, disruption, that wasn't a big topic 5-6 years ago, and I think that's completely changed today. Obviously, I think it started with COVID. I always talk about COVID as the ultimate disruption, right? There was no playbook to figure out how we were going to manage through COVID itself, whether it be supply chains, whether it be business outlook, would it change the idea of energy security, energy affordability. I remember leading our Gulf of America business, we had negative WTI for a couple of days. What does that do to your business? I think that was a wake-up call. And I think since then, we've had a significant number of disruptions, whether it be Russia-Ukraine, whether it be geopolitical risk in the Middle East. Like I said, the Suez Canal was shut down for a few days. That impacted global supply chains. Tension between US, China, tariffs, inflation. You add it all in there, every single day there's something different. What I would say for a company like Shell, we operate in 60 countries, we're a global company. We have the ability to be resilient and to go across the world. We're able to spread our supply chains out, be resilient, not dependent on individual countries or individual companies or suppliers. We're also able to put infrastructure in place that allows us to be much more optimal. So again, our trading and supply business is one of the largest trading businesses in the world. We're actually able to use the capability that we have today to be able to find ways to get molecules to our customers where they need, independent of what the geopolitical or supply chain disruptions are. And so I think a company like Shell, just given our global reach, our global size, we're able to work through this. But I would say it's a new dance every single day.
It's interesting because you've just highlighted several points that were made yesterday in the deliberations at the conference. One is basically the regional diversification you have allows you to avoid single points of failure in many cases, which I think critical. But then other risk mitigation tools you have, for example, the trading function that you have at Shell, which is massive and world class. So that's actually very useful to think about because for trading to function, you actually need deep and liquid markets as well. So along those lines, because something that came up yesterday quite a bit was how you get to depth and liquidity in emerging market supply chains. So when you think about in the energy space, minerals and materials, when you think about expansion of electricity and electricity infrastructure, those look very different in many locations, both across regions, but also then, say, longer, more mature markets like oil and even natural gas. I wonder if you could do a little compare contrast, because I know you and I chatted a little bit about how they're all different.
Yeah, we had a conversation. When people talk about Shell and supply chains, we are multiple supply chains. We're not a single supply chain. I always give we sell 500 million cups of coffee every year at Shell. I didn't know that until I got in this role and we started managing coffee supply chains, which is very different from minerals and electricity and oil and gas. Yeah. Also, putting sausages in German gas stations is very different than LNG projects as well. So it's quite fascinating, and every supply chain has its own, I would say, challenges and opportunities. I think, as you said, oil and gas are very liquid. I would say the infrastructure, the ecosystem to move those molecules around has been in place for many decades. It took many decades to build those up. It took lots of ingenuity, of course, trading capability to be able to manage that. And I see when you see disruptions, you also see the rewiring of how oil and gas flows across the world. I think you're seeing in the emerging markets, as you said, minerals, electricity, power, we don't have that ecosystem in place today. So it is a very regional approach. And so when we talk about energy transition, we talk about, I'll give power for example, 5-6 years ago, I think we had a belief, rightly or wrongly, that power was going to be something that really changed the energy system in many ways. And in some ways we were right, but it has been extremely fragmented. So 50% of the new I would say renewable power generation has been built in China. That was probably not something we expected it. We might have expected more in Europe or more in the US, but of course the policies and the regional diversification hasn't happened. And so again, as a global company, we're able to manage through that. We're able to, again, use our trading and supply organization, and we're also able to use the diversification we have in our own portfolio to be able to drive efficiencies.
So I want to sort of lean into one part of what you referenced with response to deep water production. Yep. I know the Gulf is a tremendous asset for Shell, but when you look around the world and you look at deep water, the deep water play, which is sort of rising in Guyana, for example, yep, and pretty pronounced in Brazil, but there's other areas that are also potentially prolific, particularly given the amount of exploration and announcements that have been made just over the last 5-6 years. What will it take to scale that part of the industry? Because, as you mentioned, it's a very specific supply chain, very capital intensive. Usually we're talking about long lead times. Right. How does that play out when you're thinking about planning and supply chain resilience against the backdrop of everything that's happening in the world of energy?
No, you're exactly right. I mean, the deep water, I think, is the new go-to area when it comes to oil and gas. I think the Permian was the hot area for many years. I always say if you were to take the Permian and put it in a different country, it may not work. The US ecosystem allows that to happen. And if you think about deep water, many of the things that we learned in the US, we've actually extrapolated to other places around the world. And you're starting to see that manifest in supply chains, but also capabilities. I'll give great examples. I mean, right now, the hottest place in the world around deep water is still Brazil. The Brazil pre-salt, the amount of growth there, the FPSO growth, subsea trees, umbilicals, et cetera. They have now built an entire supply chain in Brazil to be able to manage that. If you were to be able to get those same type of discoveries, let's say in West Africa, are you able to scale that as fast? The answer is probably not as fast as we were able to do in Brazil, but you are able to start to build out capability. And so FPSO capability, are there areas where you can start to look at subsea trees, for instance? Of course, your drilling capabilities as well, well services. And so the new hot play still is probably West Africa. I think Guyana is still on the cards, but now you're looking at places like Namibia, you're looking at places like Gabon, Sao Tome, et cetera. I think over time, if you see significant discoveries, you'll see those supply chains start to shift as well.
Interesting. That actually raises some interesting broader questions that I think we've been touching on over the course of the summit, which is how will developing and emerging economies actually deal with the growth in demand for resources that they have. And I'm sure that presents its own set of challenges, but I want to ask you specifically about one that I think you can draw on from your experience, because you had been involved with Pearl GTL in Qatar. And I'm sure deal making in that part of the world is very different than deal making in the US Gulf. So I wonder if you could do a little compare contrast without necessarily saying anything negative or positive, just reality, right? So.
It's a different world, but I guess for context, for people that don't know Pearl GTL, it's a gas to liquids plant. It's still the single largest investment Shell's ever made. I call us magicians. We take methane and convert it into liquids. So you make fuels that look as clear as this water here. It's some of the cleanest burning fuel, most efficient fuel, but you also have lots of other things, base oils, et cetera. It took a lot of courage to make that investment. It took courage, I think, from Shell, but it took a lot of courage from the state of Qatar as well to make that happen. And again, it was a lot of negotiation. I would say Qatar is a very bold country in terms of their ambition. And so I think the values that we were trying to do aligned with what Qatar was trying to do. They are shrewd negotiators. But what I find anywhere you go when you negotiate with companies or countries, we're still all human beings. It's relationship, it's trust-based. Negotiating in Louisiana for Gulf of America versus negotiating in Qatar, yeah, it might be slightly different language, it's different buildings, but it's still based on trust and relationships. So I say there's still a lot of that as well. The other things I give the Qataris a lot of credit for is they stick to their word. If they have a contract, they will stick to their contract. Their negotiation is all above board. And so I would say when it comes to ethics and compliance, they're fantastic as well. So I've taken a lot what I've learned from them and brought it into my current role negotiating with other places around the world.
That's a really interesting perspective. I know one thing here at the Baker Institute we talk a lot about is sanctity of contract and rule of law, yep. And I think that's actually also critical to underpin development of supply chain resilience. Something I tell my students all the time, and I'll come back to that in just a minute. But there's a couple of questions that have come through. One in particular, which I think you can speak to, and it kind of gets to the differences across sort of the commodity landscape, but it's related to position in terms of developing supply chains and getting deeper into different markets with regard to electrons versus molecules.
Yep.
I wonder if you could talk a little bit about
that. Again, I'd say probably 5 or 6 years ago, we were looking forward into the energy transition with the belief, again, that the energy transition would accelerate. It would start to displace molecules, or at least fossil molecules, and that you would see the development of more lower carbon solutions. I think that is true to some extent. I think how it's actually played out has been different. So we tried to get into electrical power generation or renewable power generation. We found that is not our competitive strength. There are other companies that can do that. We still have investments in power, either solar or wind. We still have $20 billion of capital employed out of our over roughly $200 billion globally in lower carbon solutions. But that's probably not where our competitive advantages lie. It lies in the molecule space, the molecular space. So we're spending lots of our R&D capability. We're looking at how we build different business models and things like bio-LNG and things like synthetic LNG, also looking at synthetic fuels. We think that's probably where our competitive advantage can come in. And so we are starting to put a lot of our supply chain efforts, our R&D effort, our innovation effort in the molecular space more than in the electron space.
I'm glad to hear you say that. It's actually another point that is often raised with regard to the principle of comparative advantage and where you actually can leverage that to deepen supply chains and deepen networks and expand market position, stuff like that. And I think companies like Shell definitely have a comparative advantage in the molecule space. Doesn't mean you don't play in the other one, but it's an interesting perspective. There's another question here which I think is relevant because it also connects to some work we've been doing that has to do with natural disasters.
Yep.
And I know every company that is in the international, even domestic landscape has certain protocols in place to deal with disasters. I wonder if you could speak to like hurricane season, right? What do you go through as you think about maintaining the resilience of your infrastructure and the ability to serve your customers during those types of issues?
Of course, leading our Gulf of America business for many years, it's something near dear in our heart. So hurricanes come and go. It's part of life when you operate in the U.S. Gulf Coast. I think there are probably three areas that I would probably touch on. The first is how do you design your assets? We want to make sure that our assets are resilient to storms or natural disasters wherever they may occur. Now, the 100-year storm or 500-year storm or 1,000-year storm continues to increase. So, of course, that design, I would say, protocols have also changed. But the first thing is make sure that you have resilient assets based on where they are. I'll give a great example. We have an FPSO in the Gulf of America, which is our Stones FPSO. Normally, FPSOs wouldn't be put in the Gulf of America because of hurricanes. What we designed is we can actually disconnect from the turrets. We have a disconnectable turret. When a hurricane comes in, we can disconnect. The turret goes below the surface of the water. We sail away from the hurricane, obviously. When it clears, we come back, reconnect, good to go. That is a completely different design. Innovation allows us to be able to produce molecules that are so far out in the Gulf of America that pipeline doesn't make sense. So that's the first one. The second one is actually how you deal with it. We have an amazing group of people in the U.S. Gulf Coast on our hurricane crisis team. It's 85 people that are part of it. We drill every single year beforehand. But of course, many of these people have been through many hurricanes, so they know what to do, right? They know what to do ahead of time. They know how to get people off of our platforms, how to shut in safely so there's no leaks. And then, of course, afterwards, they know how to respond to it. And so that's the second part. And then the third one is if you do have damage, you need to get back up and running, we have the capability and the engineering capability to get the assets up and running as quickly as possible.
So moving from natural disaster risk to kinetic risks, because what's been going on in Suez, what's been going on in the Persian Gulf,
yes,
these present really interesting kinetic risks. How do you flex around that?
That's where diversification comes in. So there's a lot of things come in, and I would say AI helps in digital capabilities, but understanding where all of your vessels or ships and everything are around the world at all times and being able to optimize based on any kind of changes in supply chain, that's number one. Number two, diversifying your supply chain as well. So we're not completely reliant on a China or an India or Europe. We have things spread out across the world in different countries that allow us to pivot where needed. Sometimes it's not overnight, but we can do it based off of what happens. And then the third thing I would say is, again, the portfolio is so broad, and we're allowed to use that trading and supply capability, again, to optimize the supply chains.
Interesting. So we're unfortunately running up against time, so I do want to ask you one final question. I warned you I would do this. But so I've got students in the room, and they're all looking at their career paths and thinking about what they're going to do as they go forward. And you've certainly been around the world and touched many different aspects of the energy sector, and today you touch them all pretty much. So I wonder if you could share a little bit of reflection on your own experience with all of them so they can take something away.
Yeah, so I grew up in Tulsa, Oklahoma, moved to Houston 22 years ago with Shell. Never thought that I would be living in Qatar running a gas to liquids plant. I probably didn't know where Qatar was on the map or what gas to liquids meant. Didn't realize I'd be running a global supply chain organization. What I would say, it's a marathon. It's not a sprint. I had a mentor who told me some great advice when I came in, because I was probably young, ambitious, eager to get after it. He said two things. He said, first of all, the energy landscape that we lead in today, that he leads in, will be very different than what I lead in the future. So again, what we see today and what we're talking about on stage will be very different in 20 years. He said, two things will make you successful. One, curiosity. Make sure that you learn as much as you can and be curious. Not just ask the right questions, but fundamentally ask why things happen the way they do. The second one is have grit. When we talk about resilience, I think grit's another word for resilience. Things happen, right? Personal things happen. Of course, industry things happen, societal things happen. The people who have the curiosity and the grit to go through it are the ones that will succeed. So I would say those are probably the two things I would say from a personal advice. But enjoy it. It's an amazing industry. I think there are amazing opportunities. And if you do, I think there's sky's the limit.
Rick, thank you very much.
Thank you, Ken. Appreciate it.
Absolutely. All right, so everybody sit tight. We're going to do a flip of the stage and bring the next panel up, which will dive into oil.
Okay. So we'll start the next session, which is on the supply chains of oil markets. We'll go into gas markets as well. I'm Skip York. I'm a non-resident fellow here at the Baker Institute. I'm joined by Avi Rajadran, who's with Energy Intelligence and also a fellow at the Baker Institute with me. Adam Zaminsky, who's on the board of directors at CAPSARC.
I'm an advisor.
And an advisor to CAPSARC. And then at the end is Rob Schwer, who is who's a chief economist at Chevron, right? So, okay, so this theme of this conference or this summit is around energy resilience, and so I thought we would just kind of start this conversation with a discussion about what do you think the current state of resilience is in oil and gas markets globally, and then the other part of it is how has that evolved over the last 20 to 25 years. So I guess we'll just start with you and work our way down the road.
Sure. Yeah. Thanks, Skip. I'll start with just a couple of quick points. I mean, I would say on oil, the market has proven to be pretty resilient for a number of years. Ken kicked off the conference, just kind of referring to just the fungibility of supply, just the efficiency of the market to address any issues around outages, like we had some major ones, for example, at Upcake. Sanctions and other mechanisms to try to adjust flows. The oil market's been able to navigate through all of this. It's been pretty resilient. Now we're kind of entering a period where we're kind of pushing more and more supply led by OPEC Plus into the market. So that also kind of improves liquidity options for buyers. So the oil market's been pretty resilient in my view. And one of my jobs is oil price forecasting. And every so often over the last couple of years, we've been talking about geopolitical risk premium and supply outage concerns. And I've always sort of said after learning the lessons of 2022, the beginning of or not the beginning, but the first sort of 6 months of the Russia-Ukraine conflict, that the market's been able to manage through pretty much everything that's been thrown at it, and so I think any risk premium should be pretty close to zero, because the market is very resilient. The supply chains are resilient, and the supply chains for the oil markets range from pipelines to ships to ports to everything in between. So I think the oil market has proven to be pretty efficient. I think looking ahead, we can talk about in other questions. We'll have to wonder whether there's enough supply, depending on where demand goes. So I think that's a separate topic. And I think it's sort of similar for the gas market as well. A pretty resilient market.
Let me first start, Skip, by saying thank you to the Baker Institute. And I want you to look on the up here it says Baker Institute. On the front of the podium, it says the Baker Institute of Public Policy. And you have no idea, if you haven't been involved in trying to run a think tank, and I've done that twice, or be involved in starting a school of public policy, how difficult it is, and how volatile it can be at different times. And events like this are not easy to plan and pull off. And the Baker Institute of Public Policy has done a great job. So thank you, Skip. One of the advantages of having done this for a while is, I think maybe in Texas terms, this ain't my first rodeo. And we heard earlier that supply chain problems really started with COVID and maybe the Ukraine in 2022. My first supply chain issue was in 1973-74 with the OPEC embargo, and then there was another supply interruption in 1979-1980. In 2004, 2008, just to kind of skip ahead a little bit, we had an enormous demand increase in China, and supply was not able to keep up, right? So there was a supply chain issue. We just didn't have enough of it. There was no war. There was no difficulty in the Middle East. When we have demand crises that lead to supply issues too. There was the OPEC crisis of 1986. There was the two actually really interesting non-existent supply problems. The attack on Abcake, which was mentioned yesterday in 2019. And I'd actually add the bombing of the nuclear facilities in Iran in 2025 that I think many people might have expected to have turned into a supply chain issue, but didn't. The one that really sticks with me is Hurricane Sandy in 2012. And I was involved in trying to figure out how to get gasoline into New York and New Jersey, and to alleviate that issue. So we have had a lot of supply chain issues, some of them solved better than others. Eventually it seems to me that they all get supplied. So as, just in ending, Skip, on that particular topic, let me just say that looking forward, I would say the Russia-Ukraine supply issues of 2026 is something that you should keep in mind. And maybe the Venezuela and Yemen supply chain issues of 2027 is something that you might want to think about.
Okay, Rob?
Yeah, so I started my career with Chevron about 27 years ago, right? And when we first started doing modeling, a lot of the events Adam cites, were catastrophic and, would result in oil prices spiking. And I think what we've learned over the past few years, right, is that the supply chain's proven to be more resilient. So I started thinking about, what are the causes of that? I think one, on the supply side, you've got more diversity of suppliers into the market today with U.S. tight oil, Brazil, what have you, right? So I think diversity of supply has helped. I think maybe one of the underestimated pieces of it is really the rise of China and the non-OECD in the markets. So that's added demand, but that's also added storage. So if you look at global storage capacity, it's grown 80, 100% over the last 20, 25 years, depending on whose numbers you use. Refining capacities increased 10, 15% over that period. Tanker fleets grown, 80% or so, depending on whose numbers you use. All that adds kind of resiliency into that global system. And I think that's just made the overall market more adaptable to these shifts. And, as I look back at how we adapted to Russia, Ukraine and some of the events, internally, there's always a period of adjustment, but that period of adjustment has become shorter over time. I'd say the other big driver, as we think about it, is just the availability, quality, and ability to process data and information in real time has vastly improved with technology. And I think that helps companies like ourselves really adapt to these global events in a more meaningful way than we could, say, 20, 25 years ago.
I think that's a great point. I want to kind of let's unpack this and look at the segments a little bit. Is that we talked about that across the chain there's a lot of resiliency, but are there choke points or pinch points? Adam, you mentioned Russia, Ukraine. I'm going to go to one of our questions that's already shown up already, and that here's the hypothetical, right? If you manage to stop virtually all Russian oil from moving out of the country, whether it's products or crudes, how does the how well can the global supply chain react to that? And let's just broaden that to there. Are there pinch points that we ought to be concerned about, despite the fact that resiliency is improving? Are there some worry points that keep you guys up at night?
So I can start, maybe from a Chevron perspective, as we look at it. Obviously, as events happen, we've got to adapt and optimize. Around that, maybe the two kind of points of vulnerability as we've looked at events of the last couple of years. First is within the crude market, we think of crude as largely fungible, and I think while that's true, not all crude is created equal. And I think if we think back to kind of April and the height of potential sanctions risks and tariff risk for heavy crude producers and heavy crude refiners, there were some particular risks where heavy crude is in short supply, and options were really taken off the table, and some really significant decisions may have had to been made. Fortunately, those risks didn't prevail. And so I'd say kind of within the refining system and upstream system, there are pinch points around potential crude types and heavy crude specifically. The other one I'd reference is in kind of natural gas liquids. So if you look at natural gas liquids, you're both concentrated in terms of number of suppliers as well as demand centers. And as we got into kind of trade and tariff uncertainty, particularly the U.S.-China relationship, we potentially had risk of losing natural gas liquid exports to China, which is a pretty major market, and because of the concentration of demand, difficult thing to optimize. And as an upstream producer, a lot of comes out of the wellhead: oil, natural gas liquids. All those things have to flow to make the economics work. And I think we were getting into a scenario where if we did lose customer bases, it could back up in the system, and that became a real risk.
Rob mentioned earlier some of the physical changes that have taken place in supply chains to make them more robust. One of the other things that I think needs to be said, always worth saying, is sometimes you have good government policy and sometimes you have bad government policy. And in the 1973, 74, and 79, 80 crises, we had a lot of bad government policy. We had price controls, and we had efforts to try to allocate supply around using baseline cases and other things rather than letting the markets actually solve the problem. We're getting better at allowing the markets to solve the problem. One of the other things that exists now is, and I'd call it a good government policy. I've always believed that this was something really useful. The Strategic Petroleum Reserve that the United States has and the strategic reserves that are held in Europe, Japan, and elsewhere are really useful in times of crisis. In fact, during Hurricane Sandy, it was gasoline stocks in Europe that were sent to the East Coast of the United States that actually helped solve that problem. So that's one other thing to keep in mind. What are the policies that we've designed to deal with these things? And I think getting good public policies in place is a very important part of the equation.
And I'll just briefly add to actually something that Adam was mentioning earlier, or two things that Adam was mentioning earlier. The first is keep thinking about the Strait of Hormuz, just because of just the sheer volume of both oil and products that flow through there. And I think again we've had multiple questions around potential closures over the last year or two. But again, I think maybe that Iran nuclear risk is another one that we need to keep an eye on. I don't, we've kind of forgotten about it for now, but again, this is maybe a 26, 27 type of issue, maybe even 28, but that's another one to keep an eye on. And I think with the Strait of Hormuz, it's not just necessarily with the volume that's flowing through there. For the oil market in particular, we always talk about spare capacity. If you have some kind of an issue at the Strait of Hormuz, your spare capacity suddenly goes to zero, because effectively all of that just can't move. Whatever OPEC, core OPEC has in reserve. So I think that's one. The second, I think, is maybe looking a little bit more medium to long term. Is right now, the oil market has more than enough supply, diversity of supply. But I'm kind of thinking about maybe 3 to 5 years, or 5 to 10 years down the road. Whether simply we are investing enough for a world where the consensus around demand and peaking or plateauing is just wrong. And I already see that consensus shifting, right? The peak is getting pushed a little bit higher, a little bit farther to the right. But even still, I don't necessarily think we're investing enough for that 5 to 7 year time frame. We're fine this year, next year, the next couple of years, but if sudden, and the other thing that we're seeing is we're constantly seeing the base level of demand right now, last year, getting pushed higher and higher, right? And we're seeing this even at our own numbers and at Energy Intelligence, for example, like just that base level looks like it's suddenly like a lot more than what we thought. And so in a world where, you're pushing towards, compared to this year, 103, 104 million barrels a day of demand, if you're headed to 110 in, 5 years, 7 years, whatever the time frame may be, I think you're going to have a choke point on supply. And as Adam referenced earlier, suddenly you have, if you have an India or a group of countries turn into the next China in terms of driving demand growth over the next 5 to 10 years, you're going to end up with a supply problem, and you're going to have, and then prices will signal the need for more investment. But I think that's something that I'm keeping an eye out for.
So I think I want to come back to this, is that if you're concerned about stranding assets, if you're concerned about peaking supply, that there is, for lack of a better term, there's a bit of a moral hazard among oil companies, because if I don't invest and I'm wrong, the value of the assets just improve because oil prices end up being higher. So there is a bit on the sort of, there's this asymmetrical risk in that it's better for me to not invest and be wrong than to invest and be wrong, right? Because I can avoid that stranded capital, which leads me to this kind of broadly to this uncertainty. And Rob, I'm going to prep you. I'm coming to you first on this one, because which one, if we look at the current policy environment, like specifically the U.S. trade policy, which is kind of where, is it the actual tariffs that are the issue, or is it the uncertainty around the tariffs? That which one has the bigger impact on decision making and running the business? And then,
yeah, so I'd say in our case, it's probably more of the uncertainty that factors in, and as Mike alluded to, they're looking at a number of scenarios around what does that look like in the future. We're doing similar things, on our end, similar to BP. And I think the other piece of it is we have to appreciate, we're largely in, globally connected businesses, right? And so there's a focus on, well, what is the U.S. doing? Maybe not as much focus on what are other nations doing in response. And that's where we saw, for particularly some of our supply chains, potential risks is, how do other nations respond? How does that impact our supply chain and ability to supply customers? And what risks and or opportunities that present as we look to re-optimize value chains as the new rules of the game get redefined. There were some specific tariff-related things, particularly for our refining system, around feedstock and crude supply that we had to deal with, potentially costs, and how do we mitigate that. Similar, with offshore supply chains and very specialized things that we import with very few suppliers. So there were some risks, but again, we look at it similar to Shell, very global footprint. How do we leverage the partners to kind of mitigate those risks and reduce the costs? So I'd say for us, it was really that uncertainty, and then how does the rest of the world respond, that really impacted our decision making more than the tariffs specifically.
Skip, I want to come back to your comment about if you don't invest, then maybe you're going to be better off if demand continues because prices could be higher. I'd be really careful about that if I was advising a corporation. Wall Street generally tends to pay for growth and prospects of growth. And so you might look like you're making a low-cost decision by not investing and discover that you are a takeover target from somebody that has grown and has more capital and buys you out. And so if your goal is to get bought out, then maybe that would be a good decision, but I'd be really careful. So and I want to come back, Michael and I talked about this briefly before I came up here. You mentioned the different scenarios for what growth, and Abi said he was concerned that we might not invest enough if demand continues to go, and we certainly heard that yesterday from Scott. And so let's just talk about that for a second. The BP current trajectory case for oil had demand down to almost 80 million barrels a day from the over 100 million barrels a day now in 2050. And there are a lot of other scenarios that say with current policies, and this is kind of like a current policies, but we know policies are going to change, but you start with that base case, that you could be at the 110 million barrel a day level, maybe even 114 million barrels a day. One of the real questions, and I agree with, and this actually bothered me. I was at another university up in New York a few weeks ago, and I said, if somebody wanted to write a really interesting student paper, it would be, what are the pluses and minuses? What are the pros and cons associated with whether India will be able to replace China? And all of the what I would call the more experienced people in the room said, no, it's never going to happen. And I was just kind of going, well, I don't know. I think it's like a possibility that I wouldn't want to dismiss. And if I were a student, I'd write a paper on that and just say, here are the reasons why it might happen, here are the reasons why it might not happen, and just see how they balance out. But just don't start with the assumption. And I would say, be curious. I like that. Be a little gritty. Like take a non-conventional view of what scenarios might play out. And so, what does the world look like if we go to 80 million barrels a day? But what would it look like if we're really headed for 115, instead of 80? And be very careful in how you organize yourself to respond to those. Think about it. And so one of the other things that I think, and I'll talk about it later, is flexibility. Build in flexibility. Be able to respond in some way to either of those scenarios as they begin to play out.
And I would just briefly add, I think companies, corporate strategies generally plan for maybe like a 5 to 7 year window, because once you kind of get beyond that, there's just you can just pull a couple levers and you end up with a pretty disparate range of outcomes for demand and supply. So so I think trying to triangulate just the next 5 years, let's say, is probably kind of the main priority. And even in that 5 year period, we have enough kind of uncertainties related to trade, tariffs, and just macroeconomic outlooks to kind of think about and worry about. I think there are some elements where you have more visibility, like Michael talked about, like on the road transport segment, like what China is doing, like that's impactful and is going to move the needle. But at the same time, you're trying to figure out just macro economic picture, what those look like. So I think trying to nail that 5 to maybe 7 year window, and then you just kind of keep moving the goalpost as go along. In 5 years we'll already be at 2030. So
Abi, I want to add to that comment. I actually don't worry about stranded assets. I mean, the whole argument of stranded assets, and that argument was was being made very forcefully when people were saying that, there wouldn't be any oil demand. And if you own oil assets, you're going to have stranded assets. And what I would say is discounted cash flow, the value of future cash flows, beyond ABI's 5 to 7 year period starts to sink very, very quickly. And so to worry about stranded assets in the year 2040 or 2050 is like crazy from the standpoint of running a company.
Well, there's also the capital cost is up front, right? So once you get to about year 3, you're at operating costs, which is a completely different cost basis than the installation cost. And so all of a sudden you don't need $100 oil to keep running an asset. You need $100 oil to justify the asset, or $70 or $80 oil. It reminds me of my time when I was at BHP. We did these long-term views, and we were trying to take a look at. We came up with a list of, here's a list of reasons why oil could be $50 a barrel, and here's a list of reasons why oil could be $100 a barrel. And our CFO said, so what you're telling me is that nothing works at 50, everything works at 100, so we should either do nothing or everything. And he said, thanks a lot.
So somebody should have told him, plan on 75 and be flexible.
And be flexible. I think that's flexibility would have been the answer. And that kind of leads me to what lessons can other energy systems take away from the petroleum system? We've talked a lot about the resilience, and I'll sort of lead the witness by saying we've talked about the midstream a lot more in this last 15 minutes than I think a lot of people would have anticipated. And maybe is that the takeaway, that you can get demand right and you can get supply right, but if you can't get supply to demand, you've got a problem. Is that kind of a fair lesson learned? What other lessons can the petroleum share with other energy systems about how to be resilient?
Yeah, I mean, so I think, certainly in our case, like looking at the infrastructure and making sure you're able to supply the customer as you look to grow. If you look at kind of our story in the Permian, in the early days, we started to really grow that production and didn't maybe necessarily have the takeaway capacity to get it to the customer, and that results in a penalty to economics and having to take discounts or not getting the molecules to flow. So I think, looking at, resiliency of infrastructure and making sure you can connect suppliers with customers, whether you're in a very local market or in a global market, I think is really key. I think, to me, the other piece of it is, our business has expanded into, lower carbon energies, potentially power. With this AI story here in the US is really understanding those supply chains and looking at those systems in an integrated way and trying to understand where are the potential bottlenecks and how do you potentially mitigate those risks. So like the big thing now is gas turbines. Do we have enough of them to meet the projected power demand, right? And so you've got to make some decisions, and how do you source supply chains, and then that impacts kind of the growth profile and how you invest into that. So I think being mindful of looking at those overall supply chains, how they're integrated, and then understanding how you mitigate the risks as you look to invest in certain sectors has become important, particularly as we try to grow and scale new businesses.
I'll be a little more direct since I don't live in California. Having a very unique specification for gasoline, as California does, is like a real problem if there's a supply chain issue. And I'm more inclined to believe in standards, and standards that apply kind of to everybody. And so we do have gasoline problems from time to time. We've seen that in California. We've also seen that in the aftermath of hurricanes. So here's another thing too, is that it probably makes a lot of sense to have some backup generation capacity at gasoline stations. If gasoline stations lose their power, if the only way they can get electricity is off the grid, that's like a problem if you're trying to recover from a hurricane. And Florida has seen that from time to time, and there are some of the larger stations in Florida have backup generation capability, so that's something that, again, could be useful. Heating oil, another, you were talking about downstream issues, and heating oil is always an issue in the Northeast. You have really cold weather, and the ability to move barges around because the rivers freeze up or the harbors are difficult to move things in is an issue. And so I think that when you think of supply chain issues, it shouldn't just always be OPEC or some other global issue. It can be narrower than that, and downstream can be just as difficult as others. And there's one other that I remember. Again, cold weather, propane demand in the Midwest goes way up, and if you don't have the right amount of propane in the Midwest, not only do you create heating problems for people in homes, but if it's depending on the time of year, if you can't dry your crops with propane, which is often done, that's a problem. So these things can kind of back up and they become difficult to do. So, back to, I like that word flexibility. Is be flexible, like build some flexibility into the system that allows you to find ways to move things back and forth where they're needed.
And I would just add, I think diversification of supply, as Rob mentioned earlier, is important because we have that now with oil markets, and especially for new energy systems and supply chains, we don't necessarily have it as depending on what piece of it you're talking about. And related to that, there was a presentation yesterday where we were talking about, okay, whatever we're talking about with energy, you either drill it or you mine it, right? And in old energy, you're drilling, and then you're refining or you're cracking to create chemicals and downstream derivatives and whatnot. And in new energy, you're mining and then you're processing it. And there is, there are major concerns about the concentration of that processing capacity, and China's domination of it. And it kind of goes against security, diversification, security of supply. So that's a big thing that kind of needs to be addressed and then ironed out as, however, we make the transition, we go along that path.
So Skip, let me just add that Abhi reminded me that to shift again to other areas is permitting is really an issue. And Washington has tried a couple of times to come up with better permitting legislation, and it's like on the table again. Really useful to address that. We're relatively good at building natural gas pipelines generally. Texas is working on that now. But just as an example, you can't get Pennsylvania shale gas up to Boston where they need it because New York State won't allow the pipeline to be built. And that's not very smart from a national standpoint. And we know that electricity demand for data centers is going to dramatically increase. And we have a electric grid that was designed for I'm not going to say a previous generation because it might be the generation before that. That grid has to be, built up. There's a huge number of data centers in Northern Virginia. There's electricity available in Pennsylvania, and you can't get Maryland to allow them to build transmission lines through the state of Maryland to get it down to Virginia. So this is, again, we need some sort of good federal policy to bring all 51 states, the District of Columbia, into a
you're not
better
counting
aligned
Alberta.
system. Huh?
You're not counting Alberta as the 51st state.
No,
I thought there was breaking news.
I was up in Alberta and Yukon a couple of months ago, and the people asked me where I was from, and I said, I'm from the lower 48 provinces. And they actually responded positively to that.
So one of the things I want to do is I want to go to a question that came up that, Adam, when you mentioned that you were concerned about sort of different maybe supply pinches coming in, one of them you mentioned was Venezuela in 2027. And it's kind of like the question from the audience is, can you expand on what is the concern and why is it 2027? What are you thinking there?
Honestly, that was kind of a random year pick. What I would say is that let's stick with Avi's idea that, then maybe the next 5 years we can kind of see what might be happening. And it looks to me like oil demand is still going up in those 5 years. We can debate about 2040 and 2050. And we're going to need supply from a lot of different places. Venezuela has oil, but it has a regime that's not very friendly to capital investment, and the United States is currently, doing some relatively unique things in Venezuela. So I don't know where that's going, right? Like that's like a really interesting issue, and it's just a way of saying that we might want to look for ways to encourage that diversification of supply, whether it's oil or natural gas or electricity, and not narrow the opportunities but broaden them.
Maybe the one point, as an operator there, the point I'd make too is just, I think the whole kind of demand element is underappreciated in the debate. So there's like the whole focus on what's happening on the production side, but it's really critical that you have customers, right? And so refineries in the Gulf Coast, ours included, work really well on Venezuelan oil. And if you take that option away from the US refiners, that volume has to flow elsewhere. There's frankly not a lot of other refineries in the world that can process that type of oil. And so your customer base is pretty narrow. And so that's an example of an issue that the system may struggle to optimize because you don't have, enough demand centers to really re-optimize that volume of oil because of the uniqueness and how the system was designed. And so that's a little bit of a vulnerability. And I think that's maybe one area that's lost in some of the broader debate on what do we do with Venezuela. And, frankly, it benefits U.S. consumers to have Venezuelan oil flowing here in terms of helping our system optimize and meet the product consumer here.
Anything?
No, nothing. To add,
Okay.
yeah.
So we missed the boat on heavy Alberta crude coming to Texas too. I think that's another pipeline we didn't build. And it would have made much more sense to have heavy Alberta crude being refined in Texas and export the light sweet crudes that were being produced from the shale oils. And it's like, so why are, we're kind of optimizing on the wrong things from time to time. And if you're a modeler, it's very critical that you choose the right variables to optimize on.
So now I want to, you brought up shale, and we're going to go to OPEC in a second, but the shale question is, we heard earlier that there's maybe it's a growing consensus view that shale is plateauing. Maybe there's still growth on there, but the big growth days are over. Shale is sort of a maturing, and it's plateauing. And shale came on and surprised the industry. So is there another shale surprise on the downside? Is it not a plateau? Or what's the next other surprise? Is there another surprise out there, another resource theme out there that we don't see here today that all of a sudden we could be surprised 5 or 6 years from now, all of a sudden we see this tremendous resource explode? So kind of, I don't know who wants to go first on.
Sure. I mean, I can kind of take that. So I think, there is a building narrative and consensus around, as you look particularly beyond the next 2 years around kind of the constructive outlook for oil markets based on kind of the supply declines that were shown by BP and others, right, relative to kind of the demand profile and the need for investment. And so that's sort of starting to, bear the narrative of supply scarcity, kind of like we had back in 2007, 2008 with China coming in the system, recognizing current dynamics are different. I guess the one watch point is, somebody who's tried to kind of model this is we always kind of underestimate the role of technology in all these things, and some of these supply gaps never seem to emerge. And I think sometimes the thing we discount is the oil and gas industry is an industry of innovators. and we really innovate to survive. And so when you look at, the role of shale, agree that the profile is going to change. We won't get the same growth, but companies like ourselves, Exxon, others are trying to innovate to, boost recovery factors there, and that could potentially extend the runway. So that's a technology wild card. I think, there's new frontiers. We're trying to lower the cost of deep water through application of technology, right? And so there could be resource available that comes to bear in that window of time. And then with AI, I think we're trying to leverage that. And how do you accelerate kind of time to market with projects from when you discover a resource? And I think AI is starting to prove that we can maybe do that a little bit quicker through the analytics and improved decision making. And so those are just examples, and I just sort of caution, let's not discount the role of technology when we look at future supply gaps and start stacking projects and say we don't have enough supply. Because I think it's an important, when you look at how the industry has really survived through its history, it's through innovation.
We've had 2 episodes, maybe we're still in the second one, of peak something. We had the idea of peak supply. That was back in the late 1990s, early part of the 2000s. And there was even a book written by a nice Texas guy, but he got it wrong. He called it Twilight in the Desert. And so it turns out the twilight in the desert might have been just dawn instead of sunset. But the second peak thing and that's what we were talking about earlier, is demand for oil peaking or not? There were people that said, yeah, demand is now peaking. And so Rob said, we keep underestimating technology. The whole idea behind peak supply of oil was 2 things. One, that technology wasn't going to change, and that, and believe it or not, that prices didn't matter. I mean, that was the thesis behind the Hubbert curve. That's what they call it, the Hubbert curve. And that's like, maybe in some geologic world, I mean, you could say, this is a true story. I thought, so how do we know, for peak oil, to understand peak oil, you have to know how much oil there is in the ground. So I thought, how are we going to figure that out? So I thought, well, God knows how much oil is in the ground, and has God talked about this? So I got the Bible out and I looked, and I couldn't find anything about oil in the Bible. and I was with a group from the Middle East, and I said, I also looked in the Quran, and I couldn't find anything in the Quran. And a guy started pounding the table, and I thought, whoa, I wonder if I've said something like offensive. And he said, Adam, I've read the Quran, I've memorized the Quran. You're right. There's nothing in the Quran about how much oil God put. So God knows how much oil there is, and we're all changing prices and technology to discover how to do it. And the whole idea that people were trying to say, well, there was conventional oil and unconventional oil, and that's kind of, so the unconventional oil, shale, is now conventional, right? I mean, it's like that. Those terms were wrong from the get-go. All right, I got too fired up on that one. I apologize.
No books to refer for me, but I'll just briefly add. No, I mean, I think on shale, I think the flexibility of shale is an important factor, and again, I think depending on where demand goes, right? If demand is like kind of growing but slowing down and plateauing, then the outlook for a slow growing, plateauing shale supply market, works. But if demand starts to decline for at some point, then shale can be flexible to respond, right? I mean, it already has heavy or large decline rates, and so you just kind of toggle down the capital to adjust accordingly. And I think and I think the alternate scenario where demand is rising faster than expected, I think again, your prices will lead, to the marginal, shale working, and you can kind of, throttle some more growth out of it. And just to put some numbers around that, I mean, I don't think you're going to have material growth from U.S. shale unless oil prices are consistently in the 70s. I think 60s is basically a kind of a maintenance to modest growth for large companies type of price range. And for the entire shale base to grow, you need 70s, and you need 70s to stick around, not just pop up for a couple of days and then disappear. So I think that's the price level that you need. And I think, yeah, and again, the marginal cost of growing shale is in the 70s, and will continue to grind higher, as the resource is not depleted, but matures, and your highest tier, best inventory is depleted. So I mean, I think again, if demand continues to grow, then you'll have a shift up in oil prices into the 70s, potentially into the 80s. Then you can reactivate shale to respond accordingly. So that's I think that flexibility of shale is an important thing to keep in mind.
So I want to kind of close this up by then. We haven't talked about OPEC, and how does OPEC think their way through this? And I'm kind of curious just to open up to what your thoughts are about, given the uncertainties around technology and resource themes and demand and 5 to 7 year outlooks, kind of how does OPEC navigate their way through this? If their objective is really it sounds like I'll say their objective is twofold. One is market share. They want to be a meaningful part of the market. And two is price stability at a price level that works for them domestically. But price stability and that share. How do they think their way through being a resilient member, group of member countries in a market where there is just we're just layering uncertainties on top of uncertainties. Some of them are positive and some of them are negative, but I don't know I promised Adam we'd come to Adam last. But who wants to, Avi, you want to kind of talk about where you think OPEC might be, what they might be thinking over the 5 years, and do they have a longer window than that?
Sure. I mean, with OPEC, I'll just kind of highlight a couple of things. First, yeah, I mean, we've definitely shifted from a mindset of, maybe, holding back supply for higher prices, and that was easy to do, after 2022 with Russia, Ukraine, leading into 2023 with higher prices maintained, and then into 2024 as well. But then non-OPEC plus supply responded, and you had some maybe a little bit of the kind of the pent-up demand growth coming out of COVID, faded out, right, into like a more normal growth environment. So we've definitely seen the shift in this regime from maybe withholding supply for a higher price to taking back some share, responding to some geopolitical factors, potentially responding to a new administration in Washington, all of these factors, and allowing for OPEC to still largely maintain cohesion, but at a lower price range, right? I think before it was 75 to 80 was kind of that price range where they were feeling good, and now they seem to be okay with 65 to 70, even though there are domestic financial pressures in different ways that pop up. So I think that's the first thing. I think the second thing is they're trying to think about spare capacity and their own investment and their own thinking about putting money back into the drill bit over the 5 to 10 year horizon. On our numbers, OPEC plus spare capacity right now is about 4 million barrels a day. They're always going to want to keep maybe, and Adam can correct me if I'm wrong, maybe like 1.5, 2 million, of true spare capacity, in case of supply shocks, right? In case you have, outages or disruptions or conflicts that pop up. So they have this buffer of maybe 2 million barrels a day more of supply that they can bring back to the market, and I think they're going to want to do that. That capacity is not a fixed number; it's also going to be increasing. The UAE and maybe one or two other members will be increasing capacity over the coming years. So that's not a moving. That's not the fixed number. But they do want to bring the supply back. They want to continue to kind of take share over the next couple of years as demand goes. As demand grows. And then the third thing I'd highlight is, I think, their view, again, looking longer term is, obviously the OPEC internal view is that demand is going to grow for the next 10 to 15 years, maybe plateau only around 2040, and that's at a much higher level than what many think. But either which way, their view is, look, like we'll take the share now, and we'll, if it results in slightly lower prices, it'll result in less investment, less non-OPEC plus supply growth, and if demand does grow, great, prices will naturally rise, and we'll have that more, that increased share. We'll be in good shape either way. And the flip side is, if demand is going to plateau, is going to decline in the 2030s or leading up to 2040, then from their perspective, they're not sitting with stranded assets, right? They're using as much of the capacity as they can. So I think that's kind of their thought process is it makes sense to do this now because regardless of what happens 5 to 10 years from now, it's the right move, and we'll be in a relatively better spot either way. So that's kind of how I'm thinking about OPEC plus thought process, strategy, and kind of longer term thinking. Rob, I don't know.
Yeah, maybe the only point I'd build on there. So if you look at what we're seeing in terms of how their thinking has evolved over the last 10 years with demand uncertainty, heightened geopolitical fragmentation is really a focus on demand security and securing their role. And we've seen, definitely a concerted effort to, establish partnerships with key consumers, expand kind of their global footprints across value chains, both in oil and natural gas. And so they're increasingly emerging, national oil companies, particularly in the Middle East, are increasingly emerging as competitors as we look at, how we deploy capital. And that's been a concerted shift over the last 10 years. And I think that's really coming from a place of, with these future uncertainties, how do we carve out and ensure kind of our role in the future of that energy system? And I think that's one way their thinking has evolved.
Right, so I have to preface any comments I make about OPEC with a little story. Most of my career was spent on Wall Street, and when I got to the Energy Information Administration, I got a question from the audience one time, what's the difference between Wall Street and working for the federal government? I said, well, on Wall Street, nobody ever called me sir, and I used to get that all the time as the head of the Energy Information Administration. And I said, but what I realized is working for the government, I'm flying coach everywhere. And then I said, and the other thing that I felt when I was at the Energy Information Administration is I was one unfortunate remark away from returning to the private sector. So OPEC. So I'm speaking on my own behalf, I'm not speaking as an advisor to CAPSARC, and I'm not speaking about Saudi or anybody else's energy policy, but OPEC generally has followed 3 principles in how they address the markets. First principle is that the market actually needs to be managed, right? Like, hey, the Texas Railroad Commission, right? The market, this is in fact, the last time I was here at the Baker Institute, I should have brought my props. I had a red yardstick and a blue yardstick, and they were supply and demand curves. And I said, everybody, the textbooks tell you that the supply and demand curves are these shallow things that a little change in supply only leads to a little change in price, or vice versa. Oil looks like this. It's like a small change in supply leads to big price changes. And so everybody worries, about this, and somebody needs to be in managing that market to make sure that you can balance the markets when you have these interruptions that in supply chains or something that happens on the demand side. It could also be a supply chain kind of issue. So the first principle is somebody's got to manage the market. So there is actually a reason for OPEC. I'm going to come back to an academic thing on that. The second thing is you need flexibility. Like you need to be able to address different things at different times and how you do it. And the third principle that they've tried to stick with is it really has to be a response that's collective, right? Like everybody actually, when things get tough, you need everybody, not just one or two countries, to actually manage the market. And that can involve both, supply removal or supply additions, right? So working together to add supply to the market if you have shortages. So those three principles are really important to OPEC. And so I want to come back to that first thing that I said, the market needs to be managed. There was a really interesting peer-reviewed academic paper written at CAPSARC by Axel Peru, who's French national, working at CAPSARC as the head of knowledge and analysis, the head of research. And another guy who's a Texan, by the way, Jim Smith from SMU. And Axel and Jim looked at OPEC, and they did a counterfactual. What if OPEC didn't exist over the period from the 2000 to, now it's, updated into the 2020s. And what they said was, OPEC doesn't actually set the price, but they can shave off the peaks and the valleys, right? They can kind of compress the volatility. So now a lot of economists are going to tell you that there is something called excess volatility. You can have too much volatility, and it's bad. I mean, it reduces economic activity. Companies can't plan. If oil goes to 150, it's like they didn't invest enough. And if it goes to 20, they invested too much, right? So if somebody manages that market, and what Jim and Axel said is that OPEC's market management over roughly the last 20 years have actually added something like $200 billion to global GDP. It's a relatively small number. It's like 0.2% on GDP. So GDP, is 3% instead of 2.8%, something, like along those lines. But that's measurable. And it's important. And what we learned yesterday is GDP and oil energy production creates happiness. And I like that. So I think OPEC actually is helping to create happiness around the world. And so did the Texas Railroad Commission.
Okay, so final question, lightning round. Not asking for a forecast, but what are two things? Maybe one to the positive, one to the negative. Potential surprises if you look out over, let's call it a 7 to 10 year horizon. Add a little bit longer than the planning horizon. What are a couple of things that could surprise us? I don't want to say shocks, but could surprise us. If we look out at 2035, if we got this panel back together in 2035, we'd say, I told you this could have happened, and it did. So one upside, one downside, or just one?
I can kick it up. Yeah, I mean, on the, I think on the demand side, alluded to it earlier too. I think demand, especially because consensus, I think is kind of triangulated around a peak to plateau somewhere between 2030 and 2035, and I think a surprise could be to the upside, and maybe considerably. And I think the second thing I would add is I think another surprise. I think there will be another Guyana. I think it's not really talked about that much. These like frontier exploration type opportunities, and again, it may not be the same sheer volume of a Guyana or the pace at which it's been able to ramp up and will continue to ramp up. But I think there'll be more kind of supply side opportunities out there. It may be Namibia, it may be in Angola, it may be Suriname or something like that. And also, I mean, I think don't underestimate the ability to kind of squeeze out more supply out of some pretty established large suppliers, like in Iraq, for example. I think those could also be surprises.
So a surprise, positive, negative. Maybe there's a little bit of both in here, but we talked a lot yesterday about climate and what role fossil fuels would play, and I actually continue to believe that climate is an issue that's going to be important as we move forward, and the industry ought to be able to respond to that just as they respond to anything else. But there could be something very positive in here. Carbon is not the enemy. Emissions are the enemy, whether it's emissions of sulfur dioxides or nitrogen oxides or now carbon dioxide. If we have too much carbon dioxide, maybe there's some way to fix that. And maybe the technology that we're going to see, low carbon solutions, we had ExxonMobil talking about that yesterday. Rob mentioned some of the things that Chevron is doing. The ability of the industry to innovate and find ways to actually turn carbon dioxide into something that we want, that we can turn into a useful product, is something that I think ought not to be discounted. And I think it's going to be particularly important if oil demand keeps going up and coal demand. Actually, again, we've seen this, is we are using more of the cleaner fuels, like natural gas, for example, and we're getting more renewables now, lower carbon fuels. But the total amount of fuel being used keeps going up. We're using more coal now worldwide than we have ever, right? Even though its percentage terms has gone down in the fuel mix, we're still using that. And if carbon dioxide emissions, and coal has emissions issues, not just carbon dioxide, if we need to address those in some way, and we'll do that, and maybe we're going to find the technology to do it. So I think the surprise is going to be that we're going to actually get the cost of carbon storage down to $50 a ton instead of, it was at $500 at one time, and now it might be $300 or $250. And when it gets to $50 a ton, we're just going to do it, and you're not even going to notice it in the cost of gasoline. I mean, it's like, so that would be a change that would be enormous. It would allow us to continue to use that high density gift that God gave us and still not screw up the environment. So, and I'm just going to mention one other thing that's going to surprise everybody, I said one word, AI. Something's going to happen. Artificial intelligence. Something's going to happen, and it could be good or it could be bad. One of the speakers yesterday said, I'm the eternal optimist, and I kind of went, yeah, I feel that way too. I think we'll figure it out, and that's one of the ways that you can make shale, keep playing, get the costs down, find ways to use artificial intelligence to identify the reservoirs and do your fracking at a lower cost and find safe places to sequester all that carbon dioxide that we're going to capture with direct air capture and clean up the atmosphere, and we're all going to have a happier life and wealthier.
So maybe I'll go with one, and it's really around, are we looking in the right spot for risks, right? And with electrification, I think there's a huge focus on what's happened in China, US, Europe. But in the kind of the global fragmented market, China produces a lot of EVs. At some point, they won't be able to consume them themselves and need to export them to other markets. And if you look at our forecasts and the forecasts of many, we depend on non-OECD markets, global south, for a lot of the growth in oil demand as we look out over the next decade. And what we're starting to see is Chinese EVs ending up in a lot of those markets. And I think one of the things we're trying to understand is that potentially a risk as we think about future oil demand, and what does the profile look like if we're really depending on those markets, and maybe they're electrifying at a faster rate. So that's, early warning signs, signposting we're watching as we think about strategy and risks around future of energy.
Okay, I'm going to close with an AI story that really quick. That I was a year ago. I heard Elon Musk at a Fireside Chat, and he was asked a question of, if AI becomes aware, are you afraid of the Terminator moment? And Elon Musk said, AI will become aware. It's not an if. And when it becomes aware, it'll realize the world is more interesting with human beings in it than absent. And so he said there won't be a Terminator moment, because then AI will get bored. And AI is all about being inquisitive. The other thing he then added, and I'm kind of curious if people are putting this in their outlooks, is he said, I think that the electricity demand being attributed to AI centers, data centers, is probably being overestimated. Because if AI is at risk of not having enough energy to do what AI wants to do, AI will figure out a way to become more electricity efficient. So he said, I think you're overestimating. He said, we've got all these hockey sticks on electricity demand attributed to AI. And he said, I don't think they're there. He said, I don't think they're real, because AI is not going to want to consume that much electricity, because it puts AI at risk. And when it becomes self-aware, it'll realize it needs to moderate its own demand for electricity. So that has absolutely nothing to do with oil markets, man. But it does have to do with resiliency. So I want to thank you guys for much. This was a great panel. I really enjoyed the conversations we had ahead of time, and I think I hope everybody enjoyed this session as much as I did.
Thank you.
Thanks.
Thank you.
All right, everyone. Anybody?
Turn the microphone
Okay.
on.
We ready?
I think you should be right.
All right, everyone. Can we ask y'all to take a seat so we can get going here? This wonderful collaboration is fantastic, but it really detracts from us doing anything up here. So. All right. So. Welcome back. This is the LNG panel. If that's not what you want to listen to, you should probably leave now. But we've got a wonderful panel today, and it's three people who I've known a very long time. I mean, Ken Medlock, who you know, the resident genius here and the charge of the think tank. Couldn't be more fortunate to have him. He's also has a special focus now back to his LNG focus, spending time on it. And so definitely wanted to get him on this panel. And next to him is Davis Thames, who I think, this is my personal view, and I think it's shared by a lot of people. The reason Cheniere exists, the reason US LNG exists, I was there, I saw it. Davis had a major hand, if not the most major hand in it, and developing the economic model that people banter around today as, this is the Gulf standard, this is normal. That was Davis Thames. And so could not be more happy to have him now at Western LNG, a new venture, but really enjoyed it. It's Scott Atha, who and I have been working together for 20 years now on various projects. And if his former client from 20 years ago had a lick of sense, Scott would have invented US LNG. He tried to get them to do US LNG, but they just wouldn't do it. But anyway, a great panel, and we're just going to jump right in. Ken, maybe could you talk to us a little bit about where LNG demand is and where you think it'll be going in the next 5 to 10 years? It seems to be the most pertinent question.
It is. LNG demand, I'm going to avoid using numbers, right? Because a BCM to somebody is something else to somebody else, but it's healthy and it's growing. Growth is largely being driven by a couple of things over the past few years, but for up until the Russian invasion of Ukraine, it was really an Asia-focused market. I think we're returning to that, but over the last 3 to 4 years, there's been a surge in demand out of Europe, and you saw cargo redirections in that way. I don't view that as long-term structural demand. I view that as trying to weather the storm that has resulted from that unfortunate circumstance. But as you look sort of longer term, you actually have to realize that developing economies are going to continue to drive the ship, pun intended. But what does that mean for China? What does that mean for Southeast Asian economies? What does that mean for India? What role does Japan and Korea play in all of this? Because they're still very major LNG players. All of that's very relevant. It's been interesting to hear some of the dialogue around energy security this morning that Michael sort of raised, because that does have a role for how LNG markets will evolve. In particular, that geopolitical fragmentation could result in less Chinese LNG purchases, but that's going to push that supply back out to the open water.
Less than zero that they're buying from the U.S.?
But it's going to end up somewhere else, right? I do think, however, like any market, particularly capital-intensive market like the global natural gas business is, we're going to continue to go through a bit of a boom-bust cycles, right? We'll see periods where prices rise and there's tremendous margins in developing export projects and everybody rushes to the table, and then all of a sudden all those things come online and prices subside and margins thin out, but then capital stops flowing in and we sort of reset the stage to do it all again. I think we're on the precipice of doing that again right now.
But underlying that, there's I think a core belief that is buried beneath that demand is just ever increasing, like it just keeps growing. Because there's a reason there's another cycle. If we kind of topped out at demand, there would be no other cycle, right? So is that kind of, you agree with that?
That is still very true. Nothing increases forever, but gas demand still has a bit of a road in front of it. And again, it's largely, like I was indicating, because of what we're seeing in the developing world, particularly in places where you do have a lack of resources. So not every country is like China or India has lots of coal, so they can't lean into that for energy security purposes. If they also are going to follow the same leg, again, energy security, to try to electrify and reduce oil import dependence, then they've got a choice. They've got to install a whole bunch of renewables, which can get very expensive on a system-wide basis very quickly, build lots of transmission, or they can actually lean into natural gas, and it's likely the case they'll do both. So that means there's going to be an appetite for gas to actually meet some of those needs, and largely motivated by trying to deliver energy at the lowest possible cost.
So you said something else too, that you think it's transitory, maybe not quite transitory, but European demand isn't going to maybe remain at these levels. Is that because you think just the natural cost of Russian gas, it'll eventually be flowing back to Europe, or why is that?
So I don't think we'll see a return to what we saw prior to 2022. I think that ship has sailed. However, you still have a lot of legacy infrastructure that is still very operable. Russian gas is still really cheap in terms of how it can be delivered, because it can leverage that legacy infrastructure. So I think once there is a cessation of conflict, and it's going to take a little time, but there'll be a little bit of a return to Russian flows into Europe, but in a much more moderate way. I just think you get into the cost benefit of it and the legacy relationships between some of the largest European buyers and Gazprom. I think at some point you'll start to see some of that gas flow again.
Then you're, I guess, also maybe not of the view that by 2027 the Europeans are going to be able to cut off the remaining gas. There's still about 52 BCM or 55 BCM of gas flowing into Europe, right?
Not if they want to try to reinvigorate their industrial sector. No. I just don't see that.
I mean, certainly U.S. LNG and North American LNG could meet that demand.
Well, and you've got an increased push for the Russians to also put LNG on the water. I mean, we can't forget that, right? So that's the interesting sort of dynamic I think that's unfolding out of all of this, is the conflict has actually triggered a push more heavily into waterborne cargoes. And so that's actually going to deepen the global LNG market. It's going to actually provide some de-risking benefits, but it's also going to make the market more liquid and make LNG more attractive to buyers long term. So I think it's kind of moving in a direction that one of my colleagues, Peter Hartley, wrote about with another colleague, Bob Brito, in 2002, right? Talking about how the LNG market globally will transition to something that is more liquid and actually much more fungible. And I think we're moving in that direction.
Oh, well, no, it's like it's an entirely different world from 2002.
But I don't think we're done, is my point. right? I don't think we're done with that.
Well, where do you think the new supply, from your perspective, and I'd love to get you guys in here, talk about this. Y'all are both actively, you've been at marketing for 20 years for projects, and you're both actively marketing in projects. Where do you see the LNG supply coming from? Where the customer focus? I mean, maybe
Well,
Davis?
it's quite obvious that it's Canada, right? I mean, so
These two gentlemen are both involved in Canadian projects, so we're going to get a lot of
Completely unbiased.
Canada today.
well, if you look at the question of where's the growth in the LNG industry is relatively easy compared to other industries because it's a very long capital cycle, taking 4 or 5 years to get a new project built. And so you can look 4 or 5 years ahead at what's being built, and you know that that supply is coming onto the market. And so there's no doubt that the marginal supply that's coming into the market is coming from North America. And the implications of that, I think, are quite interesting as we see the locus of supply moving from what was traditionally the Eastern Pacific Basin and the Middle East to the West. And there's a lot of implications for that, for European gas, for US gas, and for prices in the Pacific Basin that I think there's a lot yet to unfold. One of the dynamics in LNG that I've seen happen a number of times in my career is this flipping between a supply push and a buyer pull operative in the market. And we quite clearly are going into a supply push phase of the market where we will be pushing LNG into markets by lowering price. And so what's unique about US LNG and what we did at Cheniere that's now become the norm across the US industry is that customers have cancellation rights for their cargoes. So unlike pretty much any other LNG facility in the world, if the marginal value of a cargo is below its marginal cost, you don't have to lift it. And so that creates a lot of supply resiliency in the LNG market that didn't used to exist. And it has a lot of implications for the US supply base as well, as Ken and I were talking about the other night. The question of where is the, sorry, I was in Europe a couple weeks ago and it's still with me. Where is the slack in the market? Where do we create the capacity to supply these new LNG facilities? What part of the market turns off if price gets too high? And I think it's a fair question to ask which sector in the US yields when price begins to increase. And my guess is that LNG exports are probably the first place where you begin to see reductions in demand as prices in the US increase.
And even though we've had prices that have been, they're $3.30 or something, right around there. I didn't check this morning, but right around that price in the U.S. for Henry Hub. We haven't seen anything persistently north of that in a decade. There's always price spikes around weather events, things like that.
There was a bump when we came out of COVID, but that was because supply chains had to reactivate. I mean, it was a very transitory issue, but yeah.
Right. So, but you're thinking it's going, because of demand. I mean, we've got LNG, which has grown.
Being added to the Gulf Coast. I can't remember off the top of my head.
I can't either.
It's a big number. It's like 50 million
number.
tons,
Yeah.
60 million tons. So that's almost 10 BCF a day.
Yeah.
That's a massive change in the market in the U.S.
Yeah.
And it's coming at a time, the previous panel talked a little bit about this question of supply peak. And I think that the speaker from Chevron made a good point about technology always kind of meeting the day and saving the day. But there is a very real question about the capacity of the U.S. market, not only to continue to grow production in the upstream at the same cost level that had been in effect, which is heavily supplemented by associated gas. So there's a lot of associated gas in the market today that lowers the average cost of gas. And if you look at the marginal supply of gas, that may not be associated gas, that might just be straight out of Haynesville gas, which would be a step change in upstream cost. The fabric of the pipeline systems to deliver gas to the Gulf Coast has to be changed. And as we move forward through time, building pipelines around Houston is just crazy expensive, beyond what you can believe. And so I think that this question of where does US price go as this big demand hits the market in 27 and 28, I think goes up. It probably doesn't stay where it was in the past.
Scott?
I think following on Davis's comments in terms of the future supply and demand balance here, we always have amazing transparency on future supply. The projects are just so capital intensive. They take a 4 to 5 year construction cycle. You have multiple years of development prior to that. And so we always have a firm view, but by 2030, it's going to be at this amount coming out of the US. And where is it all going to go? Now, you contrast that with the demand side, which is wildly opaque. You have no idea what demand structures are going on in India and China. Yes, we can approximate, but at what price level are they going to buy? China's not importing gas right now from the US. Well, because I think it's a little expensive, frankly. They took on US supply contracts. They just are the market maker now for every other market because they're waiting for a price level that fits their overall basic expectations, frankly.
Well, who are you competing with in China? What are they going to, if they don't do gas, they're going to do what? Coal. And that's, but they're also backfilling. I mean, just because they're not buying US LNG doesn't mean they're not buying LNG. They're just not buying US LNG.
I think when we look at the long-term market, I think everyone assumes that there is significant demand growth that's in that market, China specifically, but across Asia. And it's due to production declines on their existing resource base, a growing economy that has an expectation for increases in standard of living. All of these things point to higher long-term gas demand growth. And that's where I think the market collectively is at this point in time.
I think there's another important point to raise about Chinese demand. When you look historically where most LNG has been delivered, it's to the southeastern part of the country. When you look at coal use, when you look at Power of Siberia, imports from the stands, that's into the northern and northeastern parts of the country. There are infrastructure bottlenecks that prevent arbitrage between those two things. I think that will resolve itself, but it doesn't slow by any stretch the attractiveness of LNG, particularly into the industrial southeast corridor in that country. So I don't think you can paint it with a broad brush.
At the right price.
Yeah.
At the right price, absolutely.
And we're above that price today. And complicate that with the political dynamic between the United States and China. You have the resulting no imports. If you saw Pacific Basin prices in the 7s or 8s, I don't think you would max out the import capacity in China at 200 million tons.
Yeah.
So roughly, more or less. I won't predict that.
That's all right.
But
So who can deliver at 7 to 8?
But this issue of the deliverability within China is a very important issue. I was asked to speak at an LNG conference in China in 2010, and I was assured there's plenty of LNG companies there, and I showed up. I didn't recognize a single one of them. They're all in-country truck-based LNG distribution companies. And the scale of the in-country distribution to overcome political barriers between provinces, just pure growth of cities that blocks pipeline development, it's a very big challenge to move gas across China. And so I think there's obviously the political factor, but the built-up demand base that already exists, especially in southeastern China, I think it can be a key modulator of the market to put some kind of price floor on the deliver side.
One last element, you've got a number of portfolio market participants, the majors across the board signing up long-dated contracts across North American projects and other parts of the world. You see them sign these volumes, you don't see the resulting downstream sales that they do. But that's happening in the background. And to see a BP or a Shell sign up for a big deal and they assume, well, there's no natural home. Oh, they've taken care of a lot of that here.
Yeah.
It's not like this is just going to be stranded LNG looking for a port to find.
I agree with you to somewhat.
Yeah.
I think that the majors and the large portfolio players have played a key role in absorbing the big supply growth that's been developing. I've seen plenty of people say, oh, this is a harbinger of doom because where are the demanding parties? And so yes, on the back of those purchases, there are some sales being done. But I think there's a dynamic change in the market where the demand side, when they see this big supply growth, particularly in Europe, has to ask itself, why do I contract for long-term gas? Mm-hmm. Why don't I simply buy spot? If my long-term contract is indexed on TTF, what's the point of signing a long-term contract? And that's a new development, I think. I think when we talk about the commoditization of LNG, we thought that commoditization would happen at the supply point and in the shipping segment. But I think you're seeing it develop first on the downstream side at the import point. And I think this is also a dynamic that's existing in some countries, like China, in the Pacific Basin.
When you look at those integrated LNG participants, though, I mean, they truly are taking some length as well.
Yeah.
They have a long-term view that pricing will be strong, there will not be enough resource, that gas will be a part of the overall supply mix for decades, and they're willing to say, look, we'll get to that market conclusion first. The market will find out after the fact, and they'll be well positioned.
But they play a key role in the fabric of the market. Correct. And if you think about the historical role that the big Japanese utilities played in LNG, it was to underwrite the development of greenfield infrastructure. And I think increasingly you're seeing these major integrated portfolio players taking on that role to enable this growth to be financed, to create the long-term demand. I had a colleague who once said that the buyers took the volume risk and the sellers took the price risk. And this is where I think that the Japanese utilities historically took the volume risk. Increasingly, you're seeing the portfolio players now take that volume risk.
Agreed.
And come back to China for just a second, because I don't want to close out that discussion. What about the power of Siberia? Scott, you've been around Russia a long time, and what is the future of that pipeline and Russia's supply to China? If it's not going to Europe, I mean, Ken, they're not just going to stop producing gas probably. Of course, the gas that's going to Europe is pretty far away, the gas that's going to China. But what is the possibility for that to really impact Chinese demand or change markets? What do you think?
I'll start, and I'll go to Ken. I mean, I look at the initial contract that was done between Gazprom and China, 15 years ago. The reality is this, that deal was done 25 years ago, and then negotiated the price for 10 years. Don't expect this thing to be moving in real time. It's a nice headline. And yes, there is a collective ambition for those two countries to come together. I just provide a little caution on don't overreact here. No knee jerks are required. So.
Right.
Yeah, look, I mean, China in that negotiation definitely has the upper hand, especially right now, because Russia really doesn't have any other market outlets. So that de facto gives China monopoly buying power, particularly given the LNG portfolio that they've basically contracted but aren't actually receiving because they're redirecting, right? It means they have room to wait, right, and play that waiting game and get an attractive price from the Russians. So I think at some point there'll be an agreement, and we'll see that supply move because quite frankly, it's in the Russians' best interest to secure that market because they really have, in many ways, shot themselves in the foot with the European buyers. And I think what you're going to end up seeing is Russia a much more diversified player in the global gas market because while all this is going on, they're also expanding LNG export capacity.
Right.
So they're looking at ways to hit that market, hit the global gas market from many different dimensions. I want to come back to one thing because I think it's certainly not underappreciated up here, but underappreciated in general is what role U.S. LNG is actually playing in the transformation of the global market. It's a remarkable thing that actually does contribute to long-term stable demand upside. LNG cargoes, when they're loaded in the U.S., are loaded FOB. So basically, that's what allows a portfolio player to step in, sign a long-term deal, and then play the real option game with that cargo. And if you can capture upside on a real option versus just having a strict bilateral, inflexible contract, that actually yields value in the long run that de-risks the overall capital commitment. So it's a beautiful thing in terms of market efficiency, but it is transformative for the global market.
Oh, it definitely, the years leading up to U.S. LNG were very much DES markets, so the projects were looking to deliver. They were looking to try to go directly to the market and get a net back to what were integrated projects around the globe. So whether it was, Qatar, Nigeria, wherever it was, they were more interested in bringing the LNG there and maintaining their optionality to potentially move it around and net back to the producer. And the U.S. is just a very different market. The LNG projects make zero investment in U.S. gas infrastructure, except maybe a connecting pipeline, that gets them out to another pipeline. They're not involved in the U.S. gas market except as the single largest buyers in the country now, but they're not producing. And so they're interested, they can just call to the market with price and with demand and get the gas supply that they want. And it's not like a coast country that wants to get as much net back as it can. They're interested in making LNG, dropping it off, making a rate of return, which is largely reflected in a small differential to the gas they buy, and then a capital rate of return. And that's it. That's been the structure. It's very, very classic infrastructure setup. Very, very different than the upstream developments
I'll tell
elsewhere
you
in
a
the world.
funny, real quick story. We did a project. It was a pretty significant project with a major LNG exporter in the Middle East. Don't need to say names. You can probably figure it out. But this is going back about 15 years ago. In the course of that 2-year engagement, we had many very vigorous debates with heads of trading, heads of project development about what market structure would mean, and they were insistent that they were going to maintain a 50-50 split for their cargo volumes, sort of moving into the Atlantic and Pacific Basin. That all blew up very quickly when the disaster at Fukushima happened, and it hasn't gone back. So markets transform, they flex, particularly when there's value on the table, and the entry of US LNG into that space has been utterly transformational of how that value is realized.
I think that's right, although it's interesting, you have expansions in the Middle East, both in North Field expansion in Qatar, and then, Abu Dhabi has managed to shave off its own gas needs, and then now they're going to be exporting more LNG out of Abu Dhabi. And so that's, it is, and then now you have East Africa. So you have all these different supply points. Basically, way back when Australia wasn't quite developed, you had, Qatar, and you had Nigeria, and you had, Peru and a few other places, but it was very limited supply. And now it's diversifying, and I think the last 10 years have really been sort of US LNG, been the huge focus, 15 years, let's say, ever since 2011. It's been a huge focus, but there is something else going on in the market where people are kind of moving out.
That is the landscape that new projects have to compete into. You can't lose sight of that, right? It's different.
It is, but we're seeing, at least at Baker Botts, we're seeing interest in upstream projects and interest in non-US projects that we didn't see for 10 years, or that was limited to specific fields in, offshore East Africa that were very slow to develop, much slower and much more expensive than people had wanted. So I think we're seeing different supply sources, and even in Southeast Asia, supply sources that are competing. Maybe a few words about Canadian LNG and how since we have 2 Canadian LNG projects here, about how the projects compete with the US projects and with other markets. Like, what is their structure and what are their advantages?
I think that it's important to just step back a bit and think about the history of LNG, that it was not about LNG, it was about oil. And the reason that the LNG business developed was to get rid of gas that prevented people from producing oil. And so when you ask, what is the dominant indexation mechanism in Asia, it's oil, because the market was buying oil and they were being incentivized to buy gas to replace the oil, or the sellers were trying to produce oil and they had all this gas, so they wanted to price it for oil. So it's a very natural progression that I would say that 80 to 90% of the demand in Asia is indexed to the price of oil. And so where does the US come into this? We were rightly selling a spread option. And what we were offering initially was relatively expensive to where it is today, but the market was wide open. The spreads were very large for off-takers, and it was a very compelling opportunity. Where this growth is going, though, I think creates a unique situation where the correlations in that spread option are going to increase, where the prices are all going to move in lockstep because we're going to oversupply that market, which massively decreases the value of the spread option. And so I think as we go through this time of stress, you're going to see a lot of emphasis on the creditworthiness of the off-takers, especially in the Gulf Coast, and you could see some difficulty over the course of that time as that demand is absorbed into the market. And so that sets the stage for what is Canada. And both of our projects are on the on the West Coast.
There we go.
And so we're selling into Asia. And it creates a complex situation where the market is used to buying on an oil price basis. That's the value of LNG in the market. But there have developed these market price mechanisms that were meant to deal with marginal quantities to do balancing across countries. Those are the prices that went through the roof during the course of the Ukraine crisis. And so a lot of eyeballs are on this liquid market index. So as we talk with buyers, there's a constant tension between that JKM price or some kind of oil indexation price. And it's an answer that hasn't yet been arrived at. But I think, again, for another reason, you see the portfolio players come in. And I think when I look at the Asian market and I ask where does the growth come from, we can all look at China and say, wow, there could be a whole lot of growth there. But to a large extent, it's one of the more mature markets. So Japan, Korea, Taiwan, very mature market, no demand growth, probably some loss of demand over time. China certainly has more demand growth left to go, but over the past 10 years, it's a completely different place from what it used to be. The growth in the Asian market and consequently the growth in the global market is countries like Vietnam, Bangladesh, India, where price is a problem. And so I think that the question that has to be addressed in this industry is how do you do very large, expensive development projects, which is what Canadian projects are, sell to people at a price that justifies the investment that we make, guarantee the offtake, that volume commitment side, while creating growth in incredibly price-sensitive markets. I think that that's the dynamic, that's the complicated one to answer as we look at the supply growth, because the demand growth has to go with it.
I think it's also important to look back in history a little bit when Davis was going out and doing wonders in the U.S. Gulf Coast. Canada had the same ambitions.
Right.
There were 20 projects that were going in real time, trying to be up and running at the exact same time. And there's a gigantic cemetery of fallen projects in Canada that were developed by some of the biggest players in the world.
Do you know what one of them was called? Western LNG.
Of course.
Yeah, that was an accident. I didn't know that.
This is true. No, there was plenty of ambition amongst developers, amongst some of the biggest oil and gas companies in the world. Why? Because the resource is amazing. Right. It's some of the cheapest, most prolific gas-producing basins in the world. You have a big mountain range in between.
Yeah, pretty big.
You have a Canadian government that didn't really want to buy into this story for a long time. Mm-hmm. And so you saw a lot of projects come and go. We just had our first project start up. It's called LNG Canada. And the Kitimat region was developed by Shell, but it took a long time. You look at all of the success that had been achieved in the US during this entire time, and it's shocking. And there's a lot of concern from the Canadians, okay, did we miss our window? Well, I think they've now, over the past 6 to 12 months, come to realize, hey, I need to take some ownership here. I need to be able to control my own destiny, and you're having conversations now around what can we do that does not rely on our southern neighbor, where we can capture our own egress routes here. And so we have politicians coming in together saying, how can we help you as a Canadian project? Conversations that never would have happened literally 2 years ago. And so I do see an opportunity for additional Canadian LNG to come together. It's hard. Let's not kid ourselves. But
I wanted to get to another aspect of the whole dynamic. When we developed the industry model in the United States, it was an arbitrage model.
Correct.
It was the global market arbitraging low-cost U.S. gas. And for the entry fee, which is the fixed fee that a buyer pays regardless of whether he cancels a cargo or not, he owns the right to buy Henry Hub price gas, LNG. I had an investor one time say to me, it was after we'd done a bunch of deals at Cheniere, they said, you've sold so much LNG. And I said, you know what, I actually haven't sold any LNG, and he about lost it, But the fact was that our contracts are fundamentally very large options, and every loading is an option for our off-takers. But what that means is that the U.S. producer who's delivering gas to these projects is stuck. They don't ever see global price. And in fact, I had a CEO of a producing company say to me one time, how do I get access to global price? And I said, unfortunately, you're the what's the right word for it? You're the target, you're the hit, right? in the ARB here. I think that one of the big things that's happening in Canada and what's unique about our projects and the way that they're being structured is that the producers in Canada are trying to get out from behind that barrier at the beach that prevents them from accessing global price. And so I think Scott's project is trying to do it one way, we're trying to do it another way. But in the end, what we're trying to do is create the opportunity for producers in North America to be exposed to global price. That can be good, that can be bad. It's a tough one to take, and the structure to be able to enable that is complicated. But in the end, I think that the big trend that we'll be seeing over the next 4 or 5 years in development and growth of North American LNG is precisely that ability to let producers access the global price while structuring the risk appropriately.
So you don't think that's possible in the U.S.?
It is possible, and EQT is signing SPAs to deliver gas and export it from different facilities. But I think that that question of what is the value of the spread option is going to continue to become more complicated over the next 5 to 10 years, and the capital commitments, the dollar value capital commitments that these projects represent is so much larger than anything that's really normally faced in the U.S. industry that there could be some surprises on that side of it.
Well, I think there's already been surprises. I think the cost of U.S. LNG, that strike price, as you call it, although I want to come back to that in a second, that strike price has gone up. Yep. It's not gone down because construction, especially coming out of COVID, has never quite returned prices. And we also had steel tariffs. Those have been super helpful to get our construction going. Thanks for that. But it's the entire supply chain, and also you're building this at the same time that you're talking about building natural gas-fired generation, that you're talking about building all these things that have a lot of the same components, turbines, right? Yeah. And so you're going to have a lot of competition across that chain, and it has driven price. 1/3
of construction costs of these plants is labor cost, and there's a finite pool of trained welders that anybody can poach. And those prices just keep marching up through the course of construction of these projects. Very complicated.
I was on a panel, I don't know, 8 months ago. We were talking about what are the bottlenecks, and traditionally it's been, okay, got to find buyers that can provide creditworthiness to underpin the overall investment. And I said, no, it's truly an EPC provider that can go out and build your project on a construction cost that's reliable here. Bechtel at the time was the only king that can dictate whether a project goes forward or not. That's not necessarily the case, but they have a lot of market power. Baker Hughes, Siemens, these guys control markets that are going to be integral.
You're on the internet. Don't say they have.
Just watching it.
Well, okay. So what does that mean for floating LNG? Is that the part of the way to solve this problem?
I wouldn't call it market power in the same way. So we're working with Samsung and Black & Veatch, both of us.
Yeah.
And when we signed our initial agreements with them, they owned the product of the feed, the front-end engineering and design. And so you can look at that as a person like me and you think, hey, I could have a pretty bad day if they say, guess what, we own this engineering and we're not going to build it. And I think that's, contractually, that certainly could have happened. Mm-hmm. But it just doesn't happen, and it's because they're reputable people that just don't do that kind of thing. We find this throughout the LNG industry. However, there is a lot of floating LNG happening. Samsung is one of the key contributors to it, and the availability of shipyard space to build our project while they're building Scott's project is congested. And so it's causing a timing phase that we hadn't foreseen, frankly, that we're going to have to live with. There's another FID that's coming through probably this year that needs to go into the same shipyard space that we'll go into. And so we can talk about floating LNG. It's a cost game changer, frankly, for LNG projects. And I think it could be used more widely across the world. The problem is, where can you build them? And the development of the shipyard capacity in order to build floating LNG, I think we're at the operating limit at this point.
We were worried about it. I mean, we were very aggressive on securing that capacity and that time slot to go forward. Yep. We didn't want another project to jump in front of us. It could have cost us 12 to 18 months.
Yeah.
And so
it's a, sorry, go ahead.
Sorry, yeah, it's interesting because you hear words like market power. Really what you're talking about is a constraint on the ability to do something. And in any market, it doesn't matter what it is, if you run into a binding capacity constraint, costs go up.
Yep.
Typically, depending on the capital intensity of expansion in that market space, you'll see that be a transitory issue. But when we're talking about shipyards, that's a different issue. It can last a while.
Yes or no.
Yeah.
Do you go forward or not?
That's exactly right. So So, but it's a pretty typical outcome. I think it's the result of just the tremendous demand that we've seen emerge over the last few years particularly for FLNG capability. So,
Well, and most of the construction slots are in China, for a lot of these vessels. And so that creates,
Not for FLNG.
not
Korea.
for
Yeah,
the latest ones, not for the ones you guys are doing,
Yes.
but for some of the ones that are coming
Yeah,
onto the
well,
market
that's a
soon,
unique-
a lot of that is in China. And so that's part of a very complicated answer. That's not going to be a U.S. solution. And the U.S. has gone almost entirely onshore. There are some offshore projects that are still going. Some of them are still stick built. They're not quite float in true FLNG projects. They're just offshore LNG. But it seems like there's this disjuncture in the market where a lot of projects outside the U.S. are like, yes, we're definitely going to go with a floating solution. Why is that?
It's geography driven in a lot of circumstances. Davis and I's projects are in very remote locations. So labor.
Mine's more remote than yours.
Barely, yes. Flying people in and out would be very costly. But more importantly, the actual coastline. We have gigantic fjords effectively on the west coast of Canada. There's no flat land available where you can build a 400, 500 acre type of facility. No, you've got really, really steep cliffs going into this, and the water goes straight down. There's no dredging required, thankfully, but there's no available shoreline to do this. So instead, go build it in a controlled construction yard where you can limit your costs. You have repeatability on the labor and the overall project management. It's a huge advantage for us. Now, the question had been, can you scale? And I think that's starting to erode too. Davis's project is huge from a floating LNG perspective. It's equal to many of the projects that are land-based in the US. So it continues to evolve, and I think there's a very bright future, not necessarily in every single location, but in tough places, absolutely.
Well, you guys share one, I think, common issue in Canada with the U.S., which is pipelines. Like the U.S. pipelines are beginning to constrain. I think you said it earlier, Davis, that what we are going to need is a different pipeline solution if we're going to keep building things in the Gulf Coast. But it's similar. Canada, I mean, the gas is still pretty far away, and those are bespoke pipelines. Those will only be built if there are LNG projects. There is no other reason for them to exist. And they were really hard to get the first ones launched. Why are we excited that there's going to be more pipelines to bring more gas?
Well, we're building one.
Yeah.
And I wouldn't say it's because we're excited about building it. It's going to be a really expensive pipeline. So Canada's unique. It has a very strong carbon emissions regime, very stringent prohibitions on gas-fueled generation, things like that. And so normally when a pipeline like the one that we're going to be building is developed, they look for a number of customers to utilize the capacity in the pipeline. We're going to be our own customer, and by rule, we're the only customer that can be on this pipeline. Now, if there was the possibility for gas-fired power plants to exist along the length of the pipeline, or any other kind of, take an ethane project that would strip ethane from our pipe and export polyethylene, those kinds of demands would lower the capital challenge of building a large, expensive pipeline like this. But as it stands, that pipeline will double the cost of the LNG project.
Right.
So it's an economic burden in Canada, but at the same time, Scott's right that the resource is an incredible resource. It's very large, but it's also very low cost. And today, the Canadian producer primary market is in the United States. They sell in competition with producers in the Permian Basin who flare gas, who vent gas, who have no real rules around the emissions profile of the equipment. They sell it into pipelines where venting of gas is a normal procedure, unlike in Canada where it's all completely prevented. Control valves, for example, in the United States have to sample gas pressure on both sides, and every time they resample, they let off a little bit of gas. Not allowed in Canada. That has to be an air actuated control valve. And so the costs of the Canadian producer are significantly higher than the cost of the US producer. They're also farther away from every market at the end of a long pipeline. Yet that demand or supply growth in Canada is only constrained by the amount of pipeline capacity out of the market. So that tells you how prolific, how low cost, how high quality the Canadian resource is. That's why we can build projects at the cost level that we have to build them in order to liberate that gas and bring it into the global market.
If prices are going to be going up here, why doesn't it liberate itself by coming south through pipelines?
Because the normal relationship between two markets in a pipeline is defined by this kind of cascading of marginal cost. Mm-hmm. And if the cheapest route between two markets becomes full, the next available route is where that marginal price drops to. And in this very connected fabric of US pipelines, we don't think about there only being one way to get from point A to point B. But from Canada, there's only one way to get from point A to point B. And so the effect is that the supply growth at point A increases until it hits its economic cost. And that's where price stops, regardless of what price is in point B.
Wait, who's the economist here? Wait,
sorry.
I wanted
Did I say it wrong?
Does this sound? You sounded like the economist. Ken.
So-
he's infringing on your turf.
No. So there's a long, deep relationship between Canada and the U.S. when it comes to natural gas trade, right? Pipelines have been developed. There hasn't been anything added any time in recent history. Makes sense largely because the price in the lower 48 has been as low as it has been, right? There's no way to actually recover capital to add pipeline capacity. And anybody who's looking at that market right now would say, all right, well, if Canadian price drops, what's going on in the lower 48? Could I survive adding capacity? Because if you add capacity in a capacity-constrained market, which is what defines the basis, if you will, between the Canadian producer and the lower 48 offtake, right? If you add capacity to that, you actually crush the basis. And so you actually don't get a return to capital. So what has to fundamentally happen for long-term decisions around pipelines to be made to add capacity to move from Canada to lower 48 is you have to see a structural shift in the lower 48 market. Something that really indicates that price is going to be structurally different for the long term, or else you're never going to see that capacity added. You'll just fill up what you have and stop. So one of the things that you have to look at when this comes back to the lower 48 price in general, right? Canada's one margin of response, but it's constrained by capacity. Another margin of response is if prices start to creep up in the lower 48, and this is something a Canadian producer would have to internalize too, is what happens if we start to connect up all the associated gas? Because we're producing more associated gas right now than we export. Just think about that. That's a really big number of effectively free gas. And we're still venting and flaring. Wow. So what that tells you is there's got to be a constraint somewhere in that market where you've got all this really low cost gas that's keeping it from actually getting collected and actually moved.
Negative price gas.
Yeah, that's the point, yeah. But that's where you get into what's the cost of developing gathering infrastructure, what's the cost of developing takeaway capacity, what's the cost or the impediments to building interstate pipeline capacity. There's all sorts of things that intersect with this that ultimately present constraints. I think I wrote a piece 2 years ago that infrastructure is the Achilles heel, right? It is, and it always will be. But you need those price signals to support development, and they need to be structural to support development, or else you're going to end up in these just prolific boom-bust cycles that prevent things from getting developed.
There was a pipeline, the Rockies Express pipeline, that was going to be built, incredibly expensive pipeline, forced Kinder Morgan to go private through investor discontent. And I knew of a large producer that had a lot of gas production in the West who subscribed for a quarter of the capacity on this pipeline. And the West basis at this point was about 40 cents to the east side of the United States, and the pipeline toll was going to be at least 3 times that. And so I asked somebody I knew at this company, how can you possibly support that economically? It doesn't make any sense because the basis is going to shrink once that pipeline goes into service. And he said, yeah, exactly. The basis is going to shrink. And so I've subscribed for like 1/10 of my production in the West, so I'll see that lift across my entire production base. And I think that's, if there was going to be a new pipeline from Canada to the United States, that would be the effect that people would underwrite the construction of that pipeline for. The problem is there's so much producibility of gas in Canada that as soon as that price lifted, new wells would get drilled, and it would be driven back down to the economic cost again,
Yeah, so
and nothing would have happened.
the REC system is a great example because most of the subscribers for capacity on the upstream side, they were buying that as an insurance option because you were seeing, zero pricing in the Canadian, I mean in the Rockies, so in Opal and Cheyenne, right? And that's actually where that system was moving over towards the Chicago market, which was healthy. And I think the biggest thing that hurt that project's long-term viability, it's there, right, was the Marcellus, right? Nobody saw that coming.
Right.
So that's like the black swan event when you're thinking about, I got all this really cheap gas, I want to get over to where there's demand, and then all of a sudden this new supply portfolio sort of unfolds, so.
I think you can look at the pipeline question between Canada and the U.S. and make a similar comparison to what's happening with the Marcellus right now. It's not that Marcellus has maxed out its production capability. It's lost ability to egress back to the Gulf Coast too. Yeah. The moment you could permit a pipeline to go to the U.S. Gulf Coast to supply the next LNG
There's
project,
a different problem, right? It's a permitting issue.
It is.
Not, it doesn't have a fundamental economics issue attached to it.
Permitting on the Canadian side too. I mean, trying to build that.
Building a pipeline through the east coast of the United States is impossible. It is too expensive.
Yeah, I mean, we leveraged legacy. I mean, like Columbia Gulf, we reversed compression on that system and moved it south, right? So,
a lot of
but that was stuff that was already there.
Yeah.
Building something new is a different animal. So we're back to the permitting.
Well, is it a permitting question or is it a cost question?
It's a
Davis,
cost
I hear you
question.
saying a cost question.
I mean, certainly permitting's a mess. It's less of a mess today, though. And I think I think that the FERC commissioners have been straightened out. Is that right or not? They still haven't appointed the new FERC commissioners. But assuming that Trump got his nominations on the FERC commission,
well, nothing's happening right now.
Today would be the day to file your permits and get them approved.
Right.
I still don't think it would be built.
Could you permit locally though? Yeah, you can get your FERC permit, but are you getting local permits to make that happen through Appalachian states?
I don't know that it's solely a permitting issue. I think the reason it's complicated to get the permits you're citing through some of these places is just the growth of these towns and villages and cities like Houston across what used to be remote corridors. Yeah. They're out in the middle of nowhere, and now these cities have built out across them, and you can't actually build through the existing corridors anymore. So it's 100% greenfield.
Well, we're coming to the end of it. Maybe I want to wrap with a slightly different kind of question, and this goes back to where we started about demand, which is, LNG is they are the dominant gas buyer in the U.S. by size. Like Cheniere, I think, is the largest gas purchaser in the U.S., and LNG demand, as far as single source demand, is just going to keep going up. They're going to be the largest gas buyers unless we actually start building more gas-fired generation for data centers, which is not something. We had electrification already on the menu, which people were talking about. Now, depending on who you were talking to, they would have a different thought in their head when they said electrification. Some people were thinking we're just going to have solar and we're going to have batteries, and somebody was thinking somewhere else. Now it looks like gas-fired generation is back on the menu, both for data centers and electrification and LNG. And if LNG keep having FIDs, final investment decisions for these projects, demand is going up. Maybe coming back to what Davis said earlier, are we really looking at a structural price increase over the next number of years? Or is a lot of this just going to fall away because it's not going to be economic? I mean, where are we going to end?
So I'm happy to jump in on this one. On Monday, I spoke at the American Gas Association Executive Conference in San Antonio, and this issue came up.
Can you imagine?
Interesting perspective was shared that it's not gas supply that the data center electricity providers are worried about. It's the ability to actually access pipeline capacity so that they can get enough gas to feed the power generation stations that are behind the meter, right? Mm-hmm. And that's an interesting perspective. This is coming from somebody who is involved in a major project in Louisiana where you can almost, it's hard to walk 10 yards without tripping over a pipeline, but it's an issue, right? So comes back to permitting and siting and project development. I mean, you've got to actually have, and I think with data centers, you will have anchor customers that could underpin that, but the ability to actually get stuff developed is not so easy. This comes back to a local issue, though, because right now, when it comes to permitting local connectivity, it's not that simple. And so this is something that a lot of those companies are wrestling with. So it's amazing that the issues are so similar, but the one thing I will say on top of all of that I think maybe echoes something that was said earlier today, I think some of the projections about how much gas demand is going to come for power generation for data centers are a little bit too high. There's a lot of other things that are going on that are actually going to squeeze efficiencies into the system that'll.
But they're certainly greater than zero, right?
No, they're greater than zero, without a doubt.
It'll grow. The other thing is that gas demand for power is a much more nuanced demand element than LNG supply. LNG supply is 24/7, no questions asked. Power generation, you're transforming gas into electrons. You're competing for electrons on an integrated grid. There are alternatives always in that procurement effort.
There's a lot of flex.
And so, yes, we could see a tremendous amount of gas-fired generation grow, but it doesn't mean a one-for-one increase in gas demand to go with that generation, unlike LNG.
Well, although behind-the-meter power is a very different game. You know, there's a grid,
true.
you're kind of maxed out on grid
But
power
they say
competing
it's
for
behind
electrons.
the meter because there is a meter.
Yeah, but just because but let me just say, just because you have 100 megawatts behind the meter does not mean you have 100 megawatt interconnection.
But to Davis's point, though, if you see a bunch of behind-the-meter assets added, that actually is pulling gas off of the grid, which could change the marginal cost of gas, which changes the marginal cost of power for peaker plants and other plants that aren't behind the meter. And so that's actually where the flex is in the system. And the amount of gas-fired generation there far exceeds anything that anybody's projecting for behind the meter. So it's an inframarginal source of power. It's not going to really.
Well, yesterday, for those of you who were here yesterday, we got into this discussion, and there was quickly went to, well, we're going to have 2 gigawatts of gas fired. We're going to have 4 gigawatts of small modular reactors and nuclear, and it was like, oof, that sounds like a lot. And when you add up those numbers, that's really a lot of money you're talking about spending there. I mean, if these dreams are realized, even in half, even divide them by 5, right? It's still a huge number. When you start adding up the aspirations of companies that have the balance sheet to make it happen, right?
It's still a big number, but then you get back to what are the margins of response on the supply side? And we already mentioned Canada. If there's a structural shift, that could be one. I still contend that the two most relevant ones are going to be associated gas in the lower 48. And then if you step out from that space before we get to Canada, I think the next one is actually the dry gas, right? So this is where you get into, and there's demand response too, admittedly, but this is where you get into what could you do in the Haynesville, right? And I still think we had a debate actually in this building, I think it was in 2010, between me and Art Berman. So people who know shale know that name, right? He contended that it's a flash in the pan, right? And I kept talking about how it's not, because you're underestimating the learning by doing that goes on as we step into these plays. And I laid out an example of something we did that was involved. It was a project we're involved with when I was working with Scott Tinker on this issue when he was still at BEG. We were looking at, and this is the beauty of US data, by the way, you can actually see the top side of a well, the top hole location, the bottom hole location, so you know the direction the lateral went. This is all in a well file, right? So we were looking at well file data for operators in the Barnett Shale at the time, just to sort of see historically how they did and what that meant for production, translated into productivity. And one of the operators was, for the first 18 months of developing the acreage they had there, laterals were going in just every direction. Right? And you got very mixed results on what productivity looked like for their wells. And then all of a sudden, everything started to lay down like railroad tracks. Why do you think that happened? Yeah. They figured something out, and you saw productivity go way up. Yeah. That is just a drop in the bucket in terms of what can happen when you actually put your mind to it. And this is where things like AI actually could yield tremendous benefits. I think that was referred to earlier today as well. So I don't see there being a real impediment to long-term growth in supply in the United States, particularly if the demand signal is there.
Well, that's as good a finishing statement as you can probably go with this crowd, that's for sure. There were tons of really good questions. I tried to weave some of those in, but I think Ken said they're going to try to get answers to these questions out later on. But thank you for the participation here, and hopefully we answered some of those questions. Thank you to this marvelous panel, and really appreciate it.
Well done. Yeah.
All right, since we are the last panel standing between you and lunch, we'll go ahead and get started here. This is the supply chain complexities in minerals, metals, and mining and materials. So we're very excited. Let me first start by introducing our panelists here today. We have an excellent group. We're very excited to get going. So Michelle, I'll start with you. Michelle is a fellow in energy, minerals, and materials at Rice University's Baker Institute, where she leads research on mineral supply chains and energy transition. She has more than 40 years of experience in energy economics, consulting, and investment banking, and previously served as chief energy economist at UT Austin's Bureau of Economic Geology. I'm sure she's no stranger to many of you in this room who have seen her speak and present on these topics before. So my colleague immediately to my left, Eric Robinson. Eric Robinson is a special counsel at Baker Botts, and he advises clients across the defense, industrial base, critical minerals, and technology sectors on transactions involving federal credit programs and government-backed financing. Previously, Eric was the managing director at the Department of Defense's Office of Strategic Capital and COO of its credit program office, so where he led underwriting and national security screenings. So he has a wealth of experience to discuss on federal credit, which will be pertinent and very relevant to things going on today. So, and then finally, Jonathan Smith. John is the managing director of project development and finance at Geoframe Energy. He structures and executes financing for geothermal and critical minerals projects and has almost 30 years of experience in debt capital markets and project finance, with a track record of building financing solutions for complex energy and infrastructure projects. So finally, I'm Rebecca Seidel-Inglesby. I'm a partner in the Houston office of Baker Botts. I head up the firm's critical minerals and materials subsector. Prior to joining Baker Botts, I was in-house at BHP, both in Houston and in Santiago, Chile, overseeing major development projects for one of the largest copper mines in the world, and have experience working with OEMs, with critical minerals projects, strategic joint ventures, and long-term offtake arrangements. So we will jump right in. Question for each of you. Michelle, we'll start with you, but I'd like for each of you to sort of set the table on the present landscape from each of your unique perspectives, law, operations, policy, on where we are today in addressing supply chain complexities in critical minerals.
So you want me to kick off? Okay. All right. So thanks, Rebecca. Thanks for everybody for joining us today. You all know me, I don't pull punches usually. So time for brass tacks to set everybody up, John and Eric and Rebecca for discussion. Point number one, Rebecca put in some very polite questions about how do we diversify from foreign suppliers. There's really only one foreign supplier that we're going to talk about, and that's China, which is a near monopoly when it comes to non-fuel minerals, metals, and a lot of other stuff, unfortunately. So to give you some quick statistics, imagine the world map. Think about where China is in all of this. I watch about 70 commodities, and that includes the rare earths group, so that's 15 different elements. So 85 roughly total. The periodic table is 118. Got that? So there I am. Out of the 70 commodities that I follow every day, 30% or more market share, and that includes both domestic production plus what they control in processing. So they import in addition to their own production to get to finished materials. 39 of those 70 are in China's hands. When it comes to 50% or more, which kind of includes where John's business is, 26 of those commodities. When it comes to 70% or more share, 11. Now, across that list, but mainly in that batch of 11, are some that have been the topic of conversations in terms of export controls. So the kind of stuff that's been rolling around, gallium, germanium, graphite, rare earths, antimony, or antimony for those who like to pronounce it in that way, are all in those clusters of dominant market shares from China. Near monopsony, near monopoly. Now, to go to the previous session on oil, as we think about all of this, if If you look downstream oil, you see the same thing happening, by the way. So China is now probably officially the largest refiner. I didn't hear anybody say that earlier, but I think so. On the chemicals and plastic side, they are nearly there. So we've got a lot to think about in terms of this one country, where they are in the world, and what that gives them. And so part of the fear is price power, either by accident, just because of something they're doing and responding to market conditions, or intentionally. And this is what we're trying to differentiate. How do we think about what they can do with this market control they have? The second point I want to put on the table for everybody, including me on all of this, we're talking about supply chain resilience. Inevitably, that leads to a favorite word, optionality. So it came up earlier, flexibility, optionality. A friend of mine in the LNG industry years ago made a comment that stuck with me forever. Optionality is great if you can pay for it. It was wonderful to listen to Adam and Skip and Abhi and everybody else talk about everything that's happened on the oil side over the years. Amazing stuff, as the industry has learned how to monetize every member of a barrel of oil equivalent. Come over to my side of the aisle when it comes to metals and mining, and oh my God, it is so complex. You're dealing with the problem that we had in the early days of the shale gale, trying to figure out what to do with stuff that had been trapped in vertically integrated companies, was never exposed to market in terms of market prices, so the ethanes and pentanes and all of that production. We've got all of that in small commodities that are of strategic interest. There's no markets, there's no liquidity, there's no price discovery, and you're trying to figure out how to add circuits, add investment to capture that stuff. And this is a really big dilemma when it comes to the mining industry itself. Plus, you've got the mining industry itself. Culturally, has never really thought about business conditions in the way that oil and gas is, and this is fascinating to look at. By itself, it's extremely complex. And the biggest threat, of course, is that you roll out a major investment to try to cure some of these resilience issues, and China's pricing power will undermine you. This really discourages capital markets and discourages capital flows, and I'm sure John's going to have some things to say about that. I want to mention also that a lot of what we look at and a lot of what we assume about metals, especially even the large base metals, copper, aluminum, and so on, we assume they'll be there. We know these businesses, we know these supply chains. They've pretty much always worked. But right now, we have a set of copper outages that reflect technical engineering risks that really is getting scrutinized, that no one actually really thought about seriously enough, considering these projects, the depths they're at, the complexity of the ore bodies, and so on. And so we've got something to think about. The third point, just to close up our big discussion about outlooks and how we think about energy futures and going forward, we've had this big political shift. I'm hoping Eric will comment on this from the defense side. We were being driven by assumptions about energy transition by such and such a date. Now we're worried about national security. We're dealing with energy realism, the realization that fossil fuels are actually really useful and we need to try to keep them in the picture. When we think about the materials requirements for all of the outlooks that you all saw, including those from our friends at BP today, our friends at the International Energy Agency, they do not take into account the complexities on the material supply chains outside of fuels, because it's so hard to deal with, it's so hard to grapple with. So just one last set of statistics. We're worried about electric vehicles, everybody focuses on that. If you're an oil producer, you're worried about, transportation and fuels, gasoline shares, and so on. We have 1.5 billion light-duty passenger vehicles on the road. A whopping 4% of those are electric vehicles. After all these years and all the subsidies, almost about half of that are plug-in hybrids, which means they need some gasoline. We're trying to get to targets faster than we can provide the capacity to get there for, and we need actually more vehicles than what we've got, because you're still trying to provide mobility to the rest of the world. The stresses and the strains on electric power systems and everything else along with that are not getting accounted for. I think that came up in the last panel pretty well. My price tag, just to give you all, since this was a topic of conversation inside the Baker Institute, give you all a feel. People talk about, for the 2050 targets, net zero, some achievement of that. however you set the numbers of being something like 275 trillion or 250 trillion concerted effort worldwide. I'm at 500 trillion, but also 150 years, just doing the math. So, you know, these are things that we really need to own up to, because rippling over onto the material side, you have to be able to make investments under reasonable scenarios, right?
Yes,
so
absolutely.
I think I'll stop there.
Eric, let's have you set the stage on government support, capital backing. You saw the incoming administration, significant number of first day orders on critical minerals projects. Where are we from your perspective?
The United States is in a transition point, not related to energy, but in a degree of comfort regarding industrial policy. And it's not just a product of the previous 8 months or so. If you want to benchmark the way that the second Trump administration is thinking about using tools of federal power to improve American energy and industrial resilience, we have to go back to 2018. And during the first Trump administration, the Pentagon published a document called the National Defense Strategy. And it was a watershed moment in American strategic thinking. And as an aside, I'm up here as a corporate attorney, as a member of the Global Projects Group at Baker Botts. But my personal and professional history is anchored around the Army. About 25 years ago now, I'm aging myself, but I signed up for ROTC when Bill Clinton was still president. And by virtue of being a cadet, a soldier, a reservist, Army civilian, or I'm still an Army spouse, I've been in this orbit for my entire professional career. So I think in terms of warfare. I speak like a strategist, and maybe somebody's going to send a comment later that, oh, that was a dreadful choice. They'd prefer to hear from an engineer, but I'll talk like somebody who thinks about the ebb and flow of war. So when I refer back to this 2018 National Defense Strategy, it was a express policy document that instructed really the Pentagon at the time, but a variety of other components of the federal government follow, to reorient its posture away from the wars, Iraq, Afghanistan, campaigns in Yemen and Somalia, and shift towards big four threats, with the People's Republic of China being the top, and beneath that, Iran, North Korea, and the Russian Federation. And that document started a ripple effect through American policymaking, and that ripple effect is continuing. The Biden administration didn't abrogate that disposition. The Biden administration acknowledged that the PRC was a so-called pacing threat, that it reflected a military, economic, and political potential that the United States had not had to stare down since the War of 1812. During the Cold War, the United States, NATO allies, and international allies and partners had a decisive economic advantage over the Soviet Union. In the Second World War, the United States and allied powers soundly defeated the Axis through superior technology, superior soldiering, superior engineering, superior employment of resources. So the 2018 National Defense Strategy, functionally admitting that there was an actual peer to the United States and the alliance structure that the United States had forged starting in 1945 and onward, had somebody who could break it apart by force. That was profoundly impactful on people like me who were in Washington, D.C. at the time, and were going to have to react to it. 7 years down the line, what does the NDS and that moment in American policy making reflect? Like, what are the actual consequences of it? And what we have are major legislative efforts like the CHIPS and Science Act of 2022, the Inflation Reduction Act. We have the One Big Beautiful Bill Act that was passed into law this past July. We have the Pentagon, the Department of Defense, being instructed to play a direct investment role in the American and international economy in a way that has never been done. The United States has permitted the Pentagon to be a massive purchaser of services, or a buyer of supplies, or a deployer of troops or hardware, you name it, in order to shape international and occasionally domestic outcomes. But by virtue of Congress and now 3 different presidential administrations in a row acknowledging that there's an existential crisis, that this peer competitor can upend the entire global order. New tools are being given to new institutions throughout the federal government, and old tools or existing tools are being reinvigorated to achieve superior outcomes, all of which is designed to prevent a form of future shock in which there is a war in the South China Sea, or the Russians do try to move through the Suwalki Gap, or the Iranians try to close the Strait of Hormuz, and the United States goes through 48 hours of munitions expenditure and then finds that its supply chains cannot support rearmament. That's ultimately the crisis. That for the last day and a half, we've been talking about supply chain ebb and flows and constrictions in energy prices or mineral shortfalls, and that is all extraordinarily relevant. But if we bring it back down to the fine point of why we're in this moment in American industrial policy, it's because we don't want soldiers, sailors, airmen, Marines, Coast Guardsmen, or Guardians facing down a hazard and they can't shoot back.
John, from your perspective as a developer from GeoFrame and the projects that you're looking at, what's your view on kind of realistic and achievable access to capital, some of the competition that's in this space as well?
Sure. We're developing a lithium extraction project in Texas, combined with the geothermal power plant. Our total capital need is somewhere around $1.2 billion, and at the end of the day, we'll be producing by 2030 about 83,000 metric tons of lithium carbonate per year. That makes a bit of a dent in the market, and I think alongside other project developers, Exxon, Chevron in the same formation, Standard Lithium in the same formation, and then you've got several parties out in the Imperial Valley in California. Collectively, we can make a real dent and really head off any market pressures in lithium carbonate or lithium chloride here in the United States, right? So we can work on thwarting China's efforts to basically control that market. I think the interesting thing for us is that bolstering that and probably dovetailing on Eric's point is that there's been somewhere between $20 to $40 billion of investment allocated to producing lithium-ion batteries domestically. A lot of them are overseas Korean companies that are coming over, Japanese companies that are coming over and opening up and constructing massive facilities to construct batteries, but it's really to bring everything inside the United States so that we can be adequate suppliers for a defense effort. We can be adequate suppliers for any battery backup for data centers. Or for any other critical uses. We can work on electrification of any mobilization. So, I think from our perspective and the way we will be producing the lithium from deep subterranean brines, rather than any kind of open face mining or evaporation pits or anything like that, I think that really sets up this particular small subset of critical minerals, the lithium production, as I think, moving rapidly forward. Now, can the capital keep up with us? I mentioned a couple companies, Exxon, Chevron, who are extremely well, heeled, and Berkshire Hathaway over in the Imperial Valley, and then you've got people like us who are smaller developer teams, having to really just fight the battle of raising capital, and we don't have the luxury that some of the balance sheets have of saying, we'll figure that out down the road. We got to figure it all out now. So, and what I'm referring to is every single risk, right?
I want to ask Eric a follow-up question, and then Michelle, I'll come back to you on kind of policy and regulatory realities. Eric, when you work with clients and companies like GeoFrame or others, how do you help them, or how do you think about strategic alignment with their investments and their project development with government goals, with Department of Defense opportunities to access capital?
Thanks for the opportunity, because in my previous remarks I talked about the strategic moment, but how does that actually work? And that's probably the most common question I receive on a day-to-day basis.
I think it was a good, unique question.
It's the most vital question I will answer today. And
thanks, Eric.
Nice recovery.
my colleague and my friend here.
Really smooth recovery.
No, without question, because Congress has given the department $200 billion. Like, they've got this extraordinary checkbook. The Development Finance Corporation is probably going to be reauthorized. I think it's $75 billion. The Loan Programs Office, Department of Energy has, I think it's $45 billion ticket right now. There's all of these different funding programs, and the intent is collectively aligned. How do you access it? And we're going back into a playbook of how do federal credit programs work. Most of this money is in federal lending. It is not grant money, it is not direct purchasing, although that does exist. The principal opportunity is identifying projects or transactions like the East Texas lithium project that John's talking about, that have a discrete time-limited need for capital source. They are aligned with the overarching strategy that the Pentagon has set out. They match the investment targets that Congress built in for these programs. And you bundle effectively a strategic problem, and both Michelle and John have been outlining that. It is a broad-based critical mineral, critical resource shortfall, from rare earths to lithium to magnesium. There's a host of critical warfighting components that are not readily sourced in North America or allies or partners. So you identify first a challenge. The second component is you propose a solution. Like, again, John just mentioned, we have a $1.2 billion project in East Texas that can effectively cure America of its lithium shortfalls. Like, that is a major opportunity to present to the Pentagon. And then the third component is where counsel like I become involved, because there are regulatory requirements, there are statutory obligations that you have to meet. And I've already hinted at a couple of them. You have to demonstrate alignment with the Pentagon mission. You have to hit one of Congress's express technology targets. If you're interested in the list, it's in 10 U.S.C. 149 F2. There are 33 separate technology targets that Congress instructed the Pentagon to pursue. This is not the Pentagon just riffing on its own and saying X or Y is interesting. The House and Senate Armed Services Committee said, no, this is where this money is going. So Congress gave the Pentagon a checkbook, and it gave it a pen, but it's sort of like one of the pens that you would get at a bank, in that it's attached to the desk. There are limits to the employment. And when you come together with this sort of trilogy that I just outlined of national security crisis, company with an innovative solution, and then regulatory and statutory alignment, you can make a compelling pitch to these institutions through applications or through more, let's call them less formal means of petitioning your government, and you can try to be considered for some of these funding solutions. Like just yesterday, the White House and the Pentagon announced a new, I think it was $35.6 million Defense Production Act grant that's going to a mining company, British Columbia based, but operating in Alaska. Back in July, there was a multi-part transaction that the Pentagon launched around the MP Materials Company, $400 million preferred stock purchase, $150 million direct loan, commercial offtake agreements, and a couple of other ancillary functions. So these transactions are happening. It's not just theoretic at this point. But to tie this all together, that $200 billion checkbook is still broadly untapped. And Congress is going to be kicking down the doors of the Pentagon to expend that money because it expires in 2029. So we at our firm are trying to help accelerate the process as best as we can.
John, what bottlenecks or obstacles are you seeing today, consisting of permitting, other tech risk, other investor considerations, and then I'm going to ask Michelle to follow up and solve those.
Sure, I think it's incredibly local, right? So when you think about permitting in Texas is a little bit easier than it is permitting in other places. You think about projects in the Imperial Valley, indirectly. I'm speaking just direct lithium right now.
Yep.
Okay, so I'm just kind of really dialed in here, as opposed to every other speaker who's talked globally. I'm talking very locally. So other, like the Imperial Valley has had lawsuits from all sorts of different stakeholders that are basically stopping some development. Texas is a little bit easier. We aren't on BLM land. We have private lessors. And a lot of this is relationship driven. If you are spending time with your lessors and your landmen who are the face of your company are treating everyone with respect and integrity, and we get to know the local community, and we're talking to the mayor and the county and the governor's office, that all helps remove the regulatory issues because you can get ahead of them, you can meet with people. We've met many times with the Texas Railroad Commission to make sure we're going down the right path. And we talk to the city manager about every week. So those types of barriers can be removed. What becomes a little bit more of an issue, and Michelle cited this, some of the issues around technology. We're at a stage with direct lithium extraction where we're really pushing all of the technology to come along with us, right? So we're dragging them along to help our developments here. I think for certain buyers or certain investors, without having many plants operational, that's a real hurdle, right? So you got to look for folks who are a little bit more sort of down the risk spectrum, perceived risk spectrum, from sort of classic infra who wants to do bridges and roads and projects like that. So you want someone that can, take a little bit of risk for ginormous returns.
Can I follow on
Yes.
directly? Because this is really the essential problem. What is the right way to de-risk projects so that you can go forward? I mean, everybody's got ideas and we have different approaches. When I think about what's going on at DOD, what went on before at DOE, Eric, your points, the identification of projects and things like that. I mean, we are a policy house, as our pal Adam pointed out, and one of the things we all get hung up on is the idea of picking winners. And the onus back on government is to be able to make judgments about the technical risks in projects that we, the taxpayers, are de-risking. This is a big dilemma that I don't have an answer for it, but I think this is a fundamental part of the reality check that we're in and the conversation we're in today that really needs rethinking. How do you do this the right way without exposing taxpayers in ways that you don't want to? And I think that's political discussion that needs to be had. I don't think we're having a national conversation about this the right way at all, really. And I worry about that a lot. I also don't think, when it comes to the permitting issues, I think everybody's been focused on certain things. I don't think we're having the right conversation, a fundamental conversation about how really to ensure the public interest. So a lot of the mining industry, not so much on the lithium side, but a lot of other parts of the mining industry are exposed to a lot of things at EPA that nobody is talking about. So hazardous materials, Superfund, toxic substances, et cetera, Rachel Model and I talk about this ad nauseum all the time. What is the right way to ensure the public interest given the nature of the businesses and what you're trying to ensure public integrity around? It's really expensive. It is really, really expensive. And for big things that we're not talking about at all, how do you get Americans to accept new smelter capacity for metals, copper, aluminum, or even lithium processing? How do you move forward on that? Because it doesn't do any good to produce the minerals concentrates and not be able to process them. We're already doing that. We're shipping everything to China, nearly, and people just don't realize that. So if we really want to turn the tables, this is what we have to think about. It's the midstream of the mining industry that is the biggest bottleneck. A lot of what goes on at EPA and filters down to the states is really an impediment to being able to move forward in a cost-effective way. So we don't want to give that up because we want to ensure that the public interest is met. Well, we've got to figure that out because it is a specific capital market hang-up on a lot of stuff that people are trying to do. So I think I just made it worse. I don't think I made it any better, except that we're certainly interested in engaging on these if we can get conversations, how do you do de-risking with a level playing field to knowing the development curve, the typical development curve from idea, through early funding, Series A, B, C, whatever it is, IPO, how do you get through that for projects that are high integrity projects? And then what do we really have to think about in terms of those regulatory barriers, how they operate currently, how they were formed, how they exist, how do we really reform them and move forward? Those are my worries, I guess.
Any comments around policy shifts in particular? Our keynote speaker who was supposed to be joining was planning to join and has, you have some thoughts to share on her behalf?
Well, yes, and so obviously Assistant Secretary Leslie Byers is not on the stage, and she couldn't join virtually, unfortunately, because of the shutdown, but she sends her greetings. I was really lucky to have quite a bit of time with her last week. There are ideas out there of things that can be done, and a lot of them are in the private domain. Rebecca had asked a question about, like the equivalent of low-hanging fruit. Probably John and Eric will have ideas to add to that. But we've got locations in the United States where people are actually trying to get through Superfund remediation sites that can yield multiple commodities. Things that we're interested in, like cobalt and nickel and germanium, gallium, that are in waste piles, in locations where, if we could get to this, we could do it. None of those projects tend to make it into the conversations enough, not the way they should. One of the ideas that we've kind of been debating, get different reactions to this, is whether the federal domain can help specifically on the midstream side. So if you look at all of the folks who have ideas about how to extract lithium and other minerals from our brines, they need processing hubs. Right. Can you locate processing hubs on federal lands in ways that serve the private risk takers? That's an idea that's under discussion, and we're happy to help move that along. It doesn't get you off the hook in terms of permitting. You'd still have to go through that. That's the caution I get back.
Are there any particular kind of hidden gems in the U.S. that you think could be rapidly converted into next generation processing hubs?
There are, but I'm not going to specify that. Actually, Gabe Collins and I have been debating some locations. I've been testing some ideas with various folks, just to kind of see. But there are some interesting locations. We have got federal real estate on both sides, not just DOI, but also we've got it at energy. So we've got a lot of energy sites, Department of Energy sites that we could look at. We've got federal power authorities, the old FPAs. We can look at those administrative sites. There's a lot of stuff out there. Military bases, artillery ranges, for the folks that really want to be adventurous and thinking. There are a lot of things that just aren't getting scrutiny now that we could look to help try to, come up with a way of providing some
John, did you have a follow-up?
Yeah, from our perspective, the projects that I've referred to on the lithium extraction are not just extracting. We will process. Mm-hmm. And the critical things there are, what are we able to recycle? Yep. So if there's water usage, we can actually use our brines and desalinate our brines to then use it for the water and then re-inject. Mm-hmm. So we're turning our lithium extracted into lithium carbonate, which requires a number of chemical reactions. We will produce all of our chemicals on site, mm-hmm. And use them and recycle them and reuse them all on site. Mm-hmm. So it's pretty tight.
And I think actually the interesting thing is on the brine development side, it's a different thing. Mm-hmm. It's a different part of the business than the metals, the traditional metals. Bit more option there in terms of what you can do and how you can think about doing it, and private land.
Yeah, well, it's a closed facility here of over 40 acres, and then we'll be developing probably 10,000 acres with 5 1-acre well pads.
Yeah, I think it's fair to put on the table. Last year we had a really interesting panel. Geopolitics was on it, but also SLB. So to the extent that people are looking at potential technologies that are downhole for separation, that's a footprint management technology that could be done. In situ mining, This has been, you know, a holy grail for the mining industry for a long time. There's a more serious look at that, especially in light of some of the copper incidents that are out there.
So when you, and Eric, maybe this is also a question for you too, as we looked at, as we've seen, you know, opportunities for fast tracking certain key projects, as we look at, you know, bottlenecks related to federal permitting, Michelle, you know, where do these, how do you reconcile you know, opportunities to move key projects forward, and how do you also at the same time move federal permitting forward and move these projects?
One of the challenges with the tool set that Congress has provided departments and agencies in the federal government is that federal credit isn't particularly nimble.
That's right.
It is a laborious process that is best designed for companies or public utilities that are tech readiness level 9, MRL 9, mature, existing commercial offtake agreements, that they have multi-year operating histories, they've demonstrated sound profits. The federal underwriters who are looking at the loan borrowers want to find pristine borrowers, that they see their balance sheet as an example of their own good judgment. They do not want losses on their balance sheet. And that's honestly a reflection of responsible stewards of taxpayer money. But if we go back and use the National Defense Strategy of 2018 as sort of an institutional, organizational anchor point, we are in a period of geopolitical crisis, and long multi-year underwriting processes or NEPA reviews that extend 18 months into a project's timeline won't help us reconcile the amount of spending that Congress has authorized with the end states that the United States, its partners and allies have to achieve. So without coloring too far outside the lines of just a private sector attorney now, not a policymaker, there are a couple of additional features that could be introduced into this environment that would ease the burden. If you made me the head of the Office of Strategic Capital for a day, or put me at the Economic Defense Unit, which is a new institution at the Pentagon, I would look at two new financial instruments. The first being a form of venture debt, so to speak, that is a combination of an equity stake, probably in the form of a warrant, and a higher interest rate loan that can go to less mature companies and can be commoditized. That I'm a emerging companies and venture capital attorney sort of by training, and there are tools in this environment that are designed to absolutely suppress legal burn and time spent on getting necessary capital to companies so they can execute. So you can do a simple agreement for future equity in an afternoon rather than it taking 30 days to negotiate, or 60 or 90. And there's value in speed. And if the federal government wants to move at the speed of crisis, it's going to have to embrace products that are a little more hazardous to employ. So rather than the Office of Strategic Capital or the Defense Production Act Title III team just doing discrete equity purchases or just massive loans, you would come up with some sort of a hybrid instrument that you can give to companies that are operating in these technology targets. The second component, and I think what would actually be decisive, is going to be a tough sell to Congress. But if you truly want the Pentagon in the business of de-risking technological development in this field, critical minerals sourcing, processing, if you want them operating around strategic maritime infrastructure, or any of the other technology targets that are out there, the government should serve as a guarantor for commercial offtake. That I had a conversation with a colleague who's in the media, well-placed, monitors this stuff closely, when I took the job at the Office of Strategic Capital a couple of years ago. And he likened it to me taking a bucket of water and throwing it into a pond and saying, well, you've made the water a little wetter. And he was making fun of me, and it was justified, but the basic idea is that the United States doesn't have a capital problem, that there are trillions of dollars looking for homes, and that savvy investors are not going to discriminate against something that's defense-oriented. They're not going to balk at investing in lithium because of some cultural gap. They're concerned about the financial hazard that's inherent to it. So if the Pentagon wants to encourage investment, it should be looking at options contracts or offtake agreements that extend beyond the length of commercially similar instruments. And if the Pentagon wants to commit cash that way, so that a company like John's can go to a private sector underwriter and say that I have an agreement with the Pentagon for 20,000 metric tons per year for 6 years, and this is authorized by the Defense Secretary. That is a form of federal intervention that will shift the market in a way that I think will be longer lasting than just extending the occasional loan.
But should you have a competitive process for that?
Yeah, absolutely.
I mean, we've seen, to Eric's point, we've seen this, and we talked about it. You look at, the case of MP Materials is demonstrating that if you do get that relationship built with the Pentagon, others will follow. So, the more important point for them in terms of rare earth magnets was the commitment from Apple and GM, not just the Pentagon. I mean, those were the key things.
And what you would need is like a rigid architecture of ethics inside the Pentagon, but you would also need Congress. The House and Senate Armed Services Committees have an extraordinary oversight responsibility, and they didn't necessarily want a $200 billion investment fund. Like, believe me, I saw the emails. They really wanted nothing to do with it because it's outside their remit. And understanding how a federal credit program works is a skill set that's typically resident at like the Energy Committee. Senator Barrasso's staff knows this stuff better than anybody. They are true professionals on it, but that, like Senator Reid's staff, for example, at Senate Armed Services just didn't have it in their back pockets. So robust Article 1 oversight over Article 2 disbursement of these funds is ethical, responsible, constitutional, and it'll probably lead to better strategic outcomes for the U.S.
Michelle, anything you want to add on permitting and how we fast-track these processes once we have the capital?
Yeah, I just go back to the question that I raised about whether we're really having the national conversation about this the right way. What do we need materials for? What uses? What end uses? John will sell lithium products to make batteries for anything. The national security argument is rather clean, actually. It's a lot easier than the fuzzy sort of energy future stuff that we're all struggling with, right? But that lithium battery material can go into mobile power for armed forces. Well, that's a pretty easy, chain to follow in terms of application, as opposed to, gosh, how many automakers are really going to make commitments to electric vehicle production without subsidies, and can they survive that transition process over what time period? I mean, that's really hard to get your arms around. But the direct deployment for things that matter, and along with that, you might prove up stuff that proves useful on the civilian side, right?
Right.
I mean, that's
yes, absolutely.
Kind of the key thing that we always forget. I guess, how do you build that national conversation? So what people point to all the time at the local level, and Rebecca knows this from her experience and everything she's done, you look at the benefit conversation around projects. What are the needs? What are the wants? How does the mining industry solve that? And how do you manage the expectations around it? That's actually a really big deal. What we often look at, because it comes down to that, is employment. So jobs and jobs creation, business opportunities, procurement, all that sort of stuff. And when we look at the extractive industries overall, oil, gas, minerals, timber, for that matter, you get these robust communities, clusters of the primary operators, their vendors and suppliers and everything else. I wanted to correct something that I heard yesterday in all of this. What we do see are growing efforts to figure out how to link more directly those benefits to the operations in places where people are trying to move forward with projects. So that's very constructive. A lot of it rolls back to education. We haven't lost mining education in this country. We lost the jobs that people educated at mining schools were going into. I mean, this you're not going to educate a kid and send a kid out to work in an industry or a business that doesn't exist, right? So any of the mining schools, I'm a Colorado School of Mines alum, they want to see their kids get the best jobs wherever they are, whatever industry it is, and be good alumni and send donations back to mines, right? Who doesn't want that? Rice has great science and engineering programs, and our graduates can end up anywhere and working in any industry. So there's been like this heartthrob idea out there, the Mining Schools Act, that I actually don't support because I think that's not the right way to think about this. What you have to show to your local communities is how it works. So back to kind of Eric's point on the Pentagon side, go down the funnel, you're in a local community, how do you build and communicate that benefit statement so that you can win durable support? Because at the end, what really matters is financial sustainability of the project, right? Then we don't have to worry so much on the taxpayer side if we can get to that. So part of that equation is helping people understand what needs to be done, how it needs to be done, how it could be done. And there's some really, really interesting demonstrations out there for people who are interested. Follow up on that.
So a question for each of you then. If you were to paint the picture, what does an optimal or progressed U.S. critical minerals supply chain look like? We're talking about the complexities here. We've delved in deeply on each of them, but what does progress look like in 5 years? Don't jump in all at once.
I'll take it first. Again, narrowing down on our specific little corner here, I think we have a robust supply that is, between the Smackover Formation.
Certainly a robust resource.
But I think we will have a robust
supply.
of
That's your prediction?
lithium carbonate.
Oh boy, okay.
Yes. By 2030, we'll have a robust supply of lithium carbonate that will likely answer the question of where's it coming from in the United States. I think we have the capability between the Imperial Valley and the Smackover to basically supply everything the United States needs in lithium carbonate.
Now, my concept of success in 5 years would be that programs like the Office of Strategic Capital get wound down. That ultimately, and to a point that I made earlier, like the availability of capital in the United States is not a problem. It's having a reconciliation of investor intent that can back the kind of projects that the Pentagon forecasts it will require to win the wars of 2035 or 2040. And the standoff by and between American investors and the Pentagon that sort of erupted in a couple of incidents in 2013, 2014 or so, I think that is broadly faded. That it's obvious that American or international investiture in mining and energy and the broader defense industrial base is perfectly viable. And programs like the Office of Strategic Capital may have been more successful at breaking more of cultural ice than actual shifting of economic fortunes. And it may be that the Pentagon finds that just having a few options contracts to guarantee that enough explosive precursor is on hand in the future is all that you really need, and that you don't need the Pentagon determining which mining project in which state gets the thumb of the federal government put on the scale on its behalf.
Do you want to weigh in? Or my next question is really of all to each of you. What are all of the levers of all the levers of permitting, of policy reform, of DoD support, new capital models? Which one has the power to unlock the most progress?
New capital model. Yeah, we need a new capital model. I mean, I think when you look at the amount of capital available through infrastructure funds, through PE, through family offices, it's remarkable how much capital is available. Brookfield closed a $20 billion fund yesterday. It's a lot of capital. And so, I think sometimes a lot of those firms get a little too caught in looking to have everything drilled down, every risk. So what happens is you end up sort of in an LBO type model for some of these assets. They just keep retrading. And meanwhile, you've got new projects that are ready to come online, but there's a risk here, a perceived risk there that hasn't quite been ironed out. Yet the thinking in the capital markets is so parochial that they can't quite come down to think about what Eric was talking about earlier, a sub-debt with warrants, right? But for a meaningful chunk of capital, just a higher yielding debt piece that has, a few years of PIK interest and then, warrants attached to it, because these projects can reap huge returns.
Michelle?
I think John said better what I tried to say earlier, which is rethinking the business, rethinking how you de-risk, rethinking how you capitalize the industry. What's a better, more robust way of doing that? So I think you articulated that really, really well. But I want to put something on the table that kind of goes to the previous one, where we have the same problem, which is, accessing capital markets and moving things through without dying in the valley of death. Value of carbon. So last year, we raised that on our minerals and materials panel. Some of you, whoever was here, you heard about that, the Rice invention in that space, carbon nanotubes. We had a demonstration outside. What I'd like in 5 years is to figure out how to capitalize materials inventions that would completely just change paradigms. So if we're worried about copper, aluminum, and steel, I can see us delivering that out of our advanced carbon products. But we've got to get some airtime on this. Again, John's lithium products can go into any device. If that device can take advantage of new materials in order to perform better, why not? But boy, it's hard to talk to people about this one. I mean, this is really, a big challenge. But on paper, what we can see is that we can solve a lot of our worries on the metal side with products like this, with advanced materials like this. So why not, for crying out loud?
Eric, anything else you want to add on this? And then
it can go into Kevlar too.
Sure.
It'll replace Kevlar. You'll lightweight our armed forces, and they'll get more mobile power.
Yeah, there's nothing the infantry likes more than having their weight decreased.
Yeah.
Then you can give them an extra 60 millimeter.
I can lighten the aircraft. Yeah. I can do all kinds of things with it.
John hit on what I think are two planks. The first is, if the Pentagon is going to be operating in this space, they have to get more creative with their financial instruments. And that would be a form of venture debt that includes warrants that enables them to operate in a greater variety of industries with a great and sort of wobble a bit on company level maturity. But I think what changes the entire dynamic, again, assuming that the Pentagon is going to continue to operate in this space, is commercial offtake agreements, longer term options agreements, the Pentagon being a guarantor of lithium purchasing or of gallium or of rare earth elements, and doing it in the spirit of national readiness. The Defense Production Act Title III program has been in statute for decades. It is not new, it just has to be funded accordingly. And you can turn that into a unique financial instrument that companies like John's, if they receive this, can then take to the major financial institutions of America and say that, hey, we are not an underwriting risk. We have this commercial offtake agreement, and it is fully backed by the full faith and credit of the United States government. And that's transformational in a way that I think direct lending is interesting. Commercial offtake agreements solve your problem.
This has been an excellent discussion on thinking about the complexities, strategies, innovative and thoughtful approaches to addressing some of these challenges. Michelle, I wanted to get more of your thoughts, specifically at the Baker Institute, about the work you've been leading in global scenario planning, wargaming, minerals supply strategies. Take a few more sips of water. I'll keep talking to lengthen this out.
But we need to finish up anyway, right?
Exactly. So this is your opportunity to plug the work on wargaming that you've been leading.
Oh, yes.
So
Houston
give me
in the
one
fall,
emerging
and the
insight
spring,
from that.
and the summer. But
one emerging insight from wargaming and at the Baker Institute.
Of which Eric is a fan. He already said that, right? So we've had some brief and I hope more exchanges on that. I want to call out our newest non-resident fellow, or close to that anyway, Gabe Barrington back there, who, among other things, is an active duty colonel in the Air Force and a war game specialist in the Air Force. And what happened in this is we started a conversation. Those of you who were here for our forum on June 5th know this. We want to borrow from the wargaming tradition to deal with the complexities that we've talked about on this panel. We all think it can be done. We just have to figure out the specifics in terms of our approach, our strategy, and all of that. But I want you all, before you go to lunch, this building, in many respects, resembles one of the more famous war rooms war game rooms out there at the Naval War College in Newport, where D-Day and the Pacific were both vetted during World War II at the charge of Admiral Nimitz, good Texan that he was, citizen of Fredericksburg, who led the idea that, in fact, you can game out excruciating complexities like this. You know, how to go into very sharp conflicts and win. We think we can do it on these issues that are, you know, commercial in scope but have overtones for economic security, national security, and other things. We have believers among our advisors, Gabe and the many others who have been participating with us as guinea pigs as we work through all of this. We actually ran a roundtable on Monday. We did 2 scenarios, copper in Central Africa, that's a challenging one, and aluminum. And then on Tuesday morning, everybody woke up and read about the outage at Novelis in an aluminum fabricator, basically, which supplies about 40% of aluminum to the market for auto manufacturers. And Gabe's first question about that when we talked about it was he's got these T-7s that have to get delivered to the Air Force to train pilots. About 15,000 pounds, I think you said, and about 8,000 of that is aluminum. So which way will this go in a supply chain disruption like that? So the idea is to be able to capture that here in this building with its tradition and be able to use it for a continuous dialogue. That's what we really want around not just the minerals and metals issues, but also on energy. Like I said, we've got fair game in the oil markets that we can look at, plastics and the challenges on managing plastic waste and other things that everybody around here is working on. So we're taking a stab at it. Stay tuned.
Yeah, it's excellent work you've been leading. So thank you all. Well, with that, we'll wrap it up. Let everybody go to lunch. Thank you. It's been a great conversation.
Thanks, Rebecca.
I don't know if my mic is on. Is my mic on? Good. All right. So I guess we can get started. So I'd like to introduce our illustrative panel here. To my left is Thad Hill, the Executive Chairman of Calpine Corp., a distinguished leader in the energy sector. Thad brings decades of experience in the wholesale power sector. He's been at Calpine since 2008. Prior to that, he held senior roles at NRG Energy, Texas Genco, and Boston Consulting Group. To Thad's left is Dave Barry, the CEO and co-founder of Cloverleaf Infrastructure, where he is pioneering the creation of clean-powered, ready-to-build sites for large electric loads. Before this, he served as the first county administrator for Harris County, Texas. Dave's career spans leadership roles in renewable energy finance and strategy, including at ConnectGen, Cleanland Energy Partners, and EDPR. And to his left is Dr. Peter Hartley, the George A. Peterkin Professor of Economics at Rice University and a Rice Scholar of Energy Economics at the Baker Institute. With over 35 years of experience in energy economics, Dr. Hartley has contributed extensively to research on electricity, natural gas, oil, coal, nuclear, and renewables. And his academic work also includes banking, business cycles, and international finance. And least interesting in the group is me. My name is Michael Yuffie. I'm a partner at Baker Botts in the DC office and the head of our energy regulatory practice. So topic of our panel is infrastructure reliability and resiliency in electricity markets. Simple, not complicated, very specific, very narrow. Yeah. But yeah, obviously we're facing significant changes in the energy sector, electricity sector. We're facing significant load growth, particularly large loads like data centers and crypto mining, looking to interconnect and do so quickly against the backdrop of aging transmission and generation infrastructure in the country. There's also significant headwinds on our ability to develop needed infrastructure, such as in the form of supply chain issues or interconnection issues, transmission planning, also unprecedented political and regulatory risk. How can we meet the moment, gentlemen? That's really where we are. So let's start with, what would you say are the biggest impediments to investment needed to address the current situation? So I'll start with you, Thad.
Well, and I will answer the question, but there's an underlying, thought that you had, which is demand is growing quickly, and it is growing quickly, and we all have to realize that. This year, I think it's probably 2% in the United States, which after 20 years is zero, is a big change. But there's some things going on that actually are really interesting, such as ERCOT this summer. I'll just lay this out. ERCOT load was up 4%. Peak load in ERCOT was up 0% because of price responsive load. There was a Duke study that said you could, and the US power system has about 550 gigawatts of average load, that you could add 100 gigawatts of load, and as long as that 100 gigawatts is only to curtail 45 hours a year, you didn't need to add any new resources. So I do not mean to minimize the challenge. There is a challenge. We need new transmission, we need new generation, but I also think there's some countervening forces at work, which is for the first time, I believe, in history, we're having real price responsive load that's making a real difference. And so why don't I'll pass on the rest of the question. I just, since I kind of attacked the underlying premise, but we do need real new investment, but I think we also have to be sober and thoughtful about how we frame the problem, because it has been, I believe, overstated in many cases.
Well, interesting along those lines, for example, we just saw AEP that slashed their load growth expectations pretty dramatically, much of which was data center focused. But so, I'll turn to you next, Dave, and ask your view on this issue, and you can maybe start from the load side and then.
Sure. Yeah, absolutely. And look, I would say on the topic of data center growth, like the top end expectations and headlines are massively overstated, but the growth itself is real, right? I mean, we know that on the order of $700 billion of capital expenditures are going to data center growth in the country, right? Yep. So what does that translate into US electric load growth? I think it may end up being more like 3%, but regardless, you're in a 2 to 3% range for the time being. But we've been at 0% for a very long time. And okay, there are so many ways we could go with this narrow topic that of this panel, but maybe to build on a couple of comments. One is getting more out of the infrastructure we have, right? And our infrastructure, particularly in electricity, is massively underutilized. Part of that, as Thad mentioned, is having loads curtail their usage for the limited times that they are contributing to a particular constraint on the transmission system, or there's another generation outage, or the things that happen somewhere between 0 and 10 hours of the year, right? That is getting more out of our infrastructure. It's also finding ways to combine technology at existing power plants, to upgrade power plants, to weatherize the power plants we have. There's a lot we can do. But at the same time, there is a very fundamental issue of it is too hard to build new infrastructure, right? And if one wants to frame this in the global context, and it's more complicated than this, but if you say, all right, on the topic of data centers and artificial intelligence, the US's competitor is China. That is a place that is incredibly easy to build things. And whether it's local permitting, state permitting, an interconnection queue, oscillating federal policy, the failure of Congress to enact permitting reform for forever, nearly forever, it is just too hard to build things. So I think that, this is going to take a lot of solutions, but I would throw out as some initial thoughts, getting more out of what we have and making it dramatically easier to build new infrastructure. And a lot of different kinds of infrastructure will be needed.
So before, I'm going to kick it over to you, and I do want to start with the load issue, because both of you are correct. One question, though, is the nature of the load, right? Yeah. Where you're seeing in a span of 9 to 12 months, you can see 1,000 megawatts of load appear out of the clear blue nowhere, and that is relatively new in terms. Yes. And does that play into this? Obviously, it plays into the hype, but does it have a meaningful impact from an investment perspective or infrastructure development perspective?
So I think one thing about the data center load is it's 24/7 kind of load, and so that makes it difficult when we got generation that's intermittent. And so one thing we've found in ERCOT is that there's been a lot of a retirement of dispatchable capacity. There's been dispatchable capacity added, but with the retirements, essentially dispatchable capacity has remained fairly flat in recent years. A lot of the growth has been in the non-dispatchable. So sort of trying to match that with a load that's relatively constant, there's a bit of a mismatch there. The other thing that Ken and I have just been working on we looked at the ERCOT system in some detail, and one thing we've discovered is that about 80% of the time there's at least one transmission constraint binding. So there's sort of a lot of transmission issues, and part of that is, again, a lot of the capacity that's retiring is near loads, but a lot of the capacity that's being added is remote. And so one thing we found is an increase in wind generation, for example, or wind generation matched by backing out thermal, substantially raises the probability of a transmission constraint. And also, I mean, this is also a factor in sort of going back to the very first session, Scott's presentation yesterday. He's talking about levelized full system costs. I mean, part of the issue there, people talk about having to provide backup system and also things like ancillary services, frequency control, voltage control, and so forth. But another thing we discovered is as a result of transmission issues, often you have to handle the transmission constraints, you're loading the dispatchable capacity out of merit order. So it actually means that you'd think that if you added zero marginal cost generation, you're backing out positive marginal cost thermal, there should be a big reduction in the energy price, the marginal energy price. But in fact, we don't really find that because you have a lot of this out of merit order generation to handle all of the constraints. So I think that the transmission system is a big issue.
Could
Yes.
I want.
Are we going to disagree about this topic? It could be interesting.
Yeah,
Could be the first one.
no, look, we do need to do transmission investment, but I think ERCOT's a great case example. It is true there's new transmission needed. It is true we need new generation, but our business is in the competitive environment, and I believe that that we should limit, unless you absolutely need it, anything that's a non-bypassable charge. Because I believe a lot of what we're seeing right now is massive innovation. There's pricing that's different wherever you are, and there's higher pricing inside load areas than outside load areas, which should encourage new investment. The more money on a large industrial and commercial bill that you have, that is what's a non-bypassable charge, transmission, you can't avoid it, the less reason there is to innovate at the customer premise. And so we do need more transmission. I absolutely agree with it. But it's not the only answer to these solutions. It's a part of the answer. To kind of talk about ERCOT directly, load this summer was 85,000 megawatts-ish, peak load, which was the same, actually a little below what it was last year. You can debate how much new load we're going to grow over the next 5 years, but I think probably 25,000 megawatts peak load is a reasonable assumption. We got zero year over year because of price responsive demand, but some number. If you get 10,000 megawatts of generation, which is part of the Texas Energy Fund, if you actually have more price responsive load, which you do, and a big part, because of solar and storage, we've solved the summer issue, I actually think ERCOT's going to be just fine. We absolutely need to solve some transmission constraints. I'm not denying that. But I actually think we have to be very thoughtful. The more that you actually put non-bypassable charges in, the less room there is to actually let price drive investment, and the less the room there is for investment at the customer premise, which is really where I see a ton of change coming over the next couple of years.
So you've both discussed ERCOT as a good example. Let's go outside of ERCOT, because ERCOT's special, right? It's a single state RTO. It's a lot easier to actually get things done when you don't have parochial interests, competing parochial interests from neighboring states. So let's pick the region we were talking about earlier. PJM is a good example. In PJM, do you see the same ability to meet the moment through again, trying to minimize non-bypassable charges, when you have a number of utilities that would love to see a whole lot of transmission investment because they get to put it in rate base and earn a return on it.
Well, can I actually answer your question in a different way?
Sure.
So yes, there are more politics and more complexity in policymaking in a regional transmission organization that covers so many states. It started as PJM, Pennsylvania, Jersey, and Maryland, and now it's 7, 8 states. It's also a lot easier to build things in Texas. And we have the fastest, most effective interconnection queue in the country. It is a lot easier to build resources of almost any kind than I would say anywhere in PJM. That could be new natural gas, it can be solar, it can be storage, it can be wind. I would agree more with Thad that variable renewables and storage can solve part of our problem, right? Not all of it, but in the summer, a large part of it. And PJM, meanwhile, has a 5+ year huge backlog of projects and all sorts of permitting failures, right? So I think we're seeing other things too. But both markets have price signals. Actually, both markets, imperfectly, are sending price signals, we need new stuff. For those price signals to work, you actually have to be able to build infrastructure. And if you can't, the price signals don't matter, and all they do is drive up costs. So I think that there's more to the story, for sure, but that is a big part of why Texas is being more successful in responding to prices, to build new things, and make more use of what we have, and you're seeing it much harder elsewhere.
One thing I'd like to come back to in terms of the transmission charges, and again, this in the ERCOT case, I mean, we don't have marginal transmission losses in the locational marginal prices.
Fair.
And so this is, I think, is a significant issue in terms of sending the right signal for where you locate both generation and large loads.
So what that is, or do you, I don't know if everybody out here knows marginal transmission losses. It's a really important point. Do you want to,
yeah,
or you want me to, go ahead.
Well, so the idea is, when you transmit the power, there's also a loss, in doing that. And if you had, at the moment we have these locational marginal prices where you have different prices at different locations on the grid, but the locational element at the moment only signals a transmission constraint. But even if there's no constraint, there's actually a loss along the line. So the prices should differ to reflect all of those losses in addition to the impact of constraints. And if you don't have locational marginal prices reflecting the losses, you're not sending the right signal as to where to locate generation and large loads.
So to say it exactly that, in every other market, the generator pays for the transmission losses based on where they're located relative to load. In Texas, they just upload all of that and it gets divided over all the customers. So it changes incentives about location. And that is a big deal. And there was a particularly tough PUC battle over that probably 7 years ago, where there's a lot of intramurals going on, but ultimately those things were kept out of the system.
So I'm going to bring this back to the large load issue because picking up, Dave, on what you said, you're correct. It's outside of Texas, it's incredibly hard to build transmission, to build generation. But I'm living in Washington, D.C., and Northern Virginia is the data center capital of the world. And there's still a lot of development of data centers in Northern Virginia, as well as in Ohio, Pennsylvania. But you can't build the generation, and when you look at the pricing of just buying on the market, that doesn't necessarily prove to be economical. And so what you're seeing is a lot of what we call behind the meter approaches of trying to build generation that is isolated to serve load.
That's a really bad idea.
So let's talk about that.
Well, I mean, it goes to cost and reliability. It's way more expensive to build islanded, no doubt. But even more important is your level of reliability. We've all seen a lot of power plant availability reports on this panel. Thad has one of the more reliable fleets at his company, and they don't operate 99.9% of the time. It just doesn't happen. You're trading, you never get off the grid. You're trading one grid for another. So would I like to be part of a highly network integrated grid that serves millions of customers and has thousands of resources and is operated by companies as imperfect as they are, who've been doing it for 100 years? Or would I like to go build my own and hope for the best?
Yeah,
Not a good idea.
There's a technical point, which for those of you that are power dorks like me, I'm just going to say this, which is islanded operations are really, really hard because of the frequency and the voltage requirements that have to be almost perfect on a grid. And when you have a big grid, you can balance those things out. When you have a small microgrid that doesn't lean on the grid, it's really, really hard, almost impossible. I would say you can do it for a short amount of time, but anything goes haywire and you trip and lose the whole system. So, you need to plug into the grid. This is actually one of the big questions about the Amazon Talon, the AWS Talon case at FERC, for anybody that's following that, is around what is the appropriate compensation, because they're plugged into the grid to help balance that load.
Absolutely. And, I'm sorry, Thad, you were still going.
Well, no, I was
you were on a roll.
Well, no, I was just going to address. Michael said, sorry, as exec chair now, I've gotten a little more careless with my words these days, so I don't get to come out in public this much anymore. But so to address something that you said, is PJM, you can get new power plants built in PJM. I want to address this. There's been some regulatory back and forth in PJM that's made deploying capital there, a little scarier than it has in the past. I am hopeful and optimistic that will be addressed. Capital is flowing in ERCOT to new investment. It's a market you can actually deploy capital in and think you can get a fair shake. I believe and I hopeful PJM will get back there. PJM has had hundreds of thousands of megawatts that have been deployed, invested on investor capital, not ratepayer capital. We've been in a little bit of a lull, and I hope to get back there. But certainly from a permitting standpoint, interconnection standpoint, I actually do believe it's, although not perfect, it's doable. So I don't want to address that there's like a permitting problem like you might have in other jurisdictions or something.
No, but I mean, so from the interconnection perspective, however, part of the problem is on the data center side or the large load side, the need is, it's viewed as an immediate need, right? Try to get ahead, try to get your data center built as soon as possible before, as you say, the illusory load doesn't need to be there. But you can only do that if you've got sufficient generation or if the economics work, and the difficulty is the timelines don't match. So the generation interconnection timeline doesn't match to meet the load interconnection side.
Right, and I think one thing we're seeing, we're definitely seeing a convergence of the energy and digital industries, right? And that's like the reason I have a company. But we also are seeing, I like that word mismatch, a mismatch between the pace of technology and the pace of infrastructure. And I think this behind the meter fantasy in a way is like, oh, can we get infrastructure to move as fast as technology? I mean, and the answer is it doesn't, it's not the right solution. But I do think that's the right problem. And as a sign of optimism, I mean, our country dealt with 6, 7, 8% load growth for a long time. And now we're struggling to deal with 2 or 3. It's worth reflecting, right? What were the conditions that made that possible? What was the social compact that made that possible? And then where are we now? Because this actually is solvable, right? And we have solved it. There are a lot of things getting in the way right now.
I was going to say, I mean, going to the interconnection issue, one of the reasons why we interconnected in the first place was to save on backup, needed backup capacity, right? So that gets to your point. But on the other side, I mean, I think we've seen more recently a lot of these data centers proposing behind the meter generation, simply because these queues have gotten very, very long. And some people have argued that one of the issues is the way that it's first come, first serve. I mean, if you're going to connect a large load or a large generator, you do have to do a study to figure out how it's going to influence flows on the whole network. So, we do have to do these, but there's a question as to whether you should have a first come, first served approach to approving these things, or whether people should be able to pay extra money, something like the data centers, to
Yeah, or a first
jump the
ready,
study.
first serve, right? Which is if
Right.
you're actually, which is related to paying money. If you're actually ready to make a material financial commitment, you can move ahead, right?
We've used a couple of terms interchangeably, which is behind the meter data centers. There's behind the meter islanded data centers, which was what you're addressing. We have a project in Central Texas where we actually have behind the meter data center at a gas plant where the plant is fully connected to the grid. So, which is why I think we'll see more of that. And I hope we do more of that, which is you've already got the grid connection, and you can actually put the facility behind the meter. And I do think we'll see a fair amount more of that.
In my terminology, that's co-located generation rather than islanded generation, right? Which I think in many cases, not in all cases, but in many cases do.
Oh, it's behind our meter for sure.
Yeah,
It's also co-located.
Right.
Islanded, I would have thought meant that you didn't have, you didn't have to have the same frequency and so forth. You're not actually connected.
So what I would say islanded, in fact, working on one right now, is a data center that is completely off the grid.
Right. It's on its own grid. It's still on a grid.
It is
Exactly.
on its own
That's
grid.
right. Exactly.
Right? And with the notion being that diesel backup is probably would be enough to meet, to
handle their own.
Whether it will or it's a different
batteries
story.
too.
There's no meter to
days.
be behind, I guess.
And
Right, no meter.
To Thad's earlier point, you do see major issues with frequency and voltage, and I would offer sort of a gentle different view than Peter expressed, which is that data centers are 24/7 load. That is less true of artificial intelligence training models.
true. Yeah.
There's actually a paper out there by, I think Tyler Norris wrote it, the same point we just mentioned about what if we could curtail loads, that, these data center profiles do change quite a bit, right? And so they impose new ramp rates on a grid. Storage is a great tool to deal with that. In fact, better than thermal generation. But if you manage that in an island, it gets really, really tricky. If you can manage it across a large grid and market, much, much easier. Still a problem you have to address, but much, much easier.
The training models, the power use is much more under the control of the operator, but the inference models, it depends on demand, but they still have to be available to satisfy demand whenever it comes, right?
Absolutely.
So focusing on the word mismatch, part of the problem is there's a definitive mismatch from the regulatory perspective. So let's talk, Thad mentioned the Talon AWS transaction. And there, if people aren't familiar, the Susquehanna nuclear plant is owned by Talon, and Amazon built a data center behind the meter and or co-located, and it was able to, under the existing interconnection, which was conforming to FERC standards, was able to draw, I believe it was 300 megawatts initially, but then when they wanted to jump it up to draw 480, I believe was the number, it became non-conforming to FERC standards. And now we're sitting waiting for an order on FERC's on a proceeding that FERC instituted to address this issue, and we've been waiting for a while. Part of that is politics, right? Change in administration and change in the commission makeup. But that's the mismatch I want to talk about now, which is this regulatory mismatch. Are we meeting the moment from a regulatory perspective?
Yeah, so there's a critical piece of legislation which I think will lead the country that passed in Texas, Senate Bill 6 in the previous legislative session. It was not perfect, but it went a long way towards addressing this. So first off, it does three things. Let me just say what it does without going into more depth. Number one, it says more or less that PUC has to kick off a proceeding because in ERCOT, ratepayers pay for the transmission, and if you're going to start putting stuff behind the meter or in front of, however you do it, there's an implication about who pays for that connection to the grid and how does that cost get shared. And that is a proceeding in ERCOT that's been directed by the legislature that will agree. Secondly, the number of data center megawatts that are in the queue in ERCOT is twice the power demand that NVIDIA is going to deliver in the next 4 years in chips.
You mean it's not all going to happen?
Well, but it's really hard to plan because you got a lot of wood out there where it's not going to happen. And so there's a interconnect queue, not from a power plant standpoint, from a load standpoint, where there'll be deposits made, all kinds of other things to certify what's real, what's not, and to get people focused on the right thing. The third thing that I would highlight in that bill, which is it is obviously politically hard to actually have a reliability event where people are hot or cold in their homes and the data center's turning along. And so the bill actually says if ERCOT declares an emergency, that if it's behind the meter, you actually have to take a power plant like ours and put all the power back on the grid. And if it's in front of the meter, you have to be willing to disconnect. And so that, I believe, is directly addressing a lot of the stuff that FERC is kind of tangled up on right now. And so I'm hopeful that this Texas legislation, and I believe it will, at some level become a model or at least a foil to actually get going. But it needs to get going. This is now driving development in Texas. It's the law of the land, and it's a positive thing for data center development here.
And you see a lot of similar issues unfolding elsewhere in the country. And to boil it down, there's a question of who pays, right? Mm-hmm. And I think the right answer, even though it sometimes goes against my self-interest, is that you need cost causal and incremental cost allocation to data centers. Meaning if they cause transmission upgrades, they should pay their way. If new generation is needed, they need a way to financially sponsor that generation. Now, what should not happen is they should not have to both pay incremental and new costs and pay for the whole embedded system. Like, that doesn't make sense. But people are just not going to put up with effectively a cross subsidy from residential ratepayers to the wealthiest technology companies in the world. They're not going to put up with it. And the other thing they're not going to put up with is power plants that are on the grid now, providing power to schools and hospitals and homes, getting taken off the grid to, or a data center having preference on them, that people just aren't going to put up with it, right? I mean, regardless of what FERC regulation says or current state law is, I just don't think that's going to work. And you have seen, there's this thing called Twitter, and you've seen on Twitter some Texas politicians expressing, what they think if instead of, Thad's power plants still being grid connected, if they went totally off grid and said, we're not contributing to the grid, we're just serving the data center now. I don't think that's a smart strategy.
So one thing you got to be careful about, though, is the interconnection. Part of the point of having the interconnection study is if you build your data center and you put in a new line, it's not just going to affect power flow to your line, it can affect power flows on other lines too, right? So you want to measure those marginal effects correctly.
That gets to my
Absolutely.
point, because this question of who pays and causality isn't quite that simple, right?
Yeah.
Because network transmission, the notion has always been if there is a network upgrade, that will ultimately benefit the entire system. And so, yes, it's think about the concept of building a highway, right? If you build a highway with 8 lanes, even though the projection in the near term is only 4 lanes, you're paying a lot more in the near term. However, it's going to benefit everybody in the long run. And so that's how transmission cost allocation occurs now outside of Texas and in FERC world. And there are transmission owners out there who are looking at this as a real opportunity to add to rate base and to make money, because that's how they make their money, is investing in transmission and getting a return on that investment. And so you might have some competing interest there that could make this a little bit more challenging in terms of how it plays out ultimately from a cost causation perspective.
And I agree the math can be complicated, but I mean, there's still some fairly basic arithmetic you can do, which is a data center actually adds new load. So rate making boils down to cost divided by megawatts or megawatt hours. And if you have more megawatts or megawatt hours, you have a bigger denominator to spread out costs. So I still think you can do some basic tests of, over time, is the bigger denominator compensating for the bigger numerator? And again, I think you just have to do that as part of a social compact and having industry acceptance, right?
But
the second people's bills start going up, because of data center load, and there's a plausible argument. It's going to be much, much harder to develop and build new data centers. And I can say, as someone trying to do that, right, it's essential that it's actually an industry that's welcomed, because you have to build it somewhere. It has to be permitted somewhere. You have to build transmission somewhere. And unfortunately, the difficulty in building things is now coming to data centers, right, in a way that it largely was not before. And so I think, you know, the industry has to be ahead of these regulatory and market and policy issues, or else they're going to be playing defense. And, you know, as they say in politics, if you're explaining, you're losing.
But does that position sort of fail to address, I think, a fundamental difference, which is the nature of residential load, which, by the way, I mean, it shouldn't be lost that the irony of the people who will be complaining about their higher electricity bills will be doing so on their phones and on their computers, which will be which the data centers, which the data centers are feeding. And is there a need to sort of, you know, and I understand from a political perspective, you know, if you're explaining, you're losing, but doesn't there need to be some explanation that we're in a digital world now that is, you know, insanely different than it was 20 years ago?
You know, I think, and by the way, I think this is different on power plants and restructured markets because, you know, the price signals occur and you go through cycles, and this is just part of that natural demand. At least that's the position Texas has taken, and I think we'll get there in PJM too. So it's all about the regulated, the non-bypassable charges. And look, this is going to get sorted. You know, Texas is about to have a rate case. It'll be complicated. There'll be different points of view, and we'll fight our way through it. But we'll have a view here soon. FERC will get there with Talon. I think that you've seen other innovation, which is actually interesting, because if you're a utility, you're like, I got to build out for this data center. You know, typically, by the way, when you hook into a grid, you don't have a contract with the utility. If you burn your house down, you don't have to keep paying for the connection to your house, right? It's the same way for businesses too. In Ohio, they're pushing now that whatever the upgrades are required for a big data center, you've got to do a take or pay contract for 85% of that cost, so you don't end up straining the cost and having them back on other consumers. So this, I mean, this is happening in real time, and I think well, you tell me, you're the expert here, but I think in regulatory time, this data center stuff's actually happening pretty darn quick. Far faster than a lot of other things. So I think it's going to be okay.
So I think at the state level, I would agree. I do think that at the wholesale level, at the transmission and FERC level, it could actually move quicker, and maybe with 5 commissioners it will.
And a new chairperson.
And a new chair, absolutely. Another topic which I'm sure we'll all agree on.
That was safer for me to say than you, by the way. But anyway, go ahead.
I did not gender. So the role of the various fuel types of generation, and how the various fuel types can play a role in meeting the reliability and resiliency needs. So, you know, renewables, for example, you know, can renewables actually help meet the reliability needs of the system?
I mean, absolutely. Peter and I will slightly disagree on this, but absolutely. Are they by themselves a solution? No. But do solar and wind, especially when coupled with battery storage, contribute some capacity value to meeting peak load? Absolutely. And I think you have to do those calculations and do them, you know, in a clear-eyed way. And there will remain a need for existing and potentially new fossil fuel power plants. But this is not all or nothing here.
Yeah, I guess you know, we can take the Spanish experience recently with. So one thing you get with conventional thermal generation and hydroelectricity, you kind of get frequency control more or less for free, right? Because of all the inertia of the heavy rotating machinery. All these things synchronize with each other sort of automatically. When you start to reduce the proportion of that kind of generating capacity on the system, you have to have some other way of trying to maintain the frequency and also maintaining the power flows, reactive power flows and voltage and so forth. And I think there's a lot of evidence now when you start to get big percentage of renewables. Depends partly on how much hydro the system's got, but in a lot of cases above 20%, you have starting to have problems with reliability.
We could argue about this for a long time constructively. It's also the case that solar and storage, through their inverters, have capabilities that many thermal power plants do not. And a big part of the explanation of what happened in Spain is the regulations in the grid operator were not prepared to use those inverters to control what happened. And the US actually has had rules on that for a long time, and so is in better shape. So that's not to say, oh, you can, without huge amounts of storage, go to 100% renewables, but it has a role to play if you get the regulation and technology right, which unfortunately Spain, they're fixing it now, but they did not, in terms of, hey, there is a battery here, there is an inverter here. It could help us with our problem, but we are not prepared to use it.
Look, there's an and here. I mean, you know, you can take heavy penetration of renewables as long as you have the appropriate equipment that is reliable, that does provide the inertia as well as the absolute capacity to the system. And what's going to drive that is how you compensate resources in a deregulated market. And people are working their way through that. Every single major market right now in the US is coming up with new ways of how you count capacity, how valuable is, all megawatt hours are equal. Unless you are, before you talk about environmental attributes, you don't, all megawatt hours are equal. All megawatts are not equal.
No.
Wind, solar, storage have certain contributions. Gas has certain contributions. Non-dispatchable nuclear is other, base load has other attributes. And we need to be very thoughtful about how we design, how these different things get compensated. You can get a good market design. In ERCOT, we're doing that through ancillary services and trying to construct an ancillary service market where you pay these resources that have attributes that wind and solar can't deliver, or even storage, an incremental amount of money in order so that you get the balance right. In other markets, they have capacity markets that are assigning a different capacity value, but getting that right is going to be important, and I do think you can get it right. By the way, just to tell you what the numbers are, these are EIA numbers, which I happen to think are probably reasonable. They say in this country between now and 2030, there'll be 50,000 new megawatts of natural gas generation. There'll be 220,000 megawatts of new storage, solar, and batteries. And I actually happen to think that mix will work just fine from a liability standpoint, given some other things that we've talked about already. But you gotta get the market design right to pay for the attributes that you need. In the past, Texas hasn't done that, which is how we've ended up with some out of balance issues. I think on a go-forward basis, we're gonna get it right.
And I will say this, and then let Peter weigh in. On the topic of fuels, it is also the case that natural gas is no panacea, right? And it has a role to play, but it's no panacea. In part, that's because we do not have a pipeline system that accommodates building new natural gas plants everywhere capacity is needed. It is really hard to build new pipelines. I think it should be easier.
You might get your wish with this new commission.
Yeah, right. And hopefully it'll be easier to build transmission and power plants too, right? I don't think any of that should stand in the way of a functioning electric system. You also have real questions in winter about the reliability of that system. And taking us back to Uri, a lot of what was happening was a natural gas system that was not properly winterized and a failure to coordinate across the electric and natural gas systems. Right?
I think it was the coordination. I mean, Ken and I looked into this. Part of the issue was that the gas compressors were put onto the electric mains, and the power companies didn't know which circuits they were on.
Yes.
So when they blacked out the compressors.
And so we go to that. I mean, that's actually relatively easy to fix, right? But building new pipelines is a lot harder to fix. And as someone who says, one of the things I'd like to have in a data center location is firm gas supply, because I'd much rather have natural gas backup generation, or at least the opportunity for it versus diesel. There are not that many places you can get it. Plus, you have a supply chain in terms of gas turbines that is not ramped up for the levels that are being sought. So it has a role to play, but I think there's a rush to say, okay, the molecules are the answer, because we do indeed have a lot of molecules and the ability to produce more, but getting molecules into not just megawatt hours, but dependable capacity where it's needed. There's a lot of work to be done there.
Well, I'm guessing that that has some PTSD when you talk about gas-electric coordination, considering one of the big problems has always been for his gas plants that it makes no sense to have firm gas supply. Just economically, it makes no sense. And now you have data centers that are people out there coming, oh, we want firm gas supply. You can't get it. It doesn't exist. Nuclear. Are we in a nuclear renaissance? Is it a real thing? And does it have a role to play?
I think we're in the nuclear late Middle Ages. That's
sort of my age. Do you have a?
I meant the 1200s. Yeah, just not however young you are.
Because there's a lot of talk, whether it's utility scale, new utility scale, and we have recent examples that show that the economics are challenging, to say the least.
I think if you look at the technical characteristics, there's lots of things to be said for nuclear. I think a lot of the problems are the regulatory issues, right? I mean, you look at, and in terms of that also the cost of building. I mean, we had a discussion yesterday, I think it was, with the like the Korean plants that were built in the UAE. Didn't have the same kind of cost overrun problems. I think a lot of the issues here are because of the excessive regulatory constraints.
Yeah, so look, the existing nuclear will stick around. It's going to become, at least for a while, and I believe it will continue, a national priority. The question is about new nuclear. Vogtle costs $20,000 a kilowatt to build, right? And I don't think all of that is because of the regulatory environment either, to be fair. These things are very expensive. Small modular nuclear reactors, componentization and the like. I think it's a great role of government to get a few of these tested out, and to get some deployed. It'll be in the 2030s before they're here. So with all fairness, we're now talking about the grid in the 2040s before you could even commercially. This stuff, it is expensive. It is more expensive than other alternatives. It is not something that ultimately, I'm talking brand new, not operating the existing. It's going to be more than ratepayers can pay for. I mean, at least if you're using today's, real dollars as something, as a metric. I will also tell you, there is zero chance we can decarbonize our economy ultimately without new nuclear. So to answer the question, I think you have to go all the way out into the 40s, 30s and 40s, and ask yourself, how much are we willing to spend as a people and as a planet, because I don't think one people can do it and have the planet not do it, in order to decarbonize. So I think from a policy standpoint, so it's hard to call, but it's going to be very expensive. And so I think the right answer now, which was not your question, but to say it, is, and I feel the same way about carbon capture and sequestration. 2, let's get some test projects going. That's the appropriate role of government. Get it done, get a couple of these things operating on the ground, figure out, maybe I'm wrong, maybe they're cheaper than I think. Maybe carbon capture works better than a lot of you think. I'm actually kind of bullish it, but let's get a couple of these things going, and we'll see where we are in 5 or 8 years as we've got a couple going at the appropriate level that's not overwhelming any market. So that's where I think we have to go with this. You're buying an option, a real option, but it's hard to imagine, if we are not bound and determined to go zero carbon, how a broad new nuclear build out for the nation can happen.
So it's probably time to take questions if folks have questions for the panel.
You don't have your iPad?
I do not, although maybe I'm supposed to take this iPad up here. Let me look.
Are the questions beamed in?
Yeah, they're on the, coming through here. That's how everyone else was doing it.
Can't see it though. Oh, there we go. Okay, so the first question, would connecting the U.S. power grids from east to west help solve the variability of electricity demand?
No, and there'll be other points of view. I mean, there's a minimum efficient scale issue. And I think all 3 of the grids, there are actually 3 grids in the United States, the Eastern Interconnect, the Western Interconnect, and ERCOT. And all 3 of these grids are more than a minimum efficient scale. So there are politics and there are other issues around this as well that aren't worth going into, but my answer is we should be focused on other things.
Yes, it would help.
Yeah, we did a study here some years back where we looked at the cost and benefits of connecting Texas and California with, you've got solar and wind resources in between and the different time zone. So you could sell in the evening peak in one place and the morning peak in the other. And we found that the arbitrage benefits, the benefits of being able to arbitrage price differences, the time prices we're looking at that time, would help pay for it. But you really needed
after net transmission losses and cost to build the transmission.
But
that's a question.
We needed we did it with high voltage direct current, and we were looking at a new type of transmission line that would have lower losses.
So there's a great example where this has happened, which is New England with Quebec.
With Quebec, yep.
Okay, and I would argue it's not working very well. The last 4 or 5 emergencies, somebody can check this, but it's the last 4 or 5 emergencies. If it was 5, the last 4, they've cut the power coming out of Quebec into New England. If you think they're going to let the lights go out in Montreal in order to keep the lights on in Boston, you're crazy. And this is an issue where you're crossing jurisdictions, and you've got. I mean, I cannot imagine if you're actually having events in both California and Texas, and I realize that's less likely, that they're going to let the high voltage transmission lines go to the Texas market full of power out of California, vice versa. So I just think, sorry, there's so many more issues that we're talking about permitting and getting market signals right. I happen to think this question is one, while it's interesting, it's actually not remotely pragmatic to talk about today. And
so I just a footnote on that, amusing in a way. When Ken and I submitted this paper, one of the questions we got back was, this question is not interesting because it'll never happen politically.
Fair enough.
So one question that came up was, what uses more electricity and strains the Texas grid more, LNG liquefaction, data centers, or Bitcoin mining?
Data centers will be the largest source of load growth, so in absolute term data centers. LNG load growth is meaningful, and it's often in spots of the grid that are harder to get power to. So to some comments about transmission constraints. Bitcoin, I mean, my problem with it is I don't think it really has any social use, and you're turning something that is valuable, which is electricity, into something that
it's worthless.
But setting that aside, it actually has less strain on the reliability of the grid because it is price sensitive and will ramp down when there are constraints, because you don't make any money turning something useful into something not useful if the thing that's useful costs too much. That's my take on it, at least.
One thing I would add on the LNG, I mean, one thing we discovered in our analysis of the ERCOT system and transmission constraints is that South Texas is one of the more constrained areas, and some of the LNG plants down there, maybe there needs to be some transmission augmentation for those. I would imagine.
So there is transmission being built there. Look, a lot of the LNG, not all of them, some are all electric, a lot of them are actually gas-driven with gas-driven compressors, they're derivative engines, so it's not all electric. They're material megawatts. They're not megawatts, they're just gas compressors driving what needs to be driven at these sites. And then, I happen to believe, whatever you believe about Bitcoin, you may also believe about gun stores or liquor stores or whatever else. I don't think government should be in the position of deciding who gets power and who doesn't. But I do believe that you are completely accurate, that there has been, Bitcoin is incredibly price responsive. When you get $150 power pricing, it's thousands of megawatts come off. Just like I believe Senate Bill 6 does for data centers, which is if you declare an emergency, you got to pull that off. So I happen to believe that our grid is capable of taking all of it, and I wouldn't ask that question because they're mitigants, which is price responsive load, Senate Bill 6 protection of data center. I actually think LNG will also be price responsive, as we've seen very much so. So I mean, if people are going to act commercially and they've got a lot of load, it's all going to fix itself.
The study I saw of the Bitcoin found that the most important variable in Bitcoin mining power use is the price of Bitcoin.
Right. I mean, it's a spread, right? It's how much do the electrons cost and how much is the Bitcoin worth, and then I decide whether to run my computer, right?
But the Bitcoin price is so volatile, and it drives.
And for what it's worth, I agree. I don't think the government should be in the business of rationing who gets power, but I do think some priority is going to happen whether we like it or not, right? Like hospitals are going to get power before cloud data centers, and cloud data centers are going to get power before Bitcoin miners. And I mean, regardless of what any of us think, like that's just the way it's going to happen.
So one last question. What are the relative merits of advanced transmission technology like reconductoring, dynamic line rating, what have you, versus new transmission, and how should regulators incentivize these?
You get a lot more benefit for a lot less capital. Unless you're a transmission distribution company. It's the right thing, right?
I think, and to add to that, what should regulators do? They should make sure those options are compared so that when Thad's math is right, and it usually is, that's the prescribed solution. And that goes to what I mentioned before, getting more out of what we have, right?
Yeah.
So we should really push to get the most out of what we have before we go under I worked on developing transmission lines for many years, the 7 to 10 plus year process to get those major lines built.
And part of that is, I think some people have argued that the current protocols are very conservative, and you could actually get a lot more out of the existing transmission lines just by changing the way you use them to some extent.
Well, excellent. Well, thank you guys. I really appreciate it.
Thank you.
Thanks.
Thanks. Enjoyed it. Good. Thank you.
Thank you. Sorry I missed you.
Is it working? By the way, there is one advantage maybe of being a little bit later in the day, and we will not hear the backward movement of some construction project here. Are y'all building a data center? I'm just wondering. Ambassador, thank you for joining. When I took the stage yesterday morning after you, I made a very modest promise about resolving the existential issue of supply chain resiliency by today's session.
I did?
I did. So now let's see if we can do the same for the rest of the existential issues facing the world with 29 minutes left to go. So in the interest of time, I'm going to exercise the lawyer prerogative and ask you a series of leading questions just to establish the witness. You are the director of the Baker Institute. You lead the Center for Middle East Studies here. You have more than 4 decades of experience as a diplomat. You served as the special envoy for Middle East humanitarian issues in 2023 and 2024. I read that you speak Arabic, French, Italian, hopefully English, and have a prodigious collection of honors and commendations for your service. Did I get that right?
I plead guilty.
Okay, good. So let me start with an attitudinal question that might inform the rest of our discussion. We are presently beset by news, and I was looking at the IRC's emergency watch list. Somalia, Mali, Haiti, Burkina Faso, Sudan, Syria, Myanmar, Gaza, the Sudan. Curiously, Ukraine is not on their list. I'll throw it in. Add to it the political tempest in the United States, which has achieved kind of a fevered crescendo, et cetera, et cetera. In the face of an onslaught of bad news, would you describe yourself as an optimist? And if so, why?
Look, with respect to the United States, U.S. values, U.S. leadership in the world, whether we choose or not to exercise that leadership, the opportunity to do is there. I'm an optimist. I have to be. With respect to the globe, there are always a long list of challenges, many of the same issues which you just outlined. Some are newly emergent. All of them are secondary, though, to the fundamental issue of who are we as a people? What do we wish to be? What do we want our role in the world to be, to become? That's far more important than Mali or Somalia or any of the myriad of enduring or emergent crises in the world. If you want to go outside the United States, the 2 big challenges, I'm not breaking ground here, are how do you deal with the phenomenon of Vladimir Putin and Russian irredentism, expansionism, the ongoing, almost daily now, challenges to NATO, to the West, and to the United States, and then the big near peer or peer competitor, China, from an economic, security standpoint, political standpoint in terms of presence and influence around the world. Those are the crises with which we have to concern ourselves. The Gazas of the world are not unimportant, and I don't want to diminish that. People are suffering. And there is a role, as you're seeing it played out right now, literally by the hour today, for the U.S. to lead, for a U.S. president to lead. We have impact, we have agency, we have influence. But these are secondary to the big issue of how does the U.S. see itself? How does it want to be seen in the world? And then how do we deal with the two big challenges, Russia, Putin, and China?
Let me keep it at the attitudinal level. Are you optimistic that the United States, through an exercise of its leadership and diplomacy, can address the issues of Putin and Xi in a manner that secures the American destiny?
Absolutely, if it chooses to do so in a sustained, coherent, strategic manner.
So if you'll indulge a slightly philosophical question, why does it seem for those of us in the United States that we are awash with bad news?
Social media, endless varieties of news that meet whatever one of your particular viewpoints may be. You can find the news channel, the news source that supports your and only your point of view and rejects comprehensively everybody else's. It is the multiplicity of, quote, facts, close quote, and analyses that have contributed to this phenomenon, but there is something else beyond it. I can't blame social media exclusively for this. It is a sense of, if you will, malaise that things aren't right, someone must be to blame. Who is it? You get leaders, whether in politics or in the media or elsewhere, who will identify cheerfully for you who the persons are to blame. It's not unique to the United States either, Danny. It's present in Western Europe, it's present in Asia, it's a developed country phenomenon. But look, we should not deceive ourselves or be deceived ourselves by others. The United States is the most prosperous, strongest country on earth. There was no carnage going on in the United States, except that carnage which we choose to inflict on ourselves. We are still the envy of the world. For all the problems that we and others around the world have, everyone wants to be like us. Nobody wants to be like China. No one wants to be like Russia, a literal dying country, a dying demographic. Let's not mistake that. Let's not so manipulate ourselves into believing that we're confronted, we, a puny, weak, diminishing country, culture, and power, by titans bestriding the earth. She's got problems, lots of them. Putin has beyond problems. He's the last gasp of a vision of a Russia that hasn't existed for many, many decades. Still a challenge, still a real threat. But let's not exaggerate the magnitude of that threat.
By all means. On the philosophical level, my former teacher, Paul Starr, used to say that we would all be subscribers to the Daily Me, which is the ultimate echo chamber of the news that you're looking for. And that, I think, has come to fruition. What has surprised me is that if you're an optimist, and I think I share your views to be optimistic, you don't really have a channel to dial into. There are very few channels that would give somebody an uplift in whether it be on the news or in social media, but that's a different story.
Yep.
So our politics are particularly dyspeptic these days. For many folks in this room, the regulatory state is unforgiving, whether the administration is led by a Democrat or a Republican.
Mm-hmm.
David Barry sat in that chair and said that it's too difficult to build things. He said, however, in China, it's easy to build things. So what will it take to see a meaningful change in the way the United States approaches a regulatory regime that compels innovation, that allows for innovation?
A focus on practicality, pragmatism, and consequences. An examination of regulations, of rule making that looks at what's the consequence of the rule, what's the consequence of the absence of the rule. And consequences cover a variety of different areas. What's the consequence in terms of law, legality, structures? What's the consequence in terms of prosperity? What's the consequence in terms of the environment, the broader sense of how are people doing, how do people benefit in the widest sense of benefit from this? All too much rule making is narrowly focused. It doesn't take a look at the broad range of consequences of the rule or whether the rule was itself required or not. But we're going to be confronting this, and I'm sure this has been discussed in the course of this summit, very shortly, the issue of the rulemaking and regulations that surround nuclear power. As SMRs, as MMRs become market acceptable as power generating sources, and I know you've talked about the question of sustainability, resiliency of the grid, as more and more demands from data centers, from other major consumers of electrical power look to behind the meter power generation. It's going to be gas in the short term. Ultimately, it's going to look if the regulatory climate and the market are suitable, because the technology will be there for SMRs and MMRs. But do we continue to so wrap up a power generating sector in regulation that we defeat the market demand, that we defeat the ability to use this source? That's the real question mark out here. And I can tell you, countries where the politics would argue for such tight regulation, like the UK, have gone in the opposite direction because they have to. They have no choice. Other countries where every reality and problem they are facing today, I'm thinking of Germany primarily, would lead them to regulatory relief for nuclear power, have gone the opposite direction, decommissioning the plants that they had, and they can't be recommissioned because of age, and barring because of domestic politics any revival of nuclear energy. So you can go two different ways on this. I hope the U.S. chooses the appropriate way.
So the United States has been a net positive exporter of primary energy, coal, crude, nat gas, et cetera, since 2019. From the perspective of diplomacy and the American interest, is the United States yielding its position wisely? And how do we balance our energy independence with our influence in global energy markets?
Well, Danny, I would say on the energy sector, this administration has turned around. If we were talking a year ago, I would tell you every U.S. diplomat overseas, every chief of mission, was charged with advancing U.S. energy sales and marketing. Our incentivization to move, particularly LNG, came at exactly the moment that long-term Russian pipeline contracts were expiring. These were contracts that were wholly out of sync with the market. We had floating supply, I'm speaking of the Eastern Med in particular, but we had globally supply out there that could meet at market prices what Russia could not do. And we were eating their lunch. We were accelerating the percentage of sales to countries that had traditionally relied for a plurality or a majority of their imports on Russia. We were replacing it with U.S. LNG. The Biden administration halted that for quixotic, net zero, COP-related reasons, but we're back in the game again, and we will stay in that game so long as we have the supply and the ability to export. Now, Russia hasn't been stupid. They're not suicidal. They have revised completely the terms on which their pipeline gas moves to adjust to the realities of the market, but we've still got an advantage. We can get product out there, we can be responsive to the market in a way Russia cannot.
How do I reconcile your answer with the imposition of a tariff regime that has triggered a response?
Reconciliation of the executive decisions coming out of Washington in terms of logic, pragmatism, is a very, very difficult challenge.
Yeah.
And one I won't attempt, except to say there is a conflict here. There is a set of contradictions. You got to decide what you want. Do you want to punish domestic or external perceived political opponents by taking steps which harm U.S. prosperity, U.S. jobs, U.S. revenues? Or do you want to truly make America first? We kind of already were. But do you want to sustain and make America greater? Then you cannot have these contradictory tariff regimes.
So putting aside the primary energy exports, we're seeing critical minerals, renewable supply chains become as strategic as those fuels once were. So has our diplomatic focus adjusted accordingly? Is there anything that we should be doing that we're not to ensure that we have access to, for example, the lithium and the cobalt?
Sure. Look, the major challenger here is China. And it has been building its access to ownership of rare earth, vital mineral supplies around the world for quite a long while now. Can the U.S. confront this? Sure we can. But the way you confront it is presence and the ability to offer incentives to those countries that have the resources that we want. That is a process that requires two different things. First, we have to be in the game. We have to be out there, and it cannot be in a declarative, performative fashion. I'm going to strike $100 trillion deal because I had a conversation with somebody. No, it requires negotiators. It requires people out there who know how to draft the agreements upon which a company can base corporate decisions, which is not upon rhetoric or political direction coming out of offices, whether in Washington or elsewhere around the world. It's agreements which are binding and recognized as such. We can do it. We can be competitive. We yielded a lot of ground through inattention over many years, but it isn't fatal. We can get it back, but it cannot be performative. It's got to be substantive.
We've been talking about how the United States can wield its power relative to being a net exporter of primary energy. Let me flip the question and ask you, how much influence will OPEC Plus and Russia be able to wield over the coming years, given the United States' position?
Dan, it's a very good question, and I'll try to answer it in a relatively positive fashion. Predicting the decision-making in terms of the fundamentals, pricing and production levels of oil from OPEC Plus, has become infinitely easier over recent years than it ever was in the past for two reasons. Actually, it's the same reason, two countries. Mohammed bin Salman needs all the money he can possibly make, and he will need it for all the years one can imagine into the future. There is not enough money to pay for MBS's grand projects, even scaled down as they are. But take that as a base fact. Saudi Arabia will base its hydrocarbon decision-making on one thing only, and it isn't going to be politics, it's not going to be Gaza, it's not going to be Iran, it's going to be the expert predictions of at what production level do we maximize income for the greatest predictable period of time? And guess what? Vladimir Putin, the gas station with nuclear weapons, he also needs as much money as he can get because he's hurting. He's not hurting enough to impact the decision-making on Ukraine. Just clear statement of fact here. Russia has the resiliency there. It's a complete command economy, and they have their own sources, but they're hurting economically. He's got to make as much money as he can from hydrocarbons. So he and MBS, with a reluctant UAE and sort of other players clustered around them, are going to go for the most bucks for a predictable period of time. And it isn't going to be the complex calculus of other political factors that it has been in the past. All you need to do is look at how little the needle has moved in the face of what would have been, in the past, hugely market disruptive events, including OPCAIC. And a more disruptive event than that, I can't conceive of. It didn't move because the hydrocarbons are there, and by gosh, they got to be sold.
There is a perspective, you referenced it earlier, with respect to Germany's decommissioning of its nuclear plants and its concomitant reliance on Russian gas, that Europe overcorrected on climate at the expense of reliable energy. How would you advise the European leaders to balance between energy security and climate commitments?
Hell, Danny, it's not my advice to them. It's the practical reality. Germany needs power. France, which is in a better position because of its own very robust nuclear supply source, also needs energy. And we've turned out the statistics. We can tell you what the requirements are and what you have to do to get them. Countries cannot operate against fundamental self-interest. Talk to the automobile industry in Germany, who are wondering now, is power going to be available for them to sustain their base? This is why you have major German firms bruiting, at least, the possibility of an exit. They're going to have to make pragmatic adjustments, but they have yet to confront the fundamental dissonance between their climate-related policies and their quantifiable need for energy, which is in direct contradiction to those climate-related or carbon-related or sustainability-related strictures. And I'll give you one example right now. The Corporate Sustainability Due Diligence Accord, which will, and I believe 2028 when it comes into play, if it ever does, impose a 5% of corporate global profits have to be paid if any corporate supply chain is not itself adhering to a net zero requirement. This is beyond ridiculous, which is the phrase that Qatar has used. Qatar has said, we're not going to change. We don't have a net zero commitment. Europe needs, the EU needs our LNG. We can sell it because we got to do contracting on a rolling basis. We're going to sell it to somebody, but we are not going to pay 5% of our global revenues to the EU because we don't have this. Now, the normal reaction of most rational people would be, this is not going to be sustainable. It will never be implemented. It would be suicidal for the European economy. But it shows you the contradictory, fabulous views that have entered into a real issue, which is a question of sustainability, climate, working on carbon reduction through a variety of means. It's going to have to adjust to the law of gravity at some point. But I highlight this because this is not a theoretical issue. This is a today debate between the EU and Qatar.
I want to tilt toward the Middle East on that note. To what extent is the United States still reliant on Middle East stability for energy security?
It is for the following reason, and it's not a complex response. The U.S. has its own resources. The globe does not. The globe's prosperity, I realize this may be a difficult, if not forbidden message, but you know what? Global prosperity is essential to U.S. prosperity. U.S. prosperity is critical to global prosperity. The two go hand in hand. That's been the product of, 80 years of the globalization of economics, and not just in the energy sector. When we speak of the need for a relatively stable Middle East to allow the relatively predictable, sustained flow of hydrocarbons, we're not talking, as we would have in past decades, about because the U.S. needs it. It's because the globe needs it. Look at the interchange and flows of hydrocarbon products. They move back and forth to areas of relative advantage in terms of processing, distribution, marketing. It is an unscramblable egg, but it does require in the Middle East still that relative security and stability. So from that standpoint, it isn't going to change at any point in the near future.
And I guess policing in one way or the other the marginal producer in Iran.
It means that Iran cannot be allowed, and I think they've got the message loud and clear, cannot be allowed to ever carry into place the threats that they have on occasion made to block the strait. Do I think they would try it? Not really. I think Iran is chastened enough by the events of the 12-day Israeli campaign and the one-day U.S. strikes to know if they were to do this, to even attempt to block hydrocarbon flows, there would be a swift response. And so I think in that sense, the risk from Iran may actually be lower today than it has been at any point in the past 20 plus years from the standpoint of hydrocarbons. And I'll note to you one other thing. What didn't Israel hit during the course of their 12-day campaign? And they hit just about everything. Karg Island and the hydrocarbon facilities, because they also realize this becomes a global issue. And if they really wanted the world to intervene to stop them, touching hydrocarbons would have been the trigger for that.
Okay, so far so good then with the Straits and Iran. What about the Houthis in the Red Sea?
The Houthis in the Red Sea have wrought havoc, particularly with respect to Egypt. Egypt has lost $7 billion a year from its single greatest foreign exchange earner, which is the Suez Canal, in terms of transit fees. Those transits to a newly enlarged, doubled in some places, canal, which was a vast expenditure on the part of the government of Egypt, which had to issue bonds to pay for this. The bonds are still in the process of being repaid. Egypt is in a profound, I would say most profound in modern history, economic crisis. That's not the product of the canal restrictions because of the Houthis. It's a product of Egypt's own bizarre economy in which the Egyptian military controls at least 60, 65, 70% of the GDP of the country in a wholly opaque black box. You can't run an economy for a country that size with an entity. It's an army that has a state as opposed to a state that has an army. That's the problem, but exacerbating it hugely are these loss of revenues from the canal. And by the way, the declining revenues from East Med gas fields, mismanagement, overproduction, failure to utilize onshore resources that are potentially there because the military owns them and is waiting for the best deal for profit out of all of this. The Houthis are an issue because bunker fuel is much more affordable today than it was in past years. So you go around the Horn. You don't have to go through the canal just to save critical money. You can still afford to pay for your bunker fuel, go around the Horn, and the market has adapted to the longer passage times. Can the Houthis be defeated? Well, the U.S. had a theoretical ability to inflict even more dramatic harm than the few attacks we took on the Houthis would have done. But we took ourselves out of that equation. So long as U.S. flagged ships, there are very few of those, aren't hit, go to town was the message to the Houthis on just about everybody else, and go to town, they continue more or less to do. Houthis are a very hard target. They are deeply embedded in very tough terrain to hit. They have mastered Iranian weaponry in a fashion which is quite extraordinary in terms of its speed, and Iran continues to have a sufficiently diverse means of supplying missiles to the Houthis that even with interdictions in the Red Sea and elsewhere, they can't be stopped. They're very hard to get at.
Sounds like you believe that the United States will continue to honor its ceasefire relative to the Houthis.
I do not believe the U.S. sees I do not believe the executive sees a motivation to engage U.S. forces for the sake of anybody else in countering the Houthis. And the anybody else, number one, is Israel.
Is there an increasing role for Turkey? I mean, we talked about Egypt as an energy transit hub. In this.
This is the Turkish dream.
Yeah.
Look, Turkey, as many of you understand, is vastly overbuilt in terms of landing points, liquefaction facilities, and pipeline networks. They're not really a serious producer. They have found theoretical resources in the Black Sea, but they're exceedingly deep, and the market cost of actually exploiting those sources is a matter for some a market consideration, whether it's economic or not. But Turkey sees itself not as a producer, but as a mover of fuels. Ukraine, Russia, the Caucasus, all of those into Europe. And the landing points in Europe are all there, in Bulgaria and Romania. The connectivity from those points into Germany, which is really most important, hasn't ever been completed. But in theory, it's there. Look, despite the Turkish-Israeli rift right now, what has Erdogan advocated for years? A Ceyhan pipeline that would allow East Med fuels to move to Ceyhan and through Ceyhan and the network into Europe. Now, the economics of even a 700-kilometer pipeline are now out the window. You ship it all in bottoms, you don't go through pipelines. But that shows you how important the vision of Turkey as a critical transit point, east-west, north-south, is. Can it be realized? Not so long as the Russia-Ukraine crisis goes on. Not going to happen.
The Abraham Accords, the series of U.S. brokered agreements between Israel and the UAE, Bahrain, Morocco, and Sudan, appear to have stalled. But for many students of the Middle East, the broadening of the Abraham Accords has been taken as an article of faith, notwithstanding October 7th and its aftermath. Right. Do you agree with that view?
I do. Look, the Abraham Accords, the signing on to the Accords by the countries you named, weren't done in an act of altruism or philo-Semitism. They were done because of national self-interest. They were the elevation above the table, beyond or outside the curtains, of fundamental security relationships that had been building for many, many years, particularly with the Gulf states. They were the outward acknowledgement of what had been going on. Because for those states, quite rightly, the greatest threats to their security and stability at home isn't Israel. It's not the Palestinian issue, which was almost without attention prior to Gaza, prior to October 7th. It's Iran and it's Salafi jihadi terror. They were the primary threats. And Israel had resources, had intelligence, and from the standpoint of cooperative ventures, the willingness to help in all of these fields. So do I see them as threatened? No. Can they be expanded so long as the Gaza crisis goes on? No. No, they can't. And that brings us to the most important issue here, which is Saudi Arabia. The Biden administration concluded the bilateral U.S.-Saudi portions of the so-called Saudi deal, which has virtually nothing to do with Israel or normalization. It has everything to do with China. The dollar is the reserve currency for pricing. Very specific agreements on production levels and stability in the oil market, and also China and China, as well as intrusive U.S. monitoring of an indigenous fuel cycle, which if the U.S. does not strike a deal with Saudi Arabia, the Saudis will ultimately get from somebody else, South Korea, the Chinese, and it will not have the strictures that the U.S. deal would have. The Israel portion comes in, the normalization, because that deal also contains a U.S. security binding assurance for Saudi Arabia. Binding assurances, real ones, that's not what was offered, Qatar. President cannot sign an executive order making a binding commitment. Only the Senate can do that. Senate's going to have to vote on this. The Senate would not, and the Biden administration would not in this administration, have approved a Saudi security commitment minus normalization with Israel. It was the sweetener that makes the deal work. This administration wants the deal. The preceding administration wants it or wanted it, but you got to have normalization to be able to sell it to the Senate. Normalization isn't going to happen until the issue of Gaza is addressed, which means three things. The fighting stops, essentially, which means the hostages have to come out. That's what's being worked on as we sit here and speak in Sharm el-Sheikh in Egypt right now. Secondly, there has to be an acknowledgement. There will be a Palestinian role in the governance of Gaza, specifically the Palestinian Authority, a reformed Palestinian Authority, a new Palestinian Authority, but it's got to be there. And there needs to be some form of commitment by the government of Israel, however phrased, to the concept of a pathway to a directly negotiated permanent status resolution with the Palestinians. Those are the sine qua non for a Saudi deal. Is it achievable? You bet it is, because the Saudis want it. And we want it too, for all of those China, reserve currency, indigenous fuel cycle, and stability in production pricing issues that I just mentioned. It can't be done without a resolution in Gaza, even if it's a sort of resolution.
Having outlined a resolution for Gaza and cognizant of time, what, and maybe more importantly, when is there a resolution of the Ukraine?
Totally different issue. The president is directly and quite bluntly and publicly now committed to, engaged in getting two things: all of the living hostages and as many deceased hostages as can be collected and found out within 72 hours of the closure of a deal. That closure of a deal has to come quickly. I'm talking tomorrow, Friday, this weekend. There are other parts of the deal: administration of Gaza, stabilization, disarmament of Hamas, Israeli withdrawals. Those all come secondary to those true critical elements. Release of hostages, ceasefire being established. The president has invested himself in that. That investment does not exist with respect to Ukraine.
If we're gathering for the 10th annual Energy Summit next October, are we still talking about a Ukraine conflict?
Depends. It depends entirely on this. Look, I can tell you how Ukraine ends. I can answer Dave Petraeus' famous query. Tell me how it ends? I'll tell you how it ends. It ends over time in a Russian victory through pure attrition. The wearing down of all of the vital civil sectors in Ukraine: power, electricity, water. You make unlivable and unsustainable any Ukrainian resistance or government. That's how it ends, unless there is an ending to the conflict, A, that B, provides meaningful security assurances to prevent, assuming you can get Putin to agree to end the conflict. That's a big if, and I think a most unlikely one right now. If you can get him to agree to freeze the lines, a sort of an armistice, you're going to have a robust security presence on the ground, and it isn't going to be Malians. It's going to be UK, French, and other Western European countries, not as NATO, but as who they are, national forces in a ad hoc coalition of the willing. And there will have to be a U.S. security assurance for those forces. Will that come? I see no indication at present that the current strategy of the United States is anything other than to say, Putin's a problem. He needs to be constrained economically by Europe imposing a 100% boycott of Russian hydrocarbons, which Europe is most unlikely to do, because guess what? Who are the two biggest offenders here? Slovakia and Hungary, great friends. They're the biggest importers of Russian oil. They're not going to stop. That's the excuse not to go further for the United States. Arms, of course. Arms should be sold by everybody. And if Europe won't sell them, it's not my war. It's Europe failed. I do not see a strategic approach which has a meaningful impact on Vladimir Putin's commitment to a prolonged attrition campaign, which, folks, he can manage. Putin's views are that the world, and this is not about the US, we make it about ourselves. It's not about NATO, it's not about the US, it's not about the West. It is about the world. The world brought down the Soviet Union, his world, and laughed. The world danced on the bones of that Soviet Union and collapsed the nascent Russian Federation when the ruble collapsed. We did it deliberately to humiliate Russia. And by God, he is going to get his comeuppance on us. He's going to teach us we can't do that again. So his narrative, which is very convenient for holding power, but it's also very personal. This huge chip he carries on his shoulder against the world, against everyone, is that he will show he can do what he wishes in the classic near abroad of Russia. He will eliminate the Leninist bungle, as he has referred to it, of the 20s, in which Lenin created these artificial states, the Baltics, Belarus, Ukraine, out of what was the Russian Empire, which is the authentic representation of Ruski Mir, the Russian world, the Russian space. That's what he's up to, and he thinks we're all strategically impatient and incapable or unwilling, doesn't matter which, of taking pain. We can do it for a little while, but we don't want to do it for long. Russia is endlessly patient. Russia only knows pain, and so is willing to absorb it forever. And he will attrit Ukraine. If it takes 5 years, it takes 5 years. If 400,000 Russians die, so what? Doesn't matter. It is his narrative, and he will see it through to the end unless he and his military are directly confronted by actions which invoke a price which the Russian military does not believe is acceptable, and which they then, at huge risk to their welfare, it is not good to confront the Tsar. Your health can be affected by that, as Yevgeny Prigozhin. That's what it's going to take. Do I see that coming? No.
Well, I was an optimist until that last answer. On that note, Ambassador, thank you very much, and on behalf of Baker Botts, we're very grateful to you for the partnership.
And thank Baker Botts for all of your support. We look forward to the 10th summit, and I hope on a variety of fronts we have some better news, but I think on many areas that good news is always building and is positive in terms of the energy sector and more consequentialist, realist, rational policymaking.
Thank you.
Thank you.
Appreciate it.
Thanks.
So with that, the 9th Annual Energy Summit comes to a close. Thank you all for being here. I hope you have a lot of positive takeaways, and if there's any feedback you want to share, please feel free to do so. And I look forward to seeing you soon at the next event we have. God bless.